case, when you talk about your time of supply, the only job of this chapter, time of supply, is to find out when to make the payment, liability. This will decide your due date of payment and due date of return filing. If time of supply happens to be say 10th of April for a particular transaction, it means that it has to be reported in the month of April and the due date of that is normally 20th of May. So time of supply will freeze your liability. Without knowing your time of supply, you will never have your due date of payment and due date of return filing. So it will freeze your liability. The objective of time of supply is to freeze your liability. For a transaction, there can be multiple dates, but you have to select one date or at times even multiple dates for different small amounts and freeze your liability. For goods, time of supply is discussed in section 12, and for services, time of supply is discussed in section 13. And when you talk about a special scenario where there's a change in rate of tax, time of supply for both goods and services is discussed in section 14. Now first we'll go with your section 12. We'll see section 12 and 13 together for goods and services by way of a comparative analysis so that easy revising is clearly possible. So when you talk about your goods or services, time of supply, be it section 12 or be it section 13, you have to divide that into 5 categories. Time of supply in case of FCM, in case of RCM, in case of voucher supply, in residual cases, and time of supply for interest on delayed payment of consideration. When you talk about time of supply in case of FCM and RCM, the answer is different for goods, the answer is different for services. But when you talk about your time of supply in case of voucher supply or residual cases or interest on delayed payment of consideration, the answer is same both for goods as well as service. That's no difference. So first we'll go with time of supply in case of forward charge mechanism. In case of forward charge mechanism, it is the only case where you have to work out 2 steps to find out the time of supply. Step number 1 is your due date of payment. The due date of invoice, which is based on your section 31. It is not taken from your section 12 or section 13. Due date of invoice, which is having its roots in section 31. And step number 2 is finding out time of supply either based on section 12, which is for goods, or based on section 13, which is for services. So in forward charge mechanism, unlike all the other cases, you will be having to, you have should work out 2 steps. One, where you're talking about your due date of invoice, that should be the first step. Whether the question is asking or not, that should be the first step. What is the due date of invoice? Second, your time of supply. Second, your time of supply. Right. So due date of invoice is taken from your document chapter, section 31. What is the due date of invoice? And that is also different for goods and services. What is the due date of invoice for goods? So first we are focusing on your first step. First we are focusing on your, we are not seeing time of supply. What we are seeing is due date of invoice. What is the due date of invoice for goods? Normal scenario. There is supply of goods. There is supply of goods which involves movement of goods. Supply of goods which involves normal scenario. You go to any shop, there is supply and there is removal of goods. Then what is the last date for raising the invoice? No breathing time for goods. Immediately. On or before removal. On or before removal. At times there is supply but there is no movement. At times there is supply but there is no movement. The goods are there itself but there is a supply. In that case, the due date of invoice is on or before constructive delivery. On or before constructive, when the ownership has been handed over to the recipient, that is constructive delivery. Normally 99.99% it will be supply along with movement. What is the last day to raise the invoice? Immediately, on or before removal. At times there will be supply of goods but there is no movement. Already the goods will be in the same place or already the goods are with the recipient. Either the goods will remain in the same place or goods are actually with the recipient. Then on or before delivery, which means when the ownership actually is transferred immediately. Again, no breathing time. But there is a special case where the goods are removed on sale of approval on sale on approval basis, then there is a special time. They give you 6 months time. Invoice has to be raised within 6 months from the date of removal or actual supply, whichever is earlier. Please understand there is a hidden deemed supply. If there is no acceptance or rejection within 6 months, it is deemed to be supply. It is deemed to be supply. So invoice have to be given within 6 months from the date of removal or actual supply, whichever is. If it is accepted within 6 months, no issues. Invoice will be given. If it is rejected within 6 months, no issues. Invoice will never be given. The issue is if the acceptance or rejection happens after 6 months, immediately on 6 months you have to give invoice, deemed supply. Deemed supply. And finally, if it is rejected, again give credit note. You have raised the invoice, now give credit note. But finally, if it is accepted, no worry, you have already raised the invoice. If it is accepted after 9 months, you have already raised the invoice at the end of 6 months itself. So you need to understand as a concept of hidden deemed supply. If there is no acceptance or rejection within 6 months, it is deemed to be supply. I'll repeat all the 4 possible scenarios. Accepted within 6 months, no worries. Whenever it is accepted, give the invoice. Rejected within 6 months, no worries. No invoice. No invoice. Accepted after 6 months, no worries. Immediately on 6 months, give the invoice. Supposing it is accepted on 9 months, after 9 months. After 9 months, nothing will happen because you have already raised the invoice at the end of 6 months. It is rejected after 9 months. Then at the end of after 6 months, give invoice because it is hidden deemed supply. Then when it is rejected after 9 months, to cancel that effect of invoice, raise credit note. Either supplier will raise credit note or again recipient can give corresponding tax invoice. Either seller to cancel that effect of tax invoice will give credit note or the customer will become the supplier and he will give the tax invoice. Either or. It is nothing but sale return. In sale return, there are always 2 possibilities. Either the supplier himself will give credit note or the recipient will become the supplier and he will give the tax invoice. Now, in case of services, what is the due date of invoice for your services? We are not discussing time of supply. We are just discussing your due date of invoice. Due date of invoice for goods, 3 situations. We are done. Due date of invoice for services. Now we are trying to see. Normal scenario, service has got breathing time. Normal scenario, invoice has to be raised within 30 months after the completion of service. Within 30 days. Within 30 days after the completion of services. Supply date means after the completion of 30 days. For banking sector and insurance sector. For your banking sector and insurance sector, that 30 days converts to, they have to give invoice within 45 days. Within 45 days after the completion of service. Banking sector and insurance sector. When you talk about special scenario, if at all supply ceases before completion, that is a termination of contract of supply before it actually completes. In between the contract is terminated. In between the contract is normally for services you have breathing time. For goods no breathing time. For services there is a breathing time. But in exception cases for services there is no breathing time. Which means now when the service contract terminates in between, you don't have any breathing time of 30 days, 45 days. Raise the invoice immediately. Raise the invoice immediately. When the moment the supply ceases, raise the invoice immediately. But not for the entire value. Only for the proportionate value. Only for the proportionate value. If the agreed contract value was 10 lakhs and the supply is terminated, say in between, say 20% of the work is over. Now, immediately when the supply is terminated, raise the invoice for the 20% work. If you will not raise the invoice for the entire 10 lakhs, you will raise the invoice for 2 lakhs. Immediately, no breathing time. No breathing time. And when you talk about, again, special persons, be it insurance sector, banking sector, now even telecom sector. Now a special sector has come, telecommunication sector. If the transaction is between their distinct persons, which means same bank, multiple GST number, same insurance company, multiple GST number, or same telecommunication company, multiple GST number. In that case, they can raise the invoice at the time of recording the same in their books of accounts, or maximum time they are given. at the end of the quarter in which supply was made. If the supply is made in April, on or before 30th June. In May, on or before 30th June. In June, on or before 30th June. End of the quarter. Whether the supply is made in the month of April, May or June, on or before 30th of June. Whether the supply is made in July, August or September, on or before 30th September. Whether the supply is made in October, November or December, on or before 31st of December. So likewise, it is to be done. Now, understand that banks have come twice. So you can now segregate it. Banking sector, insurance sector, telecommunication sector, others. We are only talking about your service providers. We are only talking about your service providers. Right. So when you're talking about banking sector, insurance sector, now to their branch offices. To their branch offices, which means distinct persons. Or to their customers. To their branch offices, to their customers. If banks and insurance sector is giving the services to their branch offices, invoice has to be given when? At the time of recording in books or end of quarter. If banks or insurance company are giving the services to the customers within 45 days from the date of completion of service or provision of service. If telecommunication sector is giving the services to their own branch offices having multiple GST number, then at the time of recording in their books or end of quarter. If telecommunication sector is giving services to their customers like us, then it is 30 days from the date of provision of service or completion of service. If you are talking about other sector, whether they are giving the supply to their own distinct persons, that is to their own branches or to their customers, it is within 30 days of date of provision of service. Within 30 days of date of provision of service. For them, there is no change. For them, there is no. In this way, we are able to see three concepts of due date of invoice or services: 30 days, 45 days, and end of the quarter. All the three, except for cessation, everything else is covered. Except for termination of contract, everything else is covered in this particular chart. Right. So that is the due date of invoice for goods and due date of invoice for services. Now there's something called as continuous supply of goods and continuous supply of services. A continuous supply of goods is defined to be a supply on a continuous basis or on recurrent basis. Either the supply itself is a very lengthy supply or it is supplied again and again in repeated cycles, for which invoice is raised periodically. For which invoice is raised periodically, which means there is a periodical agreement that I will be raising the invoice and you will be making the payment. Whereas a continuous supply of service is in a very similar term. Supply is on a continuous basis or on a recurrent basis, and where the payment obligation is periodical. That exactly is the same. If I raise the invoice periodically, you are going to make the payment periodically. Only if I raise the invoice periodically, the payment will be made periodically. So no change. It means a lengthy supply, whether the supply itself is very lengthy or it is supplied again and again. The work gets over, again it is supplied. The work gets over, again it is supplied. The work gets over, again it is supplied. But the difference here is for continuous supply of services, they have an extra condition that the period of the continuous supply of services should be more than 3 months. Should be more than 3 months. It is nothing but a lengthy supply of goods or a lengthy supply of services. In case of a lengthy supply of goods, which is continuous supply of goods, or lengthy supply of services, which is a continuous supply of services, there will be periodical invoice raising obligation or payment obligation. For services specifically, they have defined one more extra condition that it should be more than 3 months. The third condition is an extra condition that it should be more than 3 months. Now understand that you cannot give the invoice for every transaction. It's not possible to raise the invoice for every movement. Right. So here they have said that for continuous supply of goods, your due date of invoice is issuance of successive statement or receipt of successive payment, which was earlier. So supposing I am supplying cables to Jio company for laying the cables for your telecommunication services. I am supplying cables. Contract is given to me by Jio company that I have to supply underground cables, right? High tech cables to make sure that telecommunication services is pakka. I am going to supply cables to Jio company for the entire city of Coimbatore. Now what will happen? Will I raise the invoice for every meter of cable or every supply of cable? Today I have supplied 1000 meters of cable. Tomorrow I will supply 2000 meters of cable. Day after tomorrow I will supply 10,000 meters of cable. No. So as per the contract, I may agree that every month I will be giving a statement and I will be telling that day 1 how much meters was supplied at which area. Day 2 how much meters was supplied at which area. Along with that statement, I have to give my invoice. At times what will happen? Though I have agreed with Jio company that I will be giving monthly statement, which means I will be giving invoice along with that statement normally. But I may be in financial crunch. So I contact the Jio manager and tell that this month, though the month is to get over after say 15-20 days, I want some payment. So I am getting that payment. I have not issued a statement, but I am getting that advance payment. I have to give the invoice for that advance payment. Supposing statement finally comes to 10 lakhs and that advance payment is received in between 3 lakhs. For 3 lakhs, I would have already raised the invoice. For balance 7 lakhs, I'll give invoice at the time of statement. At the time of giving the statement. Now, what is the due date of invoice? Mind you, we are not discussing time of supply. We are discussing due date of invoice. Normally for goods, payment is not relevant at the time of supply. But here, payment becomes relevant not for time of supply, but for due date of invoice. A very tricky question. Understand that this answer is not for your time of supply. This answer is for your step number 1, due date of invoice. What about due date of invoice for continuous supply of services? Now, here, there are 3 different situations. If due date of payment is ascertainable from the contract, the contract clearly tells that after every month is over, within 7 days, you will be getting the payment. When I have to raise the invoice? For April month, on or before 7th May. For May month, on or before 7th June. For June month, on or before 7th July. Because the due date of payment is very clearly given in the contract. It can be not necessarily monthly, it can be even quarterly. Every quarter is over within 20 days, the payment will be received. So I have to give the invoice for April to June quarter on or before 20th July. For July to September quarter on or before 20th October. The contract can also tell that the payment will be made every half year. After every half year is over, within the next month end, you will be getting the payment. So for April to September, 31st of October. For October to March, 30th of April, I have to give the invoice. Whether or not I get the payment, I have to give the invoice. Because the contract tells that payment will be made on so and so date. Second scenario, the contract tells that payment will be made on completion of a particular event. When you complete the 20% of work, first payment will be released. When you complete next 20% of the work, next payment will be released. When you complete the next 20% of the work, another payment will be released. It need not be 20, 20, 20. It can be 20, 30, 40, 10. So first complete 20% of the work, you will be getting first payment. Then 30% of the work, you will be getting the next payment. Then 40% of the work, you will be getting the next payment. Finally, complete the last 10% of the work, you will be getting the next payment. So once I complete the first 20% of the work, I will be raising the invoice for that 20%. Whether I get the payment or not, I have to raise the invoice for that 20%. Once I complete the next 30%, I have to give the invoice for the next 30%. Once I complete the next 40%, I have to give the invoice for that next 40%. Once I complete the last 10%, I have to give the invoice for that 10%. Here payment is not based on time, the payment is based on event. If payment is based on time, the moment that time comes, give the invoice. If payment is based on event, the moment that event gets completed, give the invoice. As simple as that. There can be a special scenario where nothing is mentioned in the contract. Payment is not at all discussed in the contract. Then actual date of payment. If payment is linked to time, give invoice when that time comes. If payment is linked to event, give invoice when that event completes. If payment is not at all addressed in the contract, give invoice when you get the payment. When you get the payment. Link to time when the time comes. Link to event when the event completes. Nothing mentioned when you actually receive the payment. That is due date of invoice for continuous supply of services. But what is the due date of invoice for continuous supply of goods? See, for continuous supply of services, there are three different situations. They are not which was earlier. There are three different situations. This is case 1. This is case 2. And this is case 3 if nothing is mentioned. Three different cases. Whereas for continuous supply of goods, there is only one case. There is only one case. There are no multiple cases. Either at the time of successive statement or at the time of successive receipt of payment, whichever is earlier. There are no multiple cases. There is only a single scenario for which you are going to go with whichever is earlier. But there are three different cases and three different answers. Right. So this completes your first step when you talk about your due date of invoice. Once you are done with your first step, only then you will move to your second step. What is your second step? What is your second step? Time of supply. Now you are talking about your time of supply. Time of supply for goods. If invoice is given in time, actual date of invoice. If invoice is not given in time, due date of invoice. Time of supply for goods. If invoice is given in time, actual date of invoice. If invoice is not given in time, due date of invoice. That's it. Payment is not relevant. Payment is not relevant. Advance payments will not be considered. Don't see the payment. How to find out invoice is given in time or not? By seeing the actual date of invoice comparing with due date of invoice. If your actual date of invoice is before due date of invoice, invoice is given in time. If your actual date of invoice is after due date of invoice, invoice is not given on time. That is how you have to compare and find it out. So what you have to do? You have to see your due date of invoice. So that is the reason first step is finding out due date of invoice. If invoice is given in time, actual date of invoice. If invoice is not given in time, due date of invoice. Payment here is not relevant. Payment here is not relevant. Therefore, advances will not be considered. Advance payment will not be considered. But for goods, when you talk about your composition scheme, for goods, when you talk about your, this was all about your regular scheme. For goods, when you talk about your composition scheme, if invoice is given in time, if invoice is given in time, it is the actual date of invoice or receipt of payment, whichever is earlier. Whichever is earlier. If invoice is not given in time, due date of invoice or receipt of payment, whichever is earlier, which means now payment is relevant. Normally for goods, payment is not relevant. But if you are working under composition scheme, payment is relevant. Payment is relevant. Are you guys clear with this understanding? For goods sector, not working under composition scheme, invoice given in time, actual date of invoice. Not given in time, due date of invoice. Payment, therefore, advance payment will not be considered. If at all you are working under composition scheme for goods, invoice given in time, actual date of invoice or payment, the receipt of payment, whichever is earlier. Invoice not given in time, due date of invoice or date of receipt of payment, whichever is. And whenever we talk about payment, payment is earlier, a payment in books or payment in bank, whichever is. That's always reality. If at all you get multiple dates of payments, one in books and one in bank, you'll go with whichever is earlier. You'll go with whichever is earlier. Now what for service? For services, whether you talk about a regular taxable person or whether you talk about a composition taxable person, the answer remains the same. The answer remains the same. Same answer. No difference. No difference. Unlike goods, there's no difference. If invoice is given on time, it is actual date of invoice or date of receipt of payment, whichever is earlier. Whether it is regular taxable person or composition taxable person. If invoice is not given on time, If invoice is not given on time, it is not due date of invoice. It is date of provision of service or date of receipt of payment, whichever is. Please be very careful that in this case, if invoice is not given on time for services, you don't go with due date of invoice. Though you will find out that in the first step. You'll go with what? Date of provision of service or date of receipt of payment, which was earlier. So for services, there's only one answer. Whether you are under regular scheme or composition scheme. Invoice on time, actual date of invoice or date of receipt of payment, whichever is earlier. Payment is always relevant. Advance payment will always be considered. Invoice not given on time. It is not due date of invoice. You will have that in the first step, but it is not that. You will find out that in the first step, but the answer is not that. It is date of completion of service or date of provision of service or date of supply. By what name you call? Date of completion of service or date of provision of service or date of supply. Or date of receipt of payment, whichever is earlier. So completion of service can be called as provision of service, or at times the question will give you date of supply. So it is date of completion of service or date of receipt of payment, whichever is earlier. So specifically be very clear that it is not due date of invoice. Though you will find out that in the first step. Are you guys clear with this understanding? One very important point both for FCM and RCM. If you get the payment in installments, which means total payment is 5 lakhs, you get 1 lakh then 4 lakh. Or you get 1 lakh, 2 lakh, then balance 2 lakhs. If you get the payment in installment, whether 2 installment or 3 installment, it is equally applicable for FCM as well as for RCM. You have to work out that question as different questions. For 1 lakh payment, work it out separately. For the balance 4 lakhs payment, work it out separately. It is not like payment in books or payment in bank, which was earlier. So when you talk about payment in books and payment in bank, it is the same payment but different dates. In recorded in books and different date recorded in bank. But when I am telling you get the payment in installment, you are in fact getting one payment in a separate month, another payment in a separate month. So when the moment you are talking about payment in installment, 1 lakh payment is happening in the month of April. Maybe in books you have recorded in 12th April, in bank it is reflected in 15th April. So there it is which was earlier. But the second payment, 4 lakhs, is coming somewhere in December month. So that 4 lakhs has to be worked out as a separate question. If you get the payment in installment, if you get 2 installments, work it out as 2 questions. If you get 4 installments, work it out as 4 questions. If you get 5 installments, work it out as 5 questions. This is not only true for FCM but also true for RCM. Payment in installments. One contract payment in installments. Treat it as separate questions and work it out separately. Right. So this is all about your FCM. One small point is left out. This is basically for service provider. If at all you're talking about advance payment. So basically the focus is on advance payment up to 1000 rupees. Petty advances. Advance payment up to 1000 rupees along with previous invoice. This is not normal advance. Advance along with previous invoice, which means you are going to make the payment for an invoice. Supposing the invoice value is 1800, you paid 2000 rupees. Therefore, 200 rupees became advance. That situation we are talking about. So just because it is an advance up to 1000 rupees, you are not covered here. There are 2 criteria. One, advance is up to 1000 rupees. Second, it is along with the previous invoice. In that case, you can ignore the date of receipt of payment. You can focus on the next invoice date. Which means, forget about date of receipt of payment. When the next invoice is raised, time of supply will be together. For that small advances, don't stick to date of receipt of payment. Ignore it. The time of supply will be the next invoice date. For that small advances. What are the 2 criteria where you ignore date of receipt of payment? Advances up to 1000 rupees plus along with the previous invoice. It is not merely advance up to 1000 rupees along with the previous invoice. Then you can ignore the date of receipt of payment for that small advances. Time of supply will be the next invoice date altogether. So that is the point which was left out. That's all about your time of supply for your forward charge mechanism. Be very clear. In FCM, there are two steps. First is due date of invoice, which we have discussed for goods, 3 scenarios, for services, 4 scenarios. Then continuous supply of goods, 1 scenario, continuous supply of goods, services, another scenario. In total, 3 plus 4 plus 1 plus 1. So in totality, you have 9 situations for due date of invoice. Once you find out that, then go to time of supply. For goods, there are 2 answers. Regular scheme, invoice on time, actual date of invoice not on time, due date of invoice. Composition scheme for goods, invoice on time, actual date of invoice or date of receipt of payment, which was earlier. Invoice not on time, due date of invoice or date of receipt of payment, which was earlier. Right, for goods you have 2 answers, but for services, only 1 answer. Whether regular scheme or composition scheme, invoice on time, actual date of invoice or receipt of payment, which was earlier. Not on time. It is not due date of invoice, it is date of completion of service or receipt of payment, which was earlier. And one very important note, when you get the payment in installments, treat them as a separate question, not only for FCM but also for RCM. In RCM, for goods there is only 1 scenario. RCM means recipient is going to make the payment, so you are looking from the angle of recipient, and now the answer is same whether it is regular scheme or composition scheme. Now for goods sector, what is the answer? From the angle of recipient, it is date of receipt of goods or date of making the payment. Recipient will not receive the payment, recipient will make the payment, or 31st day from the date of invoice of the supplier, whichever is earlier. 3 events. When you receive the goods, or when you make the payment, or 31 days from the date of invoice of the supplier, whatever invoice, whether it is tax invoice or normal invoice, date of invoice of the supplier, whichever is earlier. For services, normal scenarios. For services, there are 2 scenarios. Normal scenario is very similar to goods, but make few changes. In services, you cannot have date of receipt of services, so that is removed. Date of making of payment, or the 31 days is replaced to 61 days. So 2 changes are done. You cannot have receipt of services, that is removed. 31 days becomes 61 days. So it is date of making of payment or 61 days from the date of invoice of the supplier, whichever is earlier in normal case. This normal case will include all RCM, including import of services from unrelated person. If it is import of services from unrelated person, that is also covered in normal category. Special category talks about a situation where there is import of services because supplier is outside India and recipient is in India, and that is from associated enterprises as per your Income Tax Act. So here you are talking about importation of services from associated enterprises. All the RCM, including importation of services, will always come in normal case. If it is importation of service from unrelated person, only one case will come in special scenario. What is that special scenario? Importation of service from associated enterprises, roughly you can call it as related person. In that case, your time of supply is date of making the payment, which is the same, just like the normal case. Rather than focusing on 61 days from the date of invoice of the supplier, here you focus on date of entry in the books of accounts of the recipient, whichever is earlier. So it is date of making the payment or date of passing the journal entry for the expenses in the books of accounts. Date of making the payment or date of passing the expenses entry in the books of accounts. Because payment is always earlier of payment in books or payment in bank. So look at this way. There are 3 dates. Payment in books, payment entry in books of accounts, payment in bank statement, or expenses entry in books of accounts, whichever is earlier. Payment entry in books of accounts, payment in bank statement, or expenses entry in books of accounts, whichever is earlier. So what is the change that you find here? The change that you find here is Here, the focus is not on 61 days from the date of invoice of the supplier. It shifts to expenses entry in the books of accounts of the recipient. Expenses entry in the books of accounts of the recipient. Right. So, for services, there are two answers. Normal answer, special answer. Normal answer is making the payment 61 days from the invoice of the supplier, which was earlier. Special answer, which is only for importation of services from associated enterprises. All the other RCM cases, including importation of services. Importation of services is not the only case. All the other RCM cases, including importation of services from unrelated person, will go in normal category. Only one case will go in special category, that is importation of service from associated enterprises, where the time of supply is making the payment or expenses entry in books of accounts of the recipient, whichever is earlier. When you talk about payment, it is always payment in books, payment in bank, expenses entry in books, whichever is earlier is a summary of the special case. Whichever is earlier is a summary of the special case. In case you are not able to find out the time of supply under any of such cases, which means you are not able to find out any of the dates, then time of supply will be the date of entry in books of accounts of the recipient, which means you are not able to see anything, both for goods and goods and services. Then resort to date of entry in the books of accounts of the recipient. Date of expenses entry in the books of accounts of the recipient. That is the last resort, both for goods and services. Now, please understand that unlike time of supply for FCM, which has to be worked out in two steps, in RCM and in all the other cases, time of supply will be worked out straightly in one step. So, first difference, in FCM, two steps. In all the other four cases, one step. Second difference, both in FCM and RCM, the time of supply is separately for goods and separately for services. Whereas in the other three cases, time of supply is the same for goods and services. And the third difference, in FCM and RCM, when you talk about your FCM and RCM, when you get the payment in installment, you have to work out multiple answers. This is not required in the other three cases. Now, when you talk about voucher supply, Now, understand this example that Tata Limited is giving vouchers to its employees. Obviously, it would have purchased vouchers from someone. It would have gone to Big Bazaar and purchased those vouchers, making the payment to Big Bazaar. It would have gone to Pizza Hut and purchased the vouchers, making the payment to Pizza Hut. More importantly, we are talking about the time of supply for Big Bazaar and Pizza Hut. So, who's the supplier? Big Bazaar or Pizza Hut. Who's the recipient? Tata Limited. Who's the recipient? Tata Limited. So, we are thinking from the angle of Big Bazaar and Pizza Hut. Obviously, Tata Limited to employees, that is a separate contract. That is another contract. Right? If the gift value is up to 50,000 per financial year per employee, it is not taxable. If it is more than that, it is taxable. Even for that, the same time of supply will be applicable, what we are discussing. Now, when you talk about your voucher supply, differentiate Big Bazaar case and Pizza Hut case. Understand that Tata Limited is giving vouchers to the employees. It would have purchased those vouchers from Big Bazaar and purchased those vouchers from Pizza Hut. That's the difference when you talk about Big Bazaar case and Pizza Hut case. In Big Bazaar case, supply is not identifiable. Supply is not identifiable at the time of issuance of voucher. Your supply is not identifiable at the time of issuance of voucher. Why? The employees of Tata Limited can go to Big Bazaar and purchase multiple items having multiple rates, and Big Bazaar cannot predict which employee is going to purchase which product. So, supply is not identifiable at the time of issuance of voucher. In Pizza Hut case, your supply is identifiable at the time of issuance of voucher. Pizza Hut clearly knows that the employees of Tata Limited will come and have food, which is having the same rate, whether they are having pizza or garlic bread or something else. It is having the same rate. So, supply is clearly identifiable at the time of issuance of voucher. So, for whom the answer will be very simple? For Pizza Hut, the answer will be very simple. Why? For Pizza Hut, Supply is identifiable at the time of issuance of voucher. When Pizza Hut is giving the vouchers to Tata Limited, Pizza Hut knows that the employees of Tata Limited can only have and come here food, which is having only one rate. Then what is the time of supply for Pizza Hut? Time of supply for Pizza Hut is date of issuance of voucher. When the vouchers are given by Pizza Hut to Tata Limited, there will be only one answer normally. Normal cases, there will be only one answer. Whether the employees are redeeming the voucher, supposing the vouchers are issued by Pizza Hut to Tata Limited in the month of April, whether one set of employees comes in the month of April, redeem the voucher, second set of employees come in June, third set of employees come in September, fourth set of employees comes in October, fifth set of employees comes in December, the answer is the same. For Pizza Hut, there will be only one answer, date of issuance of voucher. Date of issuance of voucher. But for Big Bazaar, the answer will be different. One set of employees who are coming in the month of April, for them time of supply will be April. Second set of employees when they are coming in the month of June, for them answer will be June. Third set of employees coming in the month of September, for them the answer will be September. Fourth set of employees coming in October, for them the answer will be October. The last set of employees coming in the month of December, for them the answer will be. So it is date of redemption of voucher. Big Bazaar will be having multiple answers. Big Bazaar will be having multiple answers because Big Bazaar will come to know about the exact item that the employees are purchasing only in the month of say April or June or September or October or December as the case may be. So it is date of redemption of voucher. Date of redemption of voucher. If supply is identifiable at the time of issuance of voucher, one answer, it is date of issuance of voucher. The answer is closed. If supply is not identifiable at the time of issuance of voucher, then you have to wait. The answer is date of redemption of voucher. And the answer will not be one, it will be multiple answers normally. It will be multiple answers normally. And by the way, what is voucher? Voucher is nothing but money equivalent. Tata Limited has already paid the amount to Big Bazaar and Pizza Hut. In return, it has given the vouchers. And vouchers were then distributed to the employees. When employees are going there and redeeming the vouchers, it is acting like money. It is acting like if the voucher is worth 60,000 and employees are purchasing for 70,000, 10,000 will be paid by cash. 60,000 by voucher, 10,000 will be paid by cash. So what is voucher? Voucher is nothing but an instrument where there is an obligation on whom? Obligation on Big Bazaar and obligation on Pizza Hut to accept it as a consideration or part consideration for supply. And voucher will clearly mention either the goods or services that will be supplied, or it will mention what are the potential suppliers. A single voucher can be given that you can go and use this voucher in Big Bazaar, also Pizza Hut. Right. So goods and services to be supplied will be mentioned there. Potential suppliers will be mentioned there on the instrument or the related documents. And voucher will always have the terms and conditions. What is the last date of using the voucher? For what all items you cannot use the voucher, etc. etc. In Big Bazaar, you can use this voucher for all items except item 1, 2, 3. Except item 1, say 2 and 3. They'll give the terms and conditions. Terms and in simple language, voucher is nothing but money equivalent. Money equivalent. Because Tata Limited has already paid that money well in advance to both Pizza Hut and Big Bazaar. So that is all about voucher supply. Voucher supply. So time of supply under FCM, 2 steps done. Time of supply under RCM, 1 step done. Time of supply, voucher supply, 1 step done. Time of supply in case of residual cases. Time of supply when you're talking about residual cases. Residual cases means basically fraud cases where you don't have records. Where you don't have records. So in the first scenario where periodical return is to be filed, you can write that you don't have records but you are registered. You don't have records but you are registered. In the second case where periodical return is not required to be filed, which means any other case, you don't have records, also you're not, no records, registration, first case, periodical returns are to be filed. No records, no registration, second scenario. Where there is no records but you are registered, your time of supply will be due date of filing of return. Now, how they will find out due date of filing of return? Best judgment. Again, they will find out by way of best judgment that this transaction pertains to so and so month. This transaction pertains to so and so month. Supposing they tell that this transaction pertains to April month, then the time of supply will be 20th of May. Time of supply will be 20th of May. Again, they have to resort to best judgment because you don't have any records. Please understand that when you don't have any records, you have to resort, officer will resort to best judgment. But what is the difference? Suppose in both the cases you don't have records. In both the cases you don't have records. But in one case, officer is able to find that this transaction pertains to April 2023. What will be the time of supply? 20th May 2023. What will be the due date of payment? 20th June 2023. Interest will start from 21st June. Interest will start from 21st June. When officer by the way of best judgment has found that the transaction pertains to April 2023. April 2023. By best judgment he has found. Your time of supply is due date of filing of return, which is 20th May. Your due date of payment will be, assume that you are under regular scheme, 20th of the next month. So time of supply is 20th May, which means due date of payment will be 20th June. Interest will start from 21st June. If at all you are in a scenario where you don't have records and you are not registered, officer through best judgment has found out that the transaction pertains to April. That the transaction pertains to April, but the assessee is not registered. And assessee finally makes the payment. Finally makes the payment somewhere in the month of, say, December 2026. December 2026. What will be the time of supply? Time of supply will be December 2026. Time of supply will be December 2026. In both the cases, officer did his work and said that this transaction pertains to the month of April 2023. But now, as you are not registered, your time of supply is actual date of payment. When you are making the payment? December 2026. So, what is your due date of payment? 20th Jan 2027. By the way, you have made the payment before the due date of payment because your time of supply itself is actual date of payment. There won't be any interest. Here there will be interest starting from 21st of June 2023 till the actual date of payment, because time of supply is your due date of return filing. You understand the difference? In both the cases, officer has done best judgment and found out that transaction pertains to the month of April. But in one case, you are registered. If you are registered, officer will tell that your time of supply is due date of return filing, which is 20th May. Therefore, your due date of payment is 20th June. Therefore, interest will start from 21st June. In the second case, though officer has found the transaction pertains to April 2023, but as you are not registered, your time of supply is actual date of payment. The payment which is made in the month of December 2026. And as the payment is made and that becomes the time of supply, what would be your due date of payment, by the way? Next month, 20th Jan. But you have made the payment before the due date of payment. There will be never any interest. There will be never any interest because you have made the payment before the due date of payment. There will be never any interest. Time of supply itself is actual date of payment. Though it is an extreme fraud case, but there is no interest. Why? Something is better than nothing. They want to collect the tax. Don't worry. Penalty will be there. Penalty will be there. Are we clearly differentiating these two examples? No records in both the cases. In one case registered, in one case not registered. If you are registered, time of supply is due date of return filing. If you are not registered, time of supply is actual date of payment. And finally, when you are talking about the last scenario, interest on late payment of consideration, whether by you call it as interest or late fees or penalty for delayed payment of consideration, is time of supply will be the actual date when you receive the interest. The actual date when you receive the interest. Actual date of receipt of interest. Supposing you have supplied in the month of April 1 lakh plus GST. 1 lakh plus GST. This happened in the month of April 2023. It was promised that the payment will be made within 3 months. But the payment was made after say 9 months. So you demanded interest of 15,000. This was your price. Now you are demanding interest of 15,000 in the month of December 2023, but you are finally getting interest only of 10,000 in the month of June 2024. This is again nothing but your interest, but what is the actual receipt? This is the interest that you have demanded. Interest that you have demanded. This is the interest that you have actually received. What is the time of supply? Time of supply for selling price will be April 2023. It is based on FCM. This is based on FCM. We are assuming that supply happened in April and invoice was also raised in April. So it is April 2023. Time of supply for the selling price will be under FCM. Will be under FCM. So this time of supply that you have found out is time of supply under FCM. What about time of supply for interest on delayed payment of consideration? This will be there for your interest payment when? June 2024. June 2024. And which means here time of supply was for entire 1 lakh. Here it will be for only for 10,000. So interest 15,000 will not be considered, only 10,000 will be considered. That too, income tax calculation. Multiplied by 100 divided by 100 plus rate of tax. Now we are clubbing all the provisions. This is coming from your valuation. This is coming from your valuation. So time of supply for 1 lakh will be under forward charge mechanism, which will be when the supply was made and the invoice was raised. We are assuming that both happened in the month of April. Whereas time of supply for interest on delayed payment of consideration is when interest is actually received. When interest is actually, you demanded interest of 15,000, but what you actually received? So it will be only on 10,000. That too, the valuation part of it will be 10,000 multiplied by 100 divided by 100 plus, because IC's understanding is interest valuation is always based on income tax calculation. I did not do this for 1 lakh. I am doing this only for interest portion. So that's all about your time of supply when you talk about your interest on delay payments. So when you talk about your time of supply for all the 5 cases, be it FCM, RCM, voucher, residual and interest on delayed payment, we have seen. Yes, now another very important chapter, which is composition scheme. A short question which is going to be there in your exam paper is your composition scheme. Yes. When you talk about your composition scheme, the provisions are discussed in section 10. Read along with your rule 3, 4, 5, 6, 7. So basic provision is section 10. Then there's entry point in rule 3, 4 and 5. Rule 3 talks about your intimation, 4 effective date and 5 the conditions and the restrictions. Then there is an exit point which is rule 6 validity. And finally, if at all you are under composition scheme, you have to pay a composition tax, which is rule 7. So basically remove section 10. Section 10 read along with rule 3 to rule 7. Now when you talk about composition scheme dealer, certain important points. It is a scheme for small dealers. It is a scheme for small dealers who cannot comply with the draconian provisions of GST law, who want certain relaxation. The scheme is basically for them. Basically, what are the reasons why assessee will go for composition scheme? One, these are all the advantages basically. Stock details is not required to be maintained. ITC details need not be maintained because they are not eligible for ITC. They cannot even take ITC. They cannot take ITC. 3. They have to make quarterly payment and yearly return. Don't call it as annual return. That is a separate concept per se. Quarterly payment and yearly return. A simple tax, a simple and lesser tax. Normally the tax rate is 1%. For restaurant outdoor catering, 5%. For special composition scheme, 6%. These are all the advantages because of which an assessee will opt for your composition scheme. He will opt for composition scheme. 1. No stock details. Second is not an advantage. ITC is not that, therefore no ITC. Third is an advantage. Quarterly payment, yearly return. CMP 08 quarterly payment, GSTR 4 yearly return. And fifth is obviously another advantage, very simple tax calculation, lesser tax rate. 1, 5 and 6. Obviously when you talk about this, even compensation cess is not that. He may be dealing with certain items which is attracting compensation cess. But if he is under composition scheme, he will pay only 1, 5 or 6. What are the disadvantages? These are all the advantages. What are the disadvantages? He cannot avail ITC on his purchases. He cannot collect tax on his sales. A composition scheme dealer cannot avail ITC on their purchases. Therefore, it will be added to the cost. Obviously, it will be added to the selling price. They cannot collect tax from customer. They have to pay 1%, 5%, 6%, but they cannot collect it from the customers. They have to pay from their pocket. These are all the disadvantages, major disadvantages when you talk about your composition scheme. So, advantages, this is disadvantages of your composition scheme. A composition scheme dealer is not going to give tax invoice, is going to give bill of supply because it cannot collect tax. Now we have discussed the disadvantage. It cannot collect tax and it has to clearly mention on that invoice, that is bill of supply, composition scheme dealer not eligible to collect tax on supplies. So it has to inform the customers that I cannot collect tax from your pocket. I have to pay tax from my own pocket. It is against the basic principle of indirect taxes. Normally you collect and pay tax. In this case, you cannot collect tax, but you have to pay tax. Secondly, at all their places of business, whether it is principal place of business or additional place of business, on the notice board, signboard, the shop name, they have to mention specifically that they are composition taxable person. So the customers are aware that they are going to a shop who's working under composition scheme. Right. So customer is also aware that when they go there, the shop owner will not collect GST, but also understand that when it cannot collect GST, the customer cannot take input tax credit. That's cascading effect. First of all, if I go and purchase from a composition scheme dealer, it is disadvantageous. It is disadvantageous to me. If at all I am a registered dealer. Why? I know that shop owner who's under composition scheme cannot take the credit. Therefore, his cost increases, selling price increases. I know that he cannot collect tax from me, so he'll try to include it within his selling price, within his. It is not an ideal situation for a registered dealer to purchase from composition scheme dealer. That being the case, composition scheme dealer will be opted only by those people who don't have B2B customers, who have only B2C, final retailers. Composition scheme is attractive only for retailers, retail shops, because they don't have their customer base as B2B. They have their customer base as B2C. Now, Under composition scheme, basically there are two types: normal composition scheme and special composition scheme. Normal and special. Now, what is meant by normal composition scheme and what is meant by special composition scheme? Who all can go for normal composition scheme and who all can go for special composition scheme? Normal composition scheme is basically for goods sector plus restaurant, outdoor catering sector. Special composition scheme is for others. When you talk about normal composition scheme, where you're talking about your goods sector and restaurant and outdoor catering sector, two service sector are covered here, restaurant and outdoor catering sector. You have to remember the states because states will have different limits. Now you have to remember this small story. Apni politics. Our politics can be summarized into three. What is that? Louder. Money, land and mainly Ram. Money, land and Ram. Money, land and you are not a very small person. For very small person, there will be one more thing extra, which is time pass. But now you have grown up a bit. You are not grown up to a very larger extent. You have grown up a bit. Very small person means registration limit 40 lakhs, 20 lakhs, 10 lakhs. Now you are not talking about a very small person. You are talking about a small person. So now politics is no more a time pass for you. So you are removing the time pass. Why you have to remember this? Because for 40 lakhs, 20 lakhs, 10 lakhs, TP will come. Telangana, Puducherry will come. For composition scheme, TP will not come. How to remember it? When you are very small, politics is not relevant. Time pass. When you become a bit bigger, not very big, politics is no more a time pass. Now, for all these states and other states and union territories, for all these special states, the limit for composition scheme is 75 lakhs. For other states, it is 150 lakhs. 150 lakhs. This is when you are talking about normal composition scheme. For special composition scheme, all the states, all the union territories, forget about specific categories, it is 50 lakhs. It is 50 lakhs. Either you are under normal composition scheme or you are under special composition scheme. It cannot be both. Either or. First you try for normal composition scheme. If not possible, then you try for special composition scheme. It cannot be both. So either your limit is 150 lakhs, 75 lakhs, or your limit is 50 lakhs. Right. Now, in 150 lakhs, 75 lakhs, what if you are working in Tamil Nadu and Tripura? And by the way, what these short form represents? What is AP? Arunachal Pradesh. S, Sikkim. U, M, Meghalaya. Tripura, Manipur, Nagaland, Mizoram. Right. Now, when you talk about all these states, the limit is 75 lakhs. So if you are working in Tripura, normal composition scheme, 75 lakhs. If you are working in Tamil Nadu, normal composition scheme, 150 lakhs. If you are working in Tamil Nadu and Tripura, whenever there is a fight between elder brother and younger brother, who will win? Younger will win. Right. So 75 lakhs will be the limit. For both states put together, the limit will be 75 lakhs. So whenever the fight is between elder and younger siblings, who will win? The younger one is going to win. 75 lakhs. There's no going back and all. That is, if the fight is between 150 and 75 lakhs, you have to resort to 75 lakhs. Can there be a fight between 150 and 50? No. 75 and 50? No. Why? Either it is normal or it is, if it is special composition scheme, if you're working in Tripura, 50 lakhs. Tamil Nadu and Tripura, both together, you have to go with the limit of 50 lakhs. So there is no change when you talk about your special composition scheme. Now, certain special aspects. In a normal composition scheme, as of now, you understand that it is only goods sector and two service sector, which is restaurant and outdoor catering. Now, please understand that they allow a small service portion. Along with this, there can be a small service portion. It cannot be purely service. Along with this, there can be a small service portion. What is the limit of the small service? 10%, 10% of previous year state turnover or 5 lakhs, whichever is not lower, whichever is higher. Whichever is. So in every state, you can have the small service limit. The small service element will be different from state to state. Will be different from, we call it as inner limit. We call it as, this is technically called as inner limit. This is technically called as outer limit. Outer limit is for all the states put together. Inner limit will be separately for state 1, state 2. And you have to take care that you are not crossing outer limit, all the states put together, as well as inner limit for each of the states separately. Outer limit is pan-India. Outer limit is to be seen pan-India, all the states put together. Whereas this inner limit is to be seen state-wise. Inner limit is to be seen state-wise. And everything should be simultaneously satisfied. If you are crossing the outer limit for all the states put together, go outside composition scheme. If you are within the outer limit, Tamil Nadu and Tripura together, you are within 75 lakhs. But in Tamil Nadu, the service portion has crossed this limit. Though your outer limit is within the limit, but the inner limit in Tamil Nadu has crossed outside composition scheme. In Tamil Nadu, your service is within the inner limit. But in Tripura, your service has crossed the inner limit. The inner limit for Tamil Nadu service limit, the inner limit for Tripura service limit will be different. Because the formula is what? 10% of previous year state turnover. It's not aggregate turnover. This 150 lakhs, 75 lakhs and 50 lakhs is all aggregate turnover. Whereas this inner limit is all state turnover. State turnover. Are you guys clear with this understanding? They allow a small portion of service. So then as a goods sector with a small service, I can be under normal composition scheme. Then for whom it is special composition scheme? It is for pure service sector or service sector with goods where service is more than the inner limit of normal composition scheme. It is therefore two categories. For whom? Either pure service sector or service sector plus goods where service is more than the inner limit of normal composition scheme. You are very well aware that your service is more than the inner limit which is allowed under normal composition scheme. Clear? In generality, you can tell this: goods sector, normal; service sector, special composition scheme. When you're talking about restaurant, outdoor catering sector, normal composition scheme. If it is goods plus service, if service is within the inner limit, normal. If it is goods plus service, service is more than the inner limit, try for special. First try for normal, then try for, but when you're trying for special, you have to be very careful because the limit now decreases. The outer limit now decreases to 50 lakhs. That also you have to be very cautious. Right, now just to make you understand this outer limit and inner limit for normal composition scheme, if you are working in Tamil Nadu and if you are working in Tripura, your previous year turnover is 40 lakhs and 20 lakhs. Your current year turnover is 45 lakhs and 25 lakhs. Can you enter inside composition scheme? First, it is the entry point. It is the entry point. Can you enter inside composition scheme? Can you enter inside composition scheme? Yes, you can enter inside composition scheme. Why? Because your aggregate turnover in previous year is less than or equal to 75 lakhs. It is 60 lakhs. This is entry point. Now let us talk about your exit point. Your exit point will be there. You're going to go outside your composition scheme in a case where your aggregate turnover of current year crosses 75 lakhs, or your inner limit of services in Tamil Nadu crosses how much? What is 10% of 40 lakhs? 10% of 40 lakhs is 4 lakhs or 5 lakhs, whichever is higher, it is 5 lakhs. Or your inner limit of service in Tripura crosses 10% of 20 lakhs or 5 lakhs, whichever is higher. Again, so your total turnover, your total aggregate turnover of Tamil Nadu and Tripura, either it should cross 75 lakhs or your service turnover in Tamil Nadu should cross 5 lakhs or your service turnover in Tripura should cross. If you touch any of these, whichever is earlier, you're thrown outside composition scheme. You're thrown outside composition scheme. You have to be very, very, very clear as to what are they trying to tell. They are telling that entry point is all based on previous year aggregate turnover. Entry point is all based on previous year aggregate turnover. If you see your entry point, it was based on previous year aggregate turnover. Entry point was all based on previous year aggregate turnover. Your exit point is based on current year aggregate turnover. Main criteria. This we call it as outer limit. And these two we call it as inner limit. Either your total turnover of Tamil Nadu and Tripura together crosses 75 lakhs together, or in Tamil Nadu your service portion exceeds 5 lakhs, or in Tripura your service portion exceeds, whichever comes earlier, you are going to exit. You are going to exit the composition scheme. That is how you are going to see your outer limit and your inner limit. Now moving forward, this was all about your entry point and exit point. Now understand that the limit of 150 lakhs, 75 lakhs and 50 lakhs has to be checked for previous year entry point first. If at all satisfied, then you have to even check your current year 150 lakhs, 75 lakhs, 50 lakhs for your exit point. For your exit. When you are seeing your exit point, when you are under normal composition scheme, exit point is not 1. Exit point is outer limit as well as inner limit. If you are working in 2 states, exit point is 3. Overall exit point crossing 150 lakhs, 75 lakhs, or inner limit of each state crossing the maximum allowed service, which is 10% of previous year state turnover of 5 lakhs, whichever is higher. That is for normal composition scheme. For special composition scheme, exit point is only 1, 50 lakhs. Exit point is only, the concept of inner limit is only peculiar to normal composition scheme. Now, this is all about your eligibility. Now, let us talk about certain other conditions and restrictions. First, let us be very clear about the conditions. Let us be very clear about the conditions. If at all you are under composition scheme, the condition that you check basically of previous year is the turnover, outer limit, 150 lakhs, 75 lakhs and 50 lakhs. In addition to it, now whatever we are discussing is true for both normal and special. Whatever conditions and restrictions that we are discussing is true for both your normal and special. If at all you are talking about manufacture of notified goods in previous year as well as manufacture of notified goods in current year. There are no notified services, so I am not going to discuss my discussion on notified services because there are no notified services. Manufacture of notified goods, either in previous year or in current year, you cannot go for composition scheme. Now, what are notified goods? The notified goods happens to be your pan masala, tobacco, ice cream, and your building materials. These items are there even in your registration limit of 40 lakhs, 20 lakhs and 10 lakhs. Pan masala, tobacco, ice cream and building materials. Now what is extra here is aerated water. Now what is special here is the restriction is there only for a manufacturer, not for a trader, not for a trader. And what is another special point here is it is applicable both when you're there in previous year as well as you're there in current year. Which means I should check I did not manufacture these items in previous year as well as I am not going to manufacture in. If I manufactured in previous year, I am stopping it in current year, still I am not eligible. If I did not manufacture in previous year but I am manufacturing in current year, not eligible. Then what should I check? I should check I did not touch these items, manufacture these items either in previous year, also in current year. Then I am eligible. Manufacture of notified goods. Pan masala, tobacco, ice cream, building materials and aerated water. Now you have to differentiate this with your 40 lakhs, 20 lakhs and 10 lakhs. So if you are talking about your items being pan masala, tobacco, ice cream, building materials. And if you are talking about your aerated water. If you are talking about from the angle of manufacturer, if you are talking from the angle of trader. If you are a manufacturer of pan masala, tobacco, ice cream and building material, can you go for 40 lakhs? Can you go for special limit of 40 lakhs? No. You cannot go for special limit of 40 lakhs, which means you can go for 20 lakhs, 10 lakhs, not 40 lakhs. Can you go for composition scheme? No. If you are manufacturing aerated water, can you go for 40 lakhs? Yes. But can you go for composition scheme? If you are a trader of pan masala, tobacco, ice cream, building materials, can you go for 40 lakhs? No. For 40 lakhs, whether you are a trader or a manufacturer, not allowed. But can you go for composition scheme? Yes. Because the restriction here is only for a manufacturer. Aerated water. If you are a trader, can you go for 40 lakhs? Yes. Can you go for composition scheme? Right. Things are very different for all these items. And what if I tell other items, other goods? Other goods. Other goods is very normal. I can think of 40 lakhs. I can think of composition scheme. Whether I am a manufacturer or I am a. So things will differ based on what you are and what concept you are looking for. If it is registration limit, when you can go for 40 lakhs, when you cannot go for 40 lakhs is different. If it is composition scheme, when you can go for composition scheme, when you cannot go for composition scheme is different. So things will differ based on what are you doing on these special items. Now coming back here, the criteria that is there in previous year for composition scheme is only two. Your turnover should not be more than 150 lakhs, 75 lakhs, 50 lakhs in previous year, and you should not be manufacturing notified goods in previous year. All the other points that we are going to discuss is for current year. All the other points that we are going to discuss is for current year. Do not forget this point. It is only and only for current year. Now, what are the other points which are only applicable for current year? You should not be a CTP NRTP. You should not be a special person, casual taxable person, non-resident taxable person, temporary registration. The moment you are taking CTP NRTP registration in current year, get outside composition scheme. Get outside composition scheme. Second, you should not be dealing with non-taxable supply of goods or services. Basically, alcoholic liquor for human consumption and fine notified petroleum products. Can I deal with them in previous year? Yes. Will it be included in my aggregate turnover of 150 lakhs, 75 lakhs, 50 lakhs in the previous year? Yes. I can deal with them in previous year. I cannot deal with them in a common mistake that is done by most of the students in a question given by ICI. They are giving you details of your previous year aggregate turnover, including alcoholic liquor, including interstate supply. And you come to a conclusion that in current year you cannot go for composition scheme. Why? That is all in previous year. In previous year I can have interstate supply. In previous year I can have alcoholic liquor. In current year, I should not deal with non-taxable supply. In current year, I should not have interstate supply. That we are going to discuss the next point. You should not have interstate outward supply in current year. Interstate outward supply in current year. Can I have interstate inward supply? Being in Tamil Nadu, can I purchase from Karnataka? Being in Tamil Nadu, can I purchase from Maharashtra? Being in Tamil Nadu, can I import from USA? Yes. Being in Tamil Nadu, can I sell to Karnataka? Being in Tamil Nadu, can I sell to Maharashtra? Being in Tamil Nadu, can I export to USA? Being in Tamil Nadu, can I sell to SEZ within Tamil Nadu? Being in Tamil Nadu, can I sell to SEZ within Tamil Nadu? No, it is interstate outward supply. Being in Tamil Nadu, can I purchase from SEZ in Tamil Nadu? Yes. I cannot have interstate outward supply in current year. In previous year, can I have it? Yes. I have to just check my aggregate turnover and notified items manufactured. Other things I will be checking only for the current year. Now, in current year, I should not make a supply of goods or services through ECO, which attracts GST, TCS, which attracts GST, TCS. I should not go for that. I should not go for that. If at all I am supplying through Flipkart or Amazon, where GST, TCS is applicable, I cannot be under composition scheme. I cannot be under. These are all the additional criteria. What was the main criteria? Main criteria was my turnover limit. My main criteria was my turnover limit, and other criteria was manufacture of notified goods. That is there both for previous year as well as current year. Both turnover and notified goods manufacturing is there both in previous year for entry point, current year for exit point. They are both 150 lakhs, 75 lakhs, 50 lakhs. I have to check both for previous year for my entry, current year for my exit. Manufacture of pan masala tobacco, I have to check for my previous year for entry point, current year. If at all I start manufacturing in current year, I have to exit. I have to check for both. These 2 points are there for my previous year as well as current year, A and B. 1, 2, 3, 4, whatever we have discussed, they are there only for your current year. So then what are the leftover points? Leftover points are not the conditions. Conditions we are done with. They are the restrictions. What will happen or what you will lose if you are under composition scheme? If you are under composition scheme, you cannot take credit, you cannot collect tax. Disadvantages of composition scheme. If you are under composition scheme, the moment you cross the limit of 150 lakhs, you have to go outside, exit point, main exit point. This condition A and B we have discussed. This is condition, main condition. If you cross your outer limit of 150 lakhs, 75 lakhs, 50 lakhs, you have to exit. So that is the condition that you have already completed. Now what is the first restriction? You cannot take credit on your purchases. You cannot collect output tax on your sales. What is the second restriction? I have to think pan wise, which means if I am violating condition in one state, I have to go outside composition scheme in all the states. I cannot be in composition scheme in one state and regular scheme in other state. That is a restriction. Supposing I am working in 2 states, Tamil Nadu and Tripura. If I violate a condition in Tamil Nadu, I will be thrown outside composition scheme not only from Tamil Nadu but also from all the states. My exit will happen in all the states simultaneously. I cannot tell no, my outer limit is within 150 lakhs, 35 lakhs, 50 lakhs. Only my inner limit I have violated in Tamil Nadu. So I will go outside Tamil Nadu. I will opt under regular scheme. In Tripura I will be under composition scheme. Not possible. Either both the states regular scheme or both the states composition scheme. A combination of regular scheme in one state and composition scheme in other state is not. Even a combination of normal composition scheme in one state and special composition scheme in other state is not possible, though not specifically mentioned. It's not possible. You have to opt the same scheme in all the states wherever you are working. If you are having multiple GST number. And even though you are under composition scheme, you have to pay RCM. There is no relaxation. Just because you are under composition scheme, you cannot take the liberty that okay, I will not pay RCM. Even though you are under composition scheme, you have to pay RCM under section 93, section 94. Now what is the special point? Normally you pay RCM and take credit. Here you will pay RCM but you will not be able to take RCM credit. You will not be able to take RCM credit, it will be added to the cost. Normally, under composition scheme, people think that you are going to pay only 1%, 5%, 6%. But RCM has to be paid at regular tax. 5, 12, 18, 28 as the case may be. Clear? Though you are under composition scheme where you are going to pay 1%, 5% or 6%, but for your inward supply, it is not your outward supply. For your inward supply which attracts RCM, you are going to pay regular tax. When I tell regular tax, it is not 1, 5, 6. It is 5 regular tax or 12 or 18 or 28, whatever it is. But under composition scheme, you have to pay RCM at regular tax, but you cannot take the credit. It will be added to your cost. It will be added to your cost. These are all restrictions. So whatever I have highlighted in your green color finally, right, this small a, small b and your small c, they are all restrictions or disadvantages. Even though you are under composition, if you are under composition scheme, no credit on your purchases, no collection of tax on your sales, and you have to opt uniformly under composition scheme in all the states. It cannot be regular scheme in one state, composition scheme in other state, and you have to pay RCM even though you are under composition scheme. But the disadvantage is you will pay RCM not at 156, you will pay RCM at regular tax, but you cannot take the credit. You cannot take the credit. So that is all to do with your composition scheme, entry point condition and exit point conditions, current year. All these conditions that you discussed are of current year. What are the only 2 conditions for your entry point? All the points that you discussed are all about exit point. What are the only 2 points for entry? Previous year aggregate turnover should be up to 150 lakhs, 75 lakhs, 50 lakhs. Previous year you should not be manufacturing. These are only the entry checks. Rest all or exit. Current year, no CTP, no NRDP, exit. If you are CTP, NRDP, get out. Not be dealing with non-taxable supply. If you are dealing, get out. Not be having interstate outward supply. If you are having, get out. Not be having supplying through eco which attracts CCS. If you are having that, get out. Not be dealing with notified manufacturing notified goods. Though you did not do in previous year, you don't do it even in current year. If you're starting doing it, get out. 5 exit points. Main exit point. If you're crossing 150 lakhs, 75 lakhs, 50 lakhs in current year, get out. So entry points 2. Exit point 6. Exit point. Other points that we have discussed, they are neither entry points nor exit points. They are restrictions. They are all restrictions. Now, when you talk about your composition scheme, as discussed, you have to pay certain percentage. What is the percentage that you have to pay, by the way? 1%, 5%, 6%. If you are under normal composition scheme, I'll write it as 1%, 2% change to 1%. So normal composition scheme, you're talking about a trader, you're talking about a manufacturer, restaurant, outdoor catering. Special composition scheme. Anyone. Obviously, basically it will be pure service or service plus goods, where service is more than the inner limit allowed under normal composition scheme. If you are under normal composition scheme, trader will pay 1% only on taxable supply, not on, that is an advantage for a trader. He will only pay on the taxable item, not on the exempt item. Only for payment purposes, exempt item will be excluded. For all other purposes, checking the entry limit, exit limit, exempt goods also will be included in the turnover. Only for payment purposes. It will be paid only on 1% of the taxable goods. Supposing I am dealing with 2 items, item X, item Y. Item X taxable at 18%, item Y taxable at 0%. 40 lakhs, 20 lakhs. 40 lakhs, item X, 20 lakhs, item Y. I will be paying 1% only on 40 lakhs, item X. not on 20 lakhs item I. But what if I am a manufacturer? I'll be paying 1%. The highest possible rate is 2%, but as of now notified rate is 1%. I'll be paying 1% on taxable supply as well as exempt supply. So if I'm dealing with two items, like I said, item X and item Y having the normal rates as 18 and 0, the turnover as 20 lakhs and 40 lakhs and 20 lakhs respectively in current year. As a trader, my composition tax will be 40 lakhs multiplied by 1%. As a manufacturer, 60 lakhs multiplied by, obviously this 1% will not be 1%, it will be 0.5% CGST and 0.5% SGST. And always composition scheme dealer will have only C plus S, because he cannot have interstate outward supply. He cannot have interstate. So this will be split between CGST and SGST. This will be split between your CGST and SGST. Right. Now coming back to the rates. If you are under normal composition scheme, restaurant outdoor catering sector, 5% on what? Taxable supply plus exempt supply, everything. If you are under special composition scheme, 6% on what? Taxable supply plus exempt supply. The relaxation of not paying 1% composition tax on exempt supply is only for a trader. It's only and only for a trader. It is not for others. It's only and only peculiar to a trader. The trader, you pay 1% only on the taxable goods, not on the exempt portion. And whenever trader or manufacturer or restaurant outdoor catering sector, they are paying 1% or 5%, it is not only on the goods or restaurant outdoor catering, it is also on the small service portion. A trader can have trading of goods with a small, even on the small service portion it is 1%. Manufacturer can have manufacturing of goods with a small service portion. Even on the small service portion it will be 1%. A restaurant outdoor catering can have restaurant and outdoor catering service along with small other service. Even on that small other service it will be 5%. Because restaurant outdoor catering 5%. Small other service it will be 5%. In special composition scheme you can have service with little goods. You will be paying 6% not only on the service but also on the goods portion. That is how you have to calculate your composition tax. You have to calculate your composition tax. And one very special thing in composition scheme, whether it is your previous year aggregate turnover, you use various turnovers, right? Previous year aggregate turnover for what? Entry. Current year aggregate turnover for what? Exit. You also use current year state turnover for what? Inner limit. Exit, inner limit. You also use current year state turnover for what? Payment. You have previous year aggregate turnover for entry, current year aggregate turnover for exit, outer limit. Current year state turnover, that the 10% of previous year state turnover. See, it is previous year state turnover, but that service should be in current year. So rather I will write this just because we have understood in that way. The calculation is based on previous year state turnover and the service should be there in the current year. So that we understand. So we will go with the same understanding. Percentages of previous year state turnover and service should be of current year. Current year state limit. Obviously current year you are going to see state by state. This is again exit point. This is again exit point, inner limit. And current year state turnover for, see, if I am working in Tamil Nadu and Tripura, my payment will be separately there in Tamil Nadu, CGST 0.5% and Tamil Nadu SGST 0.5%. If I am a trader. In Tripura, it will be 0.5% CGST and 0.5% Tripura SGST. It will be state to state. My return filing and all will be state to state. It will not be together one. It will be state to state. So that is again current year state turnover. You used 4 things. Previous year aggregate turnover for entry, current year aggregate turnover for exit, previous year state turnover to calculate inner service limit of current year, to calculate inner service limit of current year, again for exit, and current year state turnover to calculate payment for current year. That is for payment purposes. In all these cases, whether it is previous year aggregate turnover, current year aggregate turnover, previous year state turnover for element, current year state turnover for payment purposes, interest on loans or deposits will not be counted. This is only and only for composition scheme, not for any other place in GST. Interest on loans and deposits will not be counted. It will not be included in the calculation. You are not going to count it. If it is there in the question, treat the question as remove that amount and calculate the other numbers. If I tell previous year aggregate turnover is 160 lakhs, 145 lakhs normal and 15 lakhs interest on loan. So according to you, what will be a previous year aggregate turnover for composition scheme? 145 lakhs. 145 lakhs. Current year aggregate turnover you have crossed 150 lakhs. Out of which 130 lakhs is normal and 20 lakhs is interest. So have you crossed the limit? No. Because it is still 130 lakhs. You have to remove interest on loans and deposits. You are going to remove it entirely in all the places throughout composition scheme. Is it done in any other place? No. It is done only in composition scheme. It is excluded, and it is excluded throughout composition scheme for all the places. Number wise, there will be 4 numbers. Previous year aggregate turnover, current year aggregate turnover, previous year state turnover, current year. You remove it in all the places. You remove it in all the places. Are you guys clear with this understanding? Right. So that is all about your interest on loan portion calculation part. Very important point for your working out. You have to exclude it all the places. Throughout your composition scheme, remove it. If it is already removed, don't do anything. But if it is not removed, included, remove it. Remove your interest on loan. Right. Now, what is the leftover area in your composition scheme? We are done with the eligibility part, entry point, exit point, calculation point. Entry, exit, calculation, over. Other procedural points. Other procedural points. When you enter, can you enter composition scheme just like that? No. If you are already registered, if you are going from regular scheme to composition scheme, something special. If you're directly coming inside composition scheme, new registration, that is different. One is regular scheme to composition scheme. The first part is regular scheme to composition scheme. The second part is you're taking new registration, directly you're selecting. If it is regular scheme to composition scheme, you have to give an intimation that you want to go for composition scheme before the next financial year starts. Which means if you want to go for composition scheme from 24-25 onwards, financial year 24-25, you have to give this intimation on or before 31st of March 2024. Before the commencement of that financial year. Before the commencement of that. And if you give that intimation before the commencement of that financial year, it will be effective from the beginning of the financial year. You will be working under composition scheme from 1st of April 2024. Can you enter inside composition scheme in between a year? No. If you're already working under regular scheme, you cannot enter inside composition scheme in between of a year. You can start from, you can enter composition scheme only from 1st April of next financial year, which means a new financial year. For which you have to make sure that you are giving an intimation on or before the financial year starts. Before the financial year starts, not on or before. Before the financial year starts. You cannot give that intimation on 1st April. You have to give that intimation on or before 31st of March. And if you give that intimation, automatically from 1st of April of next financial year, you will be under composition scheme. Sir, I'm already working under composition scheme. Should I give the intimation every year? No. You're already working under composition scheme. Fresh intimation is not required. If I'm under composition scheme, next year should I give again intimation? No. By default, I'll be continuing to work under. This is required when? Only when you're switching from regular scheme to, not when you're already under composition scheme. Now, when you're going from regular to scheme to composition scheme, one more thing will happen. You have to give another statement for reversing input tax credit on your stock of inputs and capital goods, which you have to do within 60 days from the beginning of the financial year. That discussion is there in your ITC chapter. What amount of reversal? Why? Under regular scheme you enjoyed input tax credit, under composition scheme you cannot enjoy input tax credit. There is some stock which is going to be sold in composition scheme, but already you have taken the credit. So you have to reverse that credit on your inputs and capital goods. That you have to do within 60 days from the financial year beginning. Right. Now, what if you are going for a new registration and in the beginning itself you want to opt composition scheme? Can you do it? Yes. If you are going for a new registration, when you are making application for registration, there itself select you want to go for composition scheme. In form REG01, which is a registration application, select you are interested in going for composition scheme, which means if it is new registration, can you enter inside composition scheme between of a year? During the year? Yes. But what you have to do? When you are filing registration application, select that you want to go for composition scheme. And when you do that, your effective date will be your effective date of registration. Your effective date of registration. That is all about your entry point. Now what about your exit point? Either you go out yourself or you're thrown outside by the officer. If you're going out yourself, there are two possible scenarios. One, you are not satisfying the condition. Therefore, within 7 days, you have to give an intimation that you are not satisfying the condition and switch over to from composition scheme to regular scheme. Understand that even if you don't give that intimation within 7 days, you are thrown out. Now the 7 days is not so crucial. Whether or not you give that information within 7 days, from that date you are thrown out. You are outside composition scheme. 7 days is the time for within which you have to give it. Even if you don't give it, from the date you violated the condition, you are thrown outside composition scheme. And when you are under regular scheme, you can take the credit, you will be giving tax invoice, etc., etc. That all points will come. Now, there is a second possibility. What is the second possibility? You are eligible for composition scheme, but you don't like composition scheme. First is, you want to go under composition scheme, but you are not fulfilling the criteria. Second is, you are fulfilling all the criteria, but you are not interested in composition scheme. Give an intimation, go out. The moment you give an intimation, from that time you are going out. Now that 7 days will not come because you have not violated any condition. You don't like it. You want to take ITC. Therefore, you tell that from today onwards, I don't want this composition scheme. One very crucial important point. Composition scheme to regular scheme can be between of a year. It can be in course of during the year. It can be during the year, in between of a year. That is possible. Composition scheme to regular scheme. Whether you have violated the condition or you don't like it, in both the cases, rather even if proper officer is going out, in all the cases, you can go outside composition scheme to regular scheme in between of a year. That's possible. Now, what is the other criteria? You are not going outside. Proper officer is throwing you outside. So, obviously, he should give you show cause notice. Principle of natural justice. He will be giving you show cause notice and you are required to reply within that show cause notice. What will the show cause notice will tell? Show cause notice will tell that proper officer is having reasons to believe that either you are not at all eligible for composition scheme or you are eligible, you have violated the conditions in between. Either right from the beginning you are not eligible or in between you violated the conditions. After you get the show cause notice, you have to reply within 15 days. After you reply or after 15 days, so in case you don't reply from the end of 15 days, officer has to give an order within 30 days, either accepting the reply, okay, I thought you're not eligible. I thought you violated the condition, but now after you reply, I'm convinced that you are eligible. You did not violate the condition. Nothing will happen. Nothing will happen. But if proper officer is not satisfied with the reply, he will deny the option to pay under composition scheme. He'll throw you outside composition scheme from composition scheme to regular scheme from a date which is from which you contravene the provision. So you have to understand that proper officer will throw you out from composition scheme retrospectively. He'll throw you out today, but from an older date. But a circular is there clarifying that older date cannot be any fancy date. It should be a date from which the conditions were violated. The conditions were violated. From that date, you are thrown outside. And by the way, when you are thrown outside composition scheme, you are thrown outside composition scheme not only from that state but also from all the states. So if you see this particular point, when you're going outside composition scheme, you're going outside composition scheme in all the states. And when you're going outside composition scheme, you can now take the credit. You can now take the credit within 30 days. You can tell that now on the stock of inputs and capital goods which I have, from the date I am shifting from composition scheme to regular, I will avail the credit. Again, this also is discussed in your ITC chapter. Regular to composition scheme, on the stock you have to reverse the credit. Composition scheme to regular scheme, on the stock you are allowed to avail the credit. On the stock you are allowed to avail the credit. So that is all about the procedural part which was left out in your composition scheme. Now one special point which is there given in the end is, what if you decide to take the benefit of both registration and composition scheme? What will happen? If you want to enjoy both registration limit of 40 lakhs, 20 lakhs, 10 lakhs, then enjoy composition scheme. They are clarifying that, assuming that you are in the state of Tamil Nadu, you are dealing only with goods. So your registration limit is 40 lakhs. So they are telling that till 40 lakhs, you are not going to get registered. Right? Assume that your turnover is crossing for Tamil Nadu for goods. Again, composition scheme limit is 150 lakhs. Finally, when you are ending your turnover, total it is 170 lakhs. It is your first year of business. Therefore, previous year aggregate turnover is satisfied. When you talk about 40 lakhs registration limit, you don't see previous year and all. You directly only see current year limit. You are going to get registered only when you're crossing 40 lakhs. From the time you're registered till 150 lakhs, you'll be under composition scheme. After you're crossing 40 lakhs, you'll be under. Please understand that here you are not registered. Then you are registered. The moment you are registered only under composition scheme directly. New registration, you can enter inside composition scheme in between. Then finally under regular scheme. What are they trying to tell here is, what are they trying to clarify rather? For the portion of 0 to 40 lakhs, your tax will be 0. Now for calculating 150 lakhs, you will not start from 40 lakhs. You will start from 0. It is not 40 to 150. It is not 40 to 190. It is not 40 to, it is again 0 to, see, this is 0 to 40, this is 0 to 150, this is 0 to 170. So now for composition scheme, the earlier 40 lakhs will also be counted. But when you are making the payment, they give a logical clarification that composition tax will be only on 110 lakhs multiplied by, say if you are a trader, 1%. They tell that no need to pay on that 40 lakhs because you are already enjoying registration limit. See, at one point they tell that the earlier 40 lakhs will be counted for exit limit. Second point, they tell that for payment purposes, we will not touch it. For exit limit, we will count 40 lakhs. But for payment purposes, we will not touch. Otherwise, there is no benefit of enjoying the limit of registration. And for last 20 lakhs, you are going to pay regular tax, which is say 20 lakhs multiplied by assume that regular tax is 18%. If you assume that regular tax is 18%, you'll pay. So that part is clarified. That portion is clarified. I repeat, all these turnovers, be it 40 or be it 150 or be it 170, the starting point is 0. 0 to 40, 0 to 150, not 40 to 150, 0 to 150 and 0 to 170. The earlier 40 lakhs will be calculated for composition scheme with respect to exit. When you are seeing exit, you will even include the earlier 40 lakhs. But when it comes to payment, you will not include the earlier 40 lakhs because you did not get registered. You are enjoying the benefit of registration limit. So for exit purposes, that 40 lakhs was counted, but for payment purposes, that 40 lakhs was not counted. For exit purposes, when you are going to exit your composition scheme, the earlier 40 lakhs was counted, but for payment purposes, when you are making the payment, that earlier 40 lakhs was not counted. Earlier 40 lakhs means that limit till which you got the registration. Assuming you got the registration of 37 lakhs, so it will be 37 lakhs. You did not wait for 40 lakhs. You got registration right at 37 lakhs. Then you will not pay on 37 lakhs. On 130 lakhs, you will make the payment. You did not wait for 40 lakhs. You got registration at 25 lakhs. Then on 25 lakhs, you will not make the payment. But on balance, 25 lakhs, you are not going to make the payment. Till the time you are required to get registered and you actually got registered, that amount will not be again included in payment. So for that exit purposes of composition scheme, 40 lakhs is counted. For payment purposes of composition scheme, you don't count that 40 lakhs. So that is the last small portion. Again, important portion. 2-3 times questions have been asked. Small but portion, but an important portion connecting two chapters: registration limit and composition scheme. You have to understand this in this particular manner. So that's everything about your composition scheme. A very, very important chapter. So when you talk about your section 18, it talks about ITC in special circumstances. To be very specific, it talks about what scenarios? First, you're talking about a person who has gone from composition scheme to regular scheme, or a person whose supply initially was exempt supply, now it has become taxable supply, or you're talking about taking new registration. 3 scenarios: composition scheme to regular scheme, exempt supply to taxable supply, taking new registration. When you're taking new registration, you have to take care. If you're liable for registration, you have to apply for registration within 30 days from the date you are liable for registration. If it is voluntary registration, no worry. If at all you are liable for registration, make sure that you have applied for registration within 30 days. Application should be made within 30 days from the date when you are liable. This 30 days is very crucial, discussed in multiple chapters. So if at all you want to take the benefit of other points, including ITC, you have to make application within 30 days from the date you are liable for registration. When you're talking about these three cases here talks about your availment of credit. What are the 3 cases? Composition scheme to regular scheme. Your exempt supply has become taxable supply. You are not registered, now you are going for new registration. If you are liable for registration, you have to apply within 30 days from the date you are liable for registration. If you are taking voluntary registration, obviously there is no concept of 30 days. You are taking voluntary registration. This is all about your availment. When you talk about reversal, it is exactly ulta. You are going to composition scheme from regular scheme. So, regular scheme to composition scheme. Then, Earlier your outward supply was taxable, now it becomes exempt supply. Or earlier you are registered, now you are cancelling your registration, cancellation of registration. In the first three cases, it is all about availment of credit. Composition scheme to regular scheme, exempt supply to taxable supply, new registration. In the next three cases, ulta cases, regular scheme to composition scheme, taxable supply to exempt supply, cancellation of registration. Obviously, if you are under composition scheme or if your supply is exempt supply, if you are not registered, you cannot take ITC. So here the concept is all about reversal of ITC. Now why this availment and reversal is, by the way, coming? This is coming because when you are doing that conversion, on that particular date you will have some stock of inputs and capital goods, correct? On the date of conversion you will have some stock of inputs and capital goods. In the first scenario, on that stock of inputs and capital goods, you do not have taken the credit because you are under composition scheme, or you are having exempt supply, or you are not registered, or you are not registered. Now you are under regular scheme having taxable supply and registered. So what you will do on that stock, you will try to avail the credit. On that stock on which you have not taken the credit, now you will try to avail the credit, but because you are covered by regular scheme, your supply is taxable supply or you are registered. What happens in reverse scenario? Earlier you are under regular scheme taking the credit, having taxable supply taking the credit, registered taking the credit. Now you are under composition scheme, credit is not allowed, your supply has become exempt supply, credit is not allowed, you are cancelled your registration, credit is not allowed. So on that date you have a stock on which you have already taken the credit. Now you have to reverse the credit. You have to reverse the credit. Now government shows its true color when it is all about your availment and reversal. When it talks about availment, it tells certain important aspects. If it is availment, you can avail the credit of inputs and capital goods. Inputs and capital goods. Inputs means inputs as such or lying as work in progress or in form of finished goods. You have to convert that work in progress and finished goods and bring it back to the number of units of inputs. You can take the credit on inputs and capital goods if it is availment. But if it is availment, you can take the credit of inputs and capital goods when you are talking about composition scheme to regular scheme, exempt supply to taxable supply. But when it is about new registration, you can take the credit only and only of inputs. Only and only of inputs. You cannot take the credit of capital goods. So when you're talking about composition scheme to regular scheme, exempt supply to taxable supply, you can take the credit that of inputs as well as that of capital goods. You can take the credit of inputs as well as capital goods. Inputs as well as capital goods. But when it is new registration, you can take the credit only of inputs, not of capital goods. But the same logic is not applicable for reversal. If it is reversal, whether it is regular scheme to composition scheme, taxable supply to exempt supply, you have to reverse the credit on inputs and capital goods. Reversal will be there on inputs and capital goods. Even if it is cancellation of registration, even there reversal is on inputs and capital goods. So you can clearly find the difference. When it is availment, only focus on registration part. When it is availment, taking new registration, you cannot take the credit on stock of capital goods. You can take the credit only on stock of inputs. But if it is cancellation of registration, you have to reverse credit on the stock of inputs as well as capital goods. So it is not fair. It is not on equal balance. There is no balance here. When it is availment for new registration, only on inputs, not on capital goods. When it is reversal for cancellation of registration, reverse both on inputs as well as capital goods. It doesn't stop here. when it is availment, you cannot avail the credit of stock, be it inputs or be it capital goods, if it is older than 1 year. If it is older than 1 year from the date of conversion, when the conversion date is happening, go back and see 1 year. Only that last 1 year stock, be it inputs or capital goods, you can take the credit. So stock should not be more than 1 year old. Stock of inputs as well as stock of capital goods should not be more than 1 year old. So credit is not allowed if the stock is older than 1 year. But for reversal, you don't find a corresponding point, which means whether the stock is within 1 year old or more than 1 year old, you have to reverse on everything. For availment, stock should be within last 1 year. Supposing you have stock of inputs 10 lakhs, out of which 8 lakhs is last 1 year, 2 lakhs is older than 1 year. You can avail the credit on stock only of 8 lakh units. But if it is reversal, you have to reverse on entire 10 lakh units. That doesn't stop here. If you have to avail the credit, you have to make application in ITC 01, a special form, within 30 days plus extension. Within 30 days plus, if you don't apply on time, forget about the credit. If at all you are going to reverse the credit, you have to file a form, either it is GSTR 10 for cancellation of registration or ITC 03 for your taxable supply to exempt supply or your regular scheme to composition scheme. But whether you apply on time or you don't apply on time, that will be reversal. If you want the credit, you make application within 30 days plus extension. But if you have to reverse the credit, whether you make that application, there are two forms for cancellation GSTR 10 and for other conversion ITC 03. Whether you apply on time or after time, you have to do reversal. If we are doing late, you have to do reversal with interest. And for availment, when you are availing it, the amount is more than 2 lakhs. It has to be certified by a CA or a CMA. It has to be certified by CA or CMA. But here, there is no such point. There is no need of certification by CA or CMA. At times, you require certification by CA or CMA if at all you are not able to find the market value. Not for 2 lakhs. If the reversal amount is 2 lakhs, 20 lakhs, 2 crores, no certification. So then why the certification is required? This certification is required because when you are trying to find out the value of the stock, you know that is 10 lakh units. But you are not able to find out one-to-one linkage, this 10 lakh units are purchased one. You are trying to find out the market value. For that market value, CACW certificate. Not for the value, not for the amount of reversal of credit. So normally CACW certificate, CMA certificate will not come. The CMA certificate will come if at all you have difficulty in finding out the value of the stock. Otherwise, it will not come. But here for availment, even if you are able to find out the value of the stock, come with CMA certificate if the ITC availment is more than 2 lakhs. And ITC that is availed will come and sit in your credit ledger. And ITC that you are going to reverse, you have to either reverse from your credit ledger if you have the amount in credit ledger, or if you don't have, you have to pay by cash. The irony is, after supposing you have to reverse 10 lakhs, in your credit ledger you have 8 lakhs, you have to pay 2 lakhs by cash. Supposing you have to pay reverse 10 lakhs, in your credit ledger you have 15 lakhs. So you will not pay anything by cash. That extra 5 lakhs that you have will lapse. That extra 5 lakhs that you have will lapse. There is no logic, no rational. It's only government's point of view that they are trying to do this. You can see clear-cut differences between your availment and reversal. Not only for registration and cancellation, that was one special point, but all the other points, whatever other points that we have discussed, it is true for all scenarios. All scenarios, composition scheme to regular scheme, exempt supply to taxable supply, taking new registration. Regular scheme to composition scheme, your taxable supply becomes exempt supply, cancellation of registration. It's true in all the scenarios. That only one point was there specifically for registration and cancellation of registration. All the other points that we have discussed, your age 1 year, certificate, CMA certificate 2 lakhs, right? Application within 30 days. All of them are applicable for all the cases, not only for your registration and cancellation of registration. Now, There's one more difference when you talk about availment. For capital goods, you have a separate method to calculate how to get the credit of capital goods, separate method for reversal. Now let us take one example to understand both. Supposing on 10th of April 2023, you have purchased a capital goods on which ITC happens to be say 1 lakh. ITC happens to be say 1 lakh. This conversion is happening. Supposing the conversion from composition scheme to regular scheme happens on 1st of December 2023. Or conversion is there from taxable supply becoming exempt supply. This is happening on 1st of December 2023. I'll change the date and I'll make it as 10th of June. 10th of June. I'll change it to 10th of June. Right. Now, please understand how things will work out. And this date, this conversion date, I'll make it as 1st of November. 1st of November. Now, here is a scenario where you are talking about availment of credit. Correct? Composition scheme to regular scheme. Here is a scenario where you are talking about reversal of credit. Specifically for availment of credit, I have not taken the case of new registration because in new registration, you can avail the credit only on stock of inputs, not of capital goods. So I have taken care of that. And in case of reversal, in any case, reversal will be there. Even in case of cancellation of registration, reversal will be there on capital goods. How to calculate it? How to calculate the numbers? For availment of credit, it is subtraction method that we have already discussed. Subtraction method. Availment of ITC. It is the credit amount 1 lakh rupees minus 1 lakh multiplied by 5% per quarter or part thereof. So the quarter will start from 10th June to 1st number. How many quarters? Quarters always represents calendar quarters. So how many calendar quarters? 3 calendar quarters. 1st June to 30th June, 1. 1st July to 30th September, 2nd. 1st October to 1st November, 3rd. 1st October to 1st November, 3rd. How many calendar quarters are there? 3. But if you normally do quarter calculation, how many quarters would have been there? July, August, September, October, November. It would have been 2. But calendar quarters are? So calendar quarters are 3 calendar quarters. So how many quarters will subtract? 3. So what will be the answer? 85,000 rupees. 85,000 rupees is the availment. For availment, what method you go? You go with subtraction method. For reversal, you will go with multiplication method. Now, how many quarters are how many months are over? Multiplication method focuses on months. From 10th June to 1st November, how many months are over? How many months are over? Now, months, it is not calendar months, it is normal months. Normal months. 10th June to 10th July, 1 month. So, 10th July, August, 10th September, 10th October. So, how many months? 4 months. 4 months. You'll find 4 months and you'll have 21 days. 4 months, 21 days. Now, this 4 months, 21 days will be treated as, whether it is 4 months, 2 days or 4 months, 21 days, it will be treated as 5 months. Don't think that it is going by round off. Whether it is 4 months, 2 days or 4 months, 20 days or 4 months, 29 days, it will be treated as 5 months. Now, what are the balance months? In GST, capital goods life is taken as 5 years. And that is the reason you subtract 5% per quarter of part thereof. So, if for 1 quarter you are subtracting 5%, for 1 year it will be 20. For 5 years it will be 100. So, 5 years. Even here, months basis. So, 5 years will have how many months? 60 months. So, what will be the reversal? 1 lakh multiplied by balance months. What is the balance months? 60 minus 5. What is the total number of months? 60. So what will be the answer? 91, rounding up to nearest rupee 1. So for capital goods, availment you have subtraction method where you go with calendar quarters. For reversal you have multiplication method where you go with normal months. And multiplication is 1 lakh multiplied by balance months. Balance months ignoring part of, which means if it is 4 months, 2 days, completed period, you have to take it as 5 months. So balance months will be 55 months divided by 60 months. That is how you are going to do the calculation. Are you guys clear with this understanding? For availment, it is a different calculation for capital goods. For reversal, it is a different calculation for capital goods. And the last point. When you talk about registration, there was one special point for registration, if you recollect, which was not applicable for your composition scheme to regular scheme or your exempt supply to taxable supply. When it is all about registration, you can take credit only of inputs, not of capital goods. But if it is cancellation of registration, you have to reverse both on inputs and capital goods. For cancellation of registration, there is one more special point, which is not there for the other two cases, regular to composition scheme, taxable supply to exempt supply. When you're taking new registration, there is one special point. You cannot take the credit of stock of capital goods. When it is cancellation of registration, you have to reverse on stock both of inputs and capital goods. That's a normal point for other two cases also. One special point here. When you're doing that reversal, you have to do that reversal based on the calculation that we have discussed. For inputs, it is very normal calculation. See the number of units of inputs and do the workings. For capital goods, multiplication method. For capital goods, multiplication method. Compare it with output tax payable. You have to calculate output tax on the stock of inputs and capital goods, whichever is higher. Simple reason. It is deemed supply. It is deemed supply. If you recall, when we have discussed your levy chapter, VJ registered is different from VJ unregistered. When I am cancelling my registration, it is as good as I am supplying goods to myself. VJ registered is supplying goods to VJ unregistered. When it is deemed supply, you have to calculate output tax. So here you will be having one part, your ITC calculation. For inputs, just do one-to-one linking and calculate input tax credit on the stock of inputs. For capital goods, multiplication method. Compare that with output tax payable. Surely that answer will be different. Why? Your output tax payable will be based on what? Open market value multiplied by the rate on those items. It has got nothing to do with ITC. Nothing to do with ITC. Whichever is higher because of deemed supply. Because of this will not be there for regular scheme to composition scheme, taxable supply to exempt supply. It is only there for cancellation of registration. So when you talk about your regular scheme to composition scheme, taxable supply to exempt supply, a very normal working is that, nothing special. Only when you're talking about cancellation of registration, you will find something special. Output tax. This portion is same. You'll find something special. ITC calculation as in section 18, compare with output tax payable, whichever is higher. Whichever is higher. That's all about your section 18. The two parts, one about availment, one about reversal in certain cases of conversions. Now, the other two areas which are left out. The first part of section 18 we are done with. The other two areas which are left out. The main area which ICA focuses a lot of times, which is sale of capital goods. Section 80 read along with rule 40. Sale of capital goods or plant and machinery on which ITC is availed. When you are selling your capital goods, it is nothing but supply, outward supply. So when you are going to calculate the payment, it is tax on transaction value, which is nothing but selling price multiplied by the percentage, or depreciated ITC, which is nothing but ITC minus ITC multiplied by 5% number of quarters. Subtraction method, whichever is higher. You have to go with whichever is higher. On one side, you take the selling price. You have sold the capital goods, it is like normal sale, take your selling price multiplied by the GST rate. On the other side, on those capital goods, you would have availed ITC. Take the ITC, subtract it by ITC multiplied by 5% per quarter or part thereof. This calculation of per quarter or part thereof will start from where? This calculation of per quarter or part of quarter will start from where? From the date of purchase of capital goods till the date of sale of capital goods. The focus is on normal quarters or calendar quarters. In GST, always quarter represents, compare whichever is higher, pay that amount. Pay that amount. Clear? That is for your sale of capital goods. A very important and repeatedly asked question. So you'll be having two answers. First part, selling price by multiplied by the rate. Second part, ITC subtracted by 5% for every quarter. But there are special cases where you will not go with depreciated ITC. When? If the capital goods happens to be refractory bricks, molds, dies, jigs and fixtures. These capital goods are normal use in job working sector and you cannot identify after some time. You cannot identify them. Therefore, when identification is difficult, calculation of when it was purchased and when it is sold is not possible. So when you talk about refractory bricks, molds, dies, jigs and fixtures which are very normal use in job working, when they are sold as scrap, what to do? Special capital goods, when they are sold as scrap, what to do? Forget about depreciated ITC. Very normal calculation. What is a very normal calculation? Tax on transaction value. What is the tax on transaction value? Selling price multiplied by the rate. There is no second calculation. That is directly selling price multiplied by the rate. For which case? Which all cases? Refractory bricks, molds and dies, jigs and fixtures, where identification of that particular item is not possible when they are sold as scrap. When they are sold as scrap, you cannot identify. When they are sold as such, if at all these items are sold as such, I purchased them after 2-3 months, I sold as such, then what calculation will come? Tax on transaction value or depreciated ITC, whichever is higher, because now I can identify them. When they are sold as scrap, I cannot identify them. Therefore, selling price multiplied by percentage, that is nothing but tax on transaction value. That's all. That is the calculation as per section 18 read along with rule 40 when there is sale of capital goods. And finally, you're talking about your transfer of ITC. Transfer of ITC. In total, there are 4 cases. How to understand these? 4 cases. When there is sale of business, sale or transfer of business. Second, there is amalgamation or merger. Third, there is demerger. Then there's one more case that will happen. If at all you're talking about sale of business, VJ Limited is selling the business to PJ Limited. If at all there is any credit that is there lying in the electronic credit ledger of VJ Limited, supposing the credit lying is 10 lakhs. Can VJ Limited take the credit, refund of credit? No. Refund of credit is not possible except in 2 cases. Zero rated supply and inverted duty structure. What is the only possibility? Transfer that credit to PJ Limited. You can transfer that amount of credit to PJ Limited, the transferee. But that is the condition. What is the condition? Condition is PJ Limited should be taking all the liabilities of VJ Limited. Transfer of liabilities. What if there is amalgamation? The same concept. PJ Limited and PJ Limited, assuming it gets amalgamated into VP Limited. Now, in case of amalgamation and merger, what will happen? Assume that the amount of credit and electronic credit ledger of VJ Limited is 1 lakh and in electronic credit of ledger of PJ Limited is 5 lakhs. What will happen? This 1 lakh as well as 5 lakhs can go to VP Limited and it can get the credit ledger as 6 lakhs. Normal addition, but the condition remains the same. Both VJ Limited and PJ Limited should transfer the liability to VP Limited. Transfer the liability to VP Limited. Now what happens in case of demerger? Something different when you talk about your demerger. What is that something different when you talk about your demerger? Calculation part. Supposing VP Limited demerges or splits into VJ Limited and PJ Limited. And if there is a credit ledger balance in VP Limited, say 20 lakhs. Can it be given to VJ Limited and PJ Limited? Yes. It can be given to VJ Limited and PJ Limited. The condition remains the same. Condition is VP Limited should transfer the liability both to VJ Limited and PJ Limited jointly and severally. Transfer of liability. But now how will the calculation will be done? The calculation will be done on the basis of some ratio. What is that ratio? 20 lakhs multiplied by something divided by something. 20 lakhs multiplied by something divided by something. That ratio is that of value of assets. Value of assets. If the value of assets of VP Limited is 10 crores and the assets are given in the ratio of 6 crores and 4 crores, VJ Limited will get 6 by 10, PJ Limited 4 by 10. So 12 lakhs and 8 lakhs. The calculation is based on what? The calculation is based on what? The calculation is based on value of assets. Value of, and there is a clarification given. When you talk about value of assets, when you talk about your value of assets, it is not only those assets on which ITC is taken. Value of assets means all the assets, whether or not ITC has been availed. So question may try to confuse you. Out of 10 crores, only on 8 crores ITC is availed, and those 8 crores has been split into VJ Limited and PJ Limited equally into 4 crores and 4 crores. Whether you will go with 6:4 ratio or 4:4, you will still go with 6:4. Value of assets means all assets. Don't see the assets on which ITC was availed. Don't specifically see the assets on which ITC was availed. Are you guys clear with this understanding? Are we guys clear with this understanding? Right. Now, when you talk about the last case is similar to demerger. You are going for multiple registration, which is an option to you. It is similar to demerger. Now, what is happening? There's only one company, say VJ Limited. Initially, it was having only one GST number. It decided to go for multiple GST number. GST number 1, GST number 2, GST number 3. So, from one GST number, it is deciding to go for multiple GST number. One is same, other two GST number. The first GST number remains the same. It has taken other two GST number. There is an option for you to take multiple GST number if you are having multiple places of business within the same state. This is happening in the same state. If you are working in different states, obviously you have to go for multiple registration. You are working in same state. Initially you had one registration. Now you are deciding to go for multiple. Don't you think that it is just like demerger? Just like demerger. If the electronic credit ledger balance is 10 lakhs with GST number 1, how can it distribute? Well, let us try to understand the difference first. First, there is no such condition of transfer of liabilities because VJ Limited remains VJ Limited. Though it is going for multiple GST number, The person remains same. So obviously liability will be there of VJ Limited. There's no point of discussing that. That should be transfer of liability. Second difference. In all the other cases, there was a requirement of CA, CWA certificate. In all the other cases. In addition to transfer of liability, there was a requirement of CA, CWA certificate, irrespective of the value. Not 2 lakhs and all. CA, CMA certificate. Right. Cost management accountant or cost works accountant. CA, CMA certificate. Irrespective of the value, there was a requirement of CA, CMA certificate. Here, there's no such requirement. There's no such requirement. You don't have to go for CA, CMA certificate. Sir, whether the CA, CMA certificate is required, only if the value is more than 2 lakhs or all cases? All cases. Sale of business, amalgamation, merger, demerger, you have to go with, along with that particular form, you have to go with, irrespective of the value. But now there's no requirement of CA, CMA certificate. So you will find two clear-cut differences. One, no condition of transfer of liability. Second, no CA, CWA certificate because it remains the same. It is within the same company's different GST number. Third, now calculation is a bit different. How? You have multiple options. Either to give this entire GST, keep it with registration 1 itself, or give it entirely to 2, or give it entirely to 3, or give it to 1 and 2, or give it to 1 and 3, or give it to 2 and 3, or split between 1, 2 and 3. Either to have itself, or give it to GST number 2, or give it to GST number 3, or give it to GST number 1 and 2, give it to GST number 2 and 3, give it to GST number 1 and 3, or split between 1, 2 and 3. That option is you are having, which was not there in demerger. In demerger, you have to give to all. Here, either have it with yourself or give entirely to second GST number, entirely to third GST number, or give it to 1 and 2, or 1 and 3, or 2 and 3, or 1, 2 and 3. Whenever you are giving to multiple GST number, you have to go with the ratio of value of assets. On not ad hoc basis. At all you are deciding to give to 1 and 2, go with the value of assets split between 1 and 2. 1 and 3, go with the value of assets split between 1 and 3. 2 and 3, go with the value of assets split between 2 and 3. 1, 2 and 3, go with the value of assets split between 1, 2 and 3. So there you have to go with the calculation. So clearly you find 3 differences. Clear cut, you find 3 differences. First, no such condition. Second, no CACW certificate. Third, you are having multiple ways of distributing. Multiple ways of distributing, which was not there in demerger. Which was not there in demerger. Are you guys clear with this understanding? Are you guys clear with this understanding? Right. Also understand that in demerger there's a lengthy circular running to 5-6 pages. The concept is pretty simple. When you talk about the ratio, ratio is based on the demerger date. When you talk about the ratio, we are talking about your demerger. When you talk about the ratio of value of assets is based on the date of demerger. But what amount of ITC is distributed is based on date of transfer of ITC. Demerger may have happened on 1st of April, but you are transferring the credit on 1st of December. So the ratio is based on the date when demerger happened. You see the value of assets. But ITC, which is going to be distributed, you will be taking what? You will be taking the ITC that is available when it is transferred. See, as on the date of transfer, if there is no ITC, there is no question of any distribution. It cannot be ITC which was available at the time of demerger. It is ITC which is available when you are actually transferring it. Why? What is the formula that you require? ITC multiplied by the ratio. So ITC is as on the date of transfer and ratio is as on the date of demerger and earlier date. And when you go with this demerger, the third special point, when you go with this demerger, when you split the ratio, You split the ratio in totality. You don't split it CGST, SGST, IGST wise. In total, I have to give VJ Limited, say in our example, 6 lakhs and no, I'll take that example itself. 12 lakhs and 12 lakhs and 8 lakhs. I have to give 12 lakhs to VJ Limited, 8 lakhs to PJ Limited. But my ITC will be IGST, ITC, CGST, IGST and SGST, ITC. Out of that total ITC, if I add all the three, it was 20 lakhs, which I have decided to give 12 lakhs to VJ Limited and 8 lakhs to PJ Limited. Assume that ITC in total, ICNS was, total amount was 20 lakhs. So we'll take 10 lakhs, 5 lakhs and 5 lakhs. This was available with VP Limited. Now how much I have to give to VJ Limited? How much I have to give to PJ Limited? Right, what was the ITC available? I have to give PJ Limited 12 lakhs. I have to give PJ Limited. I need not give the same ratio all. In totality, I have to give 12 lakhs to VJ Limited. I may decide one option. I mean, if you talk about the total number of permutation combination for this answers, it will run in lakhs. Right? If you understand a bit of permutation combination, you'll have, I mean, answers in lakhs, different types of answers. Why? It is only not between two companies, it is also between C, S and I, and numbers will keep on varying. So one such possibility, I split that 10 lakhs, VJ Limited will take 10 lakhs IGST and 2 lakhs CGST, totally 12 lakhs, and PJ Limited will take 3 lakhs CGST and 5 lakhs SGST. That they can decide. Or multiple answers. PJ Limited will tell that no, I want the best ITC is IGST. I want 10 lakhs IGST ITC and I'll take 2 lakhs SGST ITC. It can be so many permutation combinations of answers. In toto, it is 12 and 8. In the heads, they can decide. In the heads, they can decide. You're getting that? In toto, it is 12 and 8. It is not always strictly in the ratio of 6:4. It is not always 6 lakhs, 4 lakhs, 3 lakhs, 2 lakhs, 3 lakhs, 2 lakhs. No. In totality, it is 12 lakhs and 8 lakhs. In the heads, you can decide among yourself. And the last special point of the circular. If at all this demerger is happening in multiple states, all these ratios will be applied state-wise. All these ratios will be applied. All these ratios and ITC will be going state-wise. The circular runs into 5-6 pages, but the summary of the circular is very simple. The demerger is happening. How to see? The calculation is ITC multiplied by the ratio. ITC is as on the date of transfer of ITC, ratio is as on the date of demerger. If it is happening in multiple states, if the company is having presence in multiple states, then automatically demerger happens in multiple states. So the ratio as well as ITC will be seen state-wise, not pan-India wise. If you see pan-India wise, you will get one answer. And if you see state-wise, you will get a totally different answer. So you have to go with state-wise. A very simple reason. Registration is state-wise. So this distribution will also be state-wise. Therefore, the calculation should be always obviously state-wise. And finally, when you divide in state-wise based on the ratio on the date of demerger, ITC on the date of transfer, final answer that you get between the demerged companies, that is the final answer in totality. In the heads of IGST, CGST, SGST, they can decide themselves. Both the demerged companies can decide, both the final companies which is coming out of demerger can decide among themselves. They can decide, okay, 12 lakhs and 8 lakhs. We have to take in totality. How to distribute IGST, CGST, SGST, they can decide among themselves. So that is the entire circular which is talking. This question, the 4 special points that I asked, believe me, it is a question worth 8 marks. Again, believe me, IC has never asked it. But if at all it is asking, it is worth 8 marks. And if you have not seen the circular, if you have not seen these 4 special points, you will not be in a position to crack it. But if you have seen once, only once, will be easily cracked. It is simple mathematical calculation. All are very logical. Demerger is ratios as on the date of demerger. ITCs should be as on the date of transfer, because if I don't have any ITC on that date, it really doesn't make sense. And calculation is state-wise, because registration is also state-wise. But this last question point, only if we specifically address, that will make sense. In totality, it should be split. In the heads, they can decide among themselves. So that is all about your section 18 special cases. Starting with your registration, let us try to understand first the basics of your registration. Quickly go through your basics of registration. GST registration is PAN based. It is based on your PAN number. You cannot have your GST number without PAN. If you want GST number, you should have a PAN. And the format of your GST number would be 15-digit number, which is first 2 will be your state code. Next 10, which is 3 to 12, will be your PAN. Then 13th will be entity number in that state, which means if you are registered in 2 states, 2 GST number, 13th number will be 1 in both the states. This will be increasing to 2, 3 only if you are having multiple registration in the same state. Only if you are having multiple registration in the, otherwise 13th number will be 1. And when you talk about 14th, as of now, the default alphabet is Z as of now. And 15th will be a random checksum digit. A random number generated by the system. So this is a 15-digit GST number, and it is very evident that without your PAN you cannot have GST number. But are there exceptions? Yes. When you talk about your GST TDS number, it is based on your income tax TAN and not on your income tax PAN. So your GST TDS TCS number is based on your income tax TAN. So TDS number, TCS number is based on your income tax PAN and not based on your income tax TAN and not based on your income tax PAN. Second, you're talking about you'll be having GST number based on PAN of another person. There is a special person called as NRTP, non-resident taxable person. They will have their registration based on PAN of another person. Here it is based on PAN, but not your own PAN. PAN of another person. Who is that another person? Your authorized representative, who should be Indian resident and a valid PAN card holder. Indian resident and a valid PAN card holder. So first exception is for your TDS number. First exception happens to be for your GST TDS number. Second exception happens to be with your NRTP registration, where it is based on PAN but of authorized representative, who should be a Indian resident and a valid PAN card holder. Third, this third and fourth will come always. When you talk about your unique identification number and OIDRS supplier who is outside India. Right, when you talk about UIN, unique identification number, certain UIN will be there without your PAN number. It has got nothing to do with your PAN number. Right, when you're talking about international bodies, they'll have their UIN number without PAN. Obviously, certain Indian bodies will also have UIN. There it will be based on PAN. But international bodies, they'll have their UIN without linking to income tax PAN. They'll not have any even PAN. And one, when you're talking about a supplier of OIDRS services from outside India, where he has to pay GST for the supply made to non-taxable online recipient in India, they will take the GST number but without any PAN. So first two cases, TDS TCS number, GST TDS TCS number is based on income tax TAN. NRTP based on PAN but of another person. UIN, international bodies, no need of PAN. OIDRS, supplier outside India, no need of PAN. Now, second concept, your GST number will be linked to Aadhaar. Your GST number will be linked to Aadhaar. No GST number without linking to Aadhaar. Without linking to Aadhaar. Authentication means linking to Aadhaar. Your GST number should be linked to Aadhaar. So when you talk about GST number linking to Aadhaar, it is a bit different like PAN. Without PAN, you cannot have GST number. But without linking to Aadhaar, still you can have GST number. So if at all you decide not to link your Aadhaar, see, first is there is an exempted category where there is no need of linkage. Just like the exempted category of a PAN. There is an exempted category where there is absolutely no need of any linkage. So when you talk about non-citizens of India, foreigner, which will even include OIDRS, and obviously UIN. See, OIDRS and UIN will always come in special. They don't need PAN, they don't need linking to Aadhaar. Now, what are the other categories who are exempted? Government exempts themselves. Department or establishment of central government, state government, local authority, statutory body and public sector undertaking. So, government is excluding itself from linking to Aadhaar. Right. So, you are talking about whom all being exempted? Non-citizens including OIDRS, UIN. Then the next category is government, that is central government, state government, local authority, public sector undertaking and statutory body. Now you may wonder that when you are not an individual, how can you have an Aadhaar? So for that you need to understand the concept of Aadhaar linking. If at all you are talking about a proprietorship concern, sole proprietor, what can be the categories? Sole proprietor, HUF, firm or LLP, body corporate, AOP, AOPBY and trust. For sole proprietorship concern, who has to link the Aadhaar? Proprietor. HUF, Karta. Firm or LLP, partners or designated partners. Body corporate, director. AOP, you are talking about members of managing committee of AOP. Trust, board of trustees. Anyone. Apart from that, if you have someone else appointed as authorized representative, then he also has to get his Aadhaar linked. If one of the partner himself is authorized representative, then no need to worry. One Aadhaar linking is sufficient. But if you have a director and you have someone else as authorized representative, or it can be even for a proprietorship concern. You are a proprietor, there are a lot of proprietorship concern across India where they are big shots. They will not like to get one-time password and all in their mobile number. So what they'll do, they'll appoint someone else as authorized representative. So whose Aadhaar will be linked? That proprietors or that the partners or the directors, etc., along with authorized representatives Aadhaar number. So there are two stages. So we are talking about linking. Now who are all exempted? Non-citizens, UIN, government category. That is central government, state government, local authority, statutory body and public sector undertaking. But what is the difference between PAN and Aadhaar that we are trying to understand? Then when you talk about PAN, without PAN you cannot have GST number. Forget about the exceptions. There are exceptions. But if you forget about the exceptions, without PAN you cannot get your GST number. Whereas when you talk about your Aadhaar, there are certain notified persons who are exempted from getting Aadhaar linking. But what about others? Assume that you are not covered in the category. See, that category will cover only few of them. Most of them are not covered in that exempted category. What about you? You can still get your GST number without linking your Aadhaar. All you need to do is tell that I am not interested in linking my GST number with Aadhaar. I am ready to go for physical verification of premises, and that physical verification of premises will be done before grant of GST number. So registration will be given only after doing physical verification. So physical verification will be followed by giving the registration. So you should be ready. I don't want to link my Aadhaar. I don't want to reveal my private and confidential information. Don't worry. You don't link with your Aadhaar. What you can do? You can tell that I am ready for physical verification of premises. Officers will come for physical verification of premises. They will verify all the details, documents along with the premises, and they'll give you the GST number without linking the Aadhaar. So that is possible. That is possible in Aadhaar. That is possible in Aadhaar. Right? Can you get your GST number without linking the Aadhaar? Yes. What do you have to do? You have to opt for physical verification of premises, where they will do physical verification of premises, and after that only your registration will be granted. But even after getting your registration, at times government is very much interested in your Aadhaar authentication. So at times government tells that we are very much interested in your Aadhaar authentication or Aadhaar linking. You have got your registration number. You have got your registration number. But at times government will tell that normally government cannot force you for linking your Aadhaar. That's the concept. Supreme Court has said a lot of times that it cannot be a mandate that you have to link your Aadhaar. But government indirectly tells that okay, you have got your registration number without linking the Aadhaar. But if you are coming for refund application, normal refund under Rule 89, special automated refund under Rule 96, or if you are making revocation application under Section 30, RRR, revocation of cancellation, refund normal Rule 89, refund automated special Rule 96, then mandatorily you have to link your Aadhaar before coming for them. Mandatorily you have to link your Aadhaar before coming for any of them. But suddenly they tell that, a person may tell that, see, I want to go for revocation or normal refund 89 or special automated refund Rule 96. But I don't even have Aadhaar. For me to link my Aadhaar with GST number, first I should have Aadhaar. Supposing there is a person who wants to apply for revocation of cancellation. Government tells that you should link your Aadhaar, only then you can apply for revocation of cancellation. That person tells that I don't even have Aadhaar. And there is a time limit within which I have to apply for revocation of application, 30 days plus 30 days plus 30 days after cancellation. What to do? What to do? They will tell that okay, don't worry, as you don't have Aadhaar, do one thing. Go and apply for Aadhaar. Go and apply for Aadhaar. Give us the proof of Aadhaar enrollment ID slip along with one photocopy proof, either of your bank passbook with photograph, voter ID, which will obviously with photograph, passport or driving license. Give these two details before you come for RRR. Before you come for RRR. Give the proof that you have taken action to get your Aadhaar number. After you get your Aadhaar number, the moment you get your Aadhaar number, make sure that within 30 days of getting Aadhaar number, link your Aadhaar. Link your Aadhaar. This is after applying for RRR. Two conditions are there before you apply RRR. You are telling that you are not in a position to link your Aadhaar because you don't have Aadhaar. Go and apply for Aadhaar. Give us the proof of Aadhaar enrollment ID slip along with one of your photocopy proof. Be it your bank passbook with photograph or voter ID or passport or your driving license. Do it before you apply for RRR. And after you apply for RRR, you will be getting your Aadhaar number very soon. The moment you get your Aadhaar number, it may take 10 days, 20 days, 1 month, 45 days, 60 days, whatever. The moment you get your Aadhaar number, from that time, within 30 days, come and link your Aadhaar number with your GST number. So this requirement is only for RRR. Otherwise, should you worry about linking your Aadhaar? No. You need not worry. And by the way, that RRR concept comes only after taking registration. You need not even worry about linking your Aadhaar. If you want to apply for GST number without linking your Aadhaar, can you do it? Yes. Can you continue with your GST number without linking your Aadhaar? Yes. When it becomes important, RR and R, revocation, refund, Rule 89, refund, Rule 96. Only in those cases, it becomes mandatory for you to link your Aadhaar. Now, the next concept, your GST number is state based. It is PAN based, it is Aadhaar based, it is state based. Now, for your state-based registration, please understand that there are two exceptions. Normally, if I tell that if you're working in 5 states, how many registration? 5 registration. 10 states, how many registration? But there are two types of exception. The first type of exception is you may work in multiple states, but pan India you are required to get only one GST number. Who are they, by the way? We have been discussing this repeatedly. Who are they? Who are they? They are OIDRS from outside India and certain UINs. Who are these certain UINs? International bodies having UIN. They will have one GST number or one UIN number across India. Across India. Normally the concept is one state, one registration. One state, one registration. But for this OIDRS from outside India, not a supplier in India. We are not talking about a supplier in India. If he is a supplier in India, one state, one registration. For this OIDRS supplier outside India, pan India, one registration. For certain international bodies who are having UIN, pan India, one UIN. Pan India, one UIN. This is the first type of exception. That is the second type of exception for this. What is the second type of exception? Within the state, you can get multiple registration. See, one type of exception is full India, one registration. Second type of exception is within the state, multiple registration. Can you go for within the state, multiple registration? Yes. Now, within the state, multiple registration has got two concepts. One is mandatory multiple registration within the same state. Mandatory multiple registration within the same state when you deal with special economic zone. When you deal with special economic zone, if in Tamil Nadu you have 10 branches, 8 in DTA, domestic tariff area is normal India other than SEZ, and 2 in SEZ. How many registration you have to take? 2, not 3. For all 8 domestic tariff area, 1 GST number. For both the SEZ, 1 GST number. Mandatory. Do you have an option? Do you have an option? No. You have to go for 2 GST number within Tamil Nadu. Within Tamil Nadu. And any supply between them will be treated as deemed supply and tax will be IGST, because if it is DTA to SEZ, SEZ to DTA, it is IGST. It is IGST. Now, for the same example, what is the maximum registration that I can take? 10. Maximum registration that I can take is 10. How? How many branches I have? 10. For each of them, I can take separate registration. Is this mandatory multiple registration or optional multiple registration? Optional multiple registration for each of the branch. For each of the branch. So if you look at this example where VJPJ Limited is working in Maharashtra and Delhi. In Maharashtra, it is having 4 branches in domestic tariff area, 2 branches in special economic zone. In Delhi, it is having 5 branches in domestic tariff area and 2 branches in special economic zone. What is the minimum registration that I have to take in Maharashtra and in Delhi? Maharashtra and Delhi, I cannot merge. For surely, I have to take separate registration. In Maharashtra, how many registration? In Maharashtra, how many registration? Minimum 2. 1 for 4 branches of domestic tariff area and 1 for 2 branches of SEZ. In Delhi, 2. 1 for 5 branches of domestic tariff area and 1 for 2 branches of special economic zone. Now, how many maximum registration I can take in Maharashtra? Total branches is 6. How many maximum registration I can take in Delhi? Total branches are 7. The first was a case of mandatory multiple registration. Thereafter, whatever you are taking is optional multiple registration for each of your place of business. For each of your place of business. Optional multiple registration. That is optional, not mandatory. It is optional. The moment you take multiple registration, they will be treated as distinct person. Any movement between them will be treated as deemed supply. Will be treated as deemed supply. You have to remember that. The moment you take multiple registration, they will be treated as distinct person. Any movement between them will be treated as deemed supply in terms of your schedule 1 para 2. Will be treated as deemed supply in terms of your schedule 1 para 2. That also you need to remember. So this is all about your basics of GST number. Adding to it, we have already discussed that there are 3 types of registration can be categorized into 3 types. One is normal GST number, taxpayer. One is tax distributor, that is your ISD, and one is tax deductor or collector, TDS, TCS. What do you think? Just think of the situation. Amazon, how many GST number it will have? One normal GST number for its own supplies, one GST TCS number for supply by others through Amazon. For its commission, it will have normal GST number. For supply by others through Eco, it will have GST TCS number. Assume if Amazon is also selling to government. No, TDS will be by government. TDS will be by when you can have all of them. When you can have all of them. Government. How? Take an extreme example. Government is having its online platform. Government is having its online platform. Government will have normal GST number for its supply. It may be supply of goods or supply of services commission. Government will have TDS number for its receipt, not for its supply, for receiving the goods. Supplier to government. So government will be acting as recipient, GST TDS number. Government will have GST TCS number for the supplies made through government's website or government app. Don't worry, government will have one more thing. Government may have ISD number. Because if it is having multiple GST, not multiple GST number in this way, multiple normal GST number. Multiple normal GST number. It may also have ISD. It may also have ISD. Amazon clearly has got three GST number. One, normal GST number in multiple states. One, GST TCS. One, ISD. One, ISD. Clear? So these are all the types of registration that you can have. Now, if at all you are taking the registration in the state of Maharashtra, should you register separately for CGST, separately for Maharashtra SGST, or separately for IGST, or one registration will be sufficient for Maharashtra SGST, CGST, IGST and compensation cess? What is the concept? One registration is sufficient. Your GST number is not based on tax. If I am registering in Maharashtra, my registration is for paying all the taxes in Maharashtra, be it CGST, be it Maharashtra SGST, be it IGST, be it compensation cess. So GST number is not tax based. GST number is not tax based. So that is all about your basic principles or basic concepts of your GST number. When you talk about registration chapter, it can be divided into four parts. Basic concept of GST registration, which we have discussed. Taking GST number, amending GST number and cancellation of GST number. Now, when you talk about application for GST number, why will assessee go for GST number? Application can be by assessee or it can be suo motu given by the department. Why will assessee go for GST number? Assessee will go for GST number because he is liable for registration or he is taking voluntary registration. Either he is liable for registration under section 22, turnover based registration, section 24, compulsory registration, or he is going for voluntary registration. He is going for voluntary registration. Two doors are there. You are liable because of that you are going. You are not liable, but still you are going for voluntary registration. Why will department give suo motu registration to the assessee? Fraud category. Assessee is liable for registration, but he is not applying for registration. Assessee is liable for registration, but he is not applying for registration. What will department do? Give suo motu registration. Give suo motu registration. Now, the second stage is amendment. Once you are registered, there will be amendment of registration. Amendment can be done only and only by assessee. One is core field amendment and one is non-core field amendment. One is non-core field amendment, not the main amendment. Core field amendment. Amendment cannot be done by department. Either it is core field or non-core field. Both are done by the assessee. Core field amendment includes main changes. Your main changes. What can be your main changes? Your main changes can include changing the legal name of the company, which means changing the name which is there on your PAN card, not your trade name. Changing the legal name of your company. Change in the place of business. adding additional place of business, removing additional place of business, changing the principal place of business. Change in the person. Change in the person. Adding partners, removing partners, adding directors, removing directors, changing the karta, adding authorized representative, removing authorized representative. That all comes in person. Legal name, place, person. Legal name, place, person. Non-core field amendment example is changing your trade name. You can have any of your trade name. You can keep any trade name for yours. Obviously, when you are trying to get it registered in terms of trademark registration, you have to take care of other things. But otherwise, you can have any trade name. Change in the trade name, or you are talking about change in your mail ID and mobile number. Even to the extent of changing the bank account is also non-core field, which should technically not be non-core field. It should be technically core field, but as of now, it is also non-core field. These are all examples of core field amendments and non-core field amendments, and both are done by assessee. And finally, you are talking about the last stage, which is cancellation. Now, cancellation, first category, which can be done both by assessee as well as department. Both can do it in 4 cases. Second category, where only department can do suo motu cancellation. Where assessee can do cancellation as well as department can do cancellation. There are in total 4 cases. What are the 4 cases? First scenario, where assessee has stopped the business. Assessee has stopped the business. Second scenario, assessee has sold the business, including death of a proprietor where the business is taken over by the legal heir. Sold the business. Stopped, sold. Stopped and sold. Third is a scenario where there is change in constitution of business with change in PAN. If PAN number is the same, no need for coming for cancellation. Go for amendment. Change in constitution with change in PAN. What about change in constitution without change in PAN? Go for amendment. Go for, if PAN changes, the old firm has to go for cancellation and the new firm has to go for new registration. But if PAN remains the same and only constitution is changing, few people are coming inside and few people are going outside, don't worry, go for amendment. And next, you are talking about a taxable person is no longer liable for registration. By the way, why you go for registration by default? Because you are liable for registration. Now you are no longer liable for registration. Have you stopped your business? No. Have you sold your business? No. Is there any change in constitution with change of PAN? No. You are still continuing your business, but your turnover has come down. You are no longer liable for registration under section 22 or 24. Therefore, you are cancelling your registration. Here, one funny point is also mentioned. You might have taken voluntary registration. See the entry doors. There are 2 entry doors. You are liable, you took. You are not liable, you voluntarily took. Now you voluntarily took. You are never ever liable for registration, but you voluntarily took the registration. Can you apply for cancellation? Yes. You can apply for cancellation. Here you cannot talk about liability. There was no liability for you to get registered. You got registered. Can you exit the doors? Yes. You came inside, though it was not required. You can go outside because it is not required. These are the 4 cases where both assessee and department can start. Now, what are the 10 cases where only department can start cancellation? Where only department can start cancellation. You are doing your business from a place which is not declared. From declared place of business, you are not doing any business. From a place which is not declared, a secret place, you are trying to do business. Fraud. Second, mega fraud, bada fraud, very big fraud. Fraud, cheating the government. You are giving invoice without supply, fake invoice, bill trading. You are giving invoice without supply. Third, you have obtained registration itself by way of fraud, willful misstatement or suppression of acts. The details of the documents that you have given are incorrect. Fraud, misrepresentation or willful misstatement of facts. It will be cancelled. Or you are violating Rule 10A. What is Rule 10A? Rule 10A tells that when you get your GST number, you might not have your bank account. So GST department tells that don't worry, you get your GST number without giving a bank account details. See, one of the mandatory details while getting a GST number is bank account. But now you are getting a GST number without bank account, because GST department tells that you get your GST number, go to a bank, open the current account, come back and give to us, come back and update us with your bank account within 45 days of grant of registration, within 45 days of getting your GST number or due date of your first return, whichever is earlier. This is the deadline given to you. You are getting GST number without giving your bank account details. Get your GST number, go to bank, open the bank account, come to us, update the bank account. Within how much time? 45 days from the date when you get your GST number. Grant of registration means get your GST. It may be applicable retrospectively, but when you get your GST number in your hand, grant of registration or due date of your first, you will be filing first return, which will be for a group of months together. Supposing you are liable in June, you are getting registration in August. So you will be filing the return of August, including the transaction of June, July and August. In 1 month, you will be including 3 months transaction. Due date of that is 20th of September. So before that, 20th of September. 45 days from the date you get your RC, due date of your first return, whichever is earlier. See that date, update the bank account within that date. If not, your registration will be cancelled. You violate section 171, anti-profiteering clause. Not so relevant now, it was relevant when the GST was introduced. With GST, you get more credit, so your cost reduces. But you are not reducing your selling price, which means you are trying to get more profit. You are trying to get more profit. Anti-profiteering clause. Not so relevant today. Was very much relevant at the time when GST was born. You are trying to get extra profit. How? With GST, you will get more credit. More credit means less cost. Less cost means you should reduce your selling price, but you are keeping the selling price same, which means you'll have a extra profit. You'll have a, government tells that we will cancel your GST. Is it relevant today much? No. No, it's gone. It was relevant when GST was born in 2017. Not relevant much today. You are violating the provisions of Rule 86. There's a Rule 86 which tells that if your taxable supply excluding exempt supply and zero rated supply in a particular month exceeds 50 lakhs, minimum 1% you have to pay by cash. Minimum 1% you have to pay by cash. If I tell that your output tax is 100 and input tax is 110, what is the amount that you will normally pay by cash? You will pay nothing by way of cash, rather ITC carry forward will be 10. But if you are covered by 86B, now I am explaining 86B also. What is 86B? When it is applicable? When it is applicable? It is applicable in a scenario where your sales, taxable sales, where your outward supply of taxable supply, do not count exempt supply, do not count zero rated supply, because anyways tax will be zero. Don't count exempt supply, don't count zero rated supply, don't count your exports, don't count your supply to SEZ, don't count your supplies which are exempt. Only taxable supplies you count. If it is more than 50 lakhs, it will be applicable. It will be applicable. When it is applicable, what will happen? Here we have assumed that 86B is not applicable. If 86B is applicable, your output tax is 100, your input tax credit is 110, but how much you can use? They tell that minimum 1% we want in cash. So minimum 1% of what? 1% of all your output tax. They want in tax. So they tell that you cannot use your 100. Here how much credit you have used? 100 in the previous case. Here how much credit you can use? You have to reverse work. First you have to find what amount you have to pay in cash. Then you have to decide, okay, I have to pay minimum 1 rupee by way of cash. So how much credit I would have used? Only 99. So what is the ITC carry forward? ITC carry forward. It will not be 10, it will be 11. You are not having any loss per se. You are paying something by cash, simultaneously your credit increases. Your credit Government wants at least something in cash. At least something in cash. You are not following 86B. You are not following 86B that we have discussed. What is 86B? It is telling that at least 1% of your output tax paid by cash. Paid by when it is applicable? Your taxable supply other than exempt supply, zero rate supply exceeds 50 lakhs. When you are applying 86B, you will not include RCM because RCM anyways will pay by cash. So don't include RCM. RCM always you pay by cash. You see only your net output tax. You see only your net output tax. It should be minimum 1%. It is not applicable in certain cases. Let us even discuss and complete that. It is not applicable in certain cases. What are the cases where it is not applicable? It is not applicable for government, Department of Central Government, State Government, Local Authority, Public Sector Undertaking and Statutory Body. First, government removes itself from this applicability. Then it is not applicable for a case where you are going for refund of your GST input tax credit. Refund of your GST input tax credit. More than 1 lakh. More than 1 lakh. Your refund of ITC in GST is more than 1 lakh in last year. First is government sector. Second is your refund of GST ITC is more than 1 lakh in previous year. Third, your payment of income tax. Your payment of income tax is more than 1 lakh, but not in last year. In last 2 financial years for which due date of return has gone. So directly you will not see last 2 years. You are in financial year 23-24. Now in October 2023, what will be your last 2 financial years? It will be 21-22 and 22-23. Very normal. But if you are standing in April 2023, it will not be 21-22 and 22-23 because standing in April 2023, your due date of IT return for 22-23 has not yet come. So then it will be 20-21 and 21-22. Right. So what are we talking about? What are we talking about? First, it's not applicable for what? Government. Second, your refund of, here it is not payment, refund of GST input tax credit, which is applicable only in 2 cases. Zero rate supply and inverted duty structure is more than 1 lakh in previous year, normal previous year. Third, your payment of income tax, not refund now, it is payment. Payment of what? Income tax is more than 1 lakh. How many years? Not 1 year, not that, 2 years. That too, how to calculate? Those 2 financial years for which the due date has gone. For which the due date has gone. Wait, the point is not over here. When you are seeing this income tax payment more than 1 lakh, you will be seeing for whom? Either, let us think about a company. Either the company, let us talk about proprietor, HUF. Either HUF or the Karta. Either HUF or the Karta. Partnership firm, LLP. Either partnership firm or 2 partners, 2 designated partners. Company. Either the company or managing director, sufficient, 1 managing director sufficient, or 2 whole-time directors. 2 whole-time directors. Trust. Either the trust or 2 trustees. AOP. Either the AOP or 2 members of managing committee. You have more benefits. If company has not paid more than 1 lakh income tax in 2 financial years, so don't worry. Check managing director. He would have paid more than 1 lakh in last 2 financial years. If he has not paid, don't worry. Check 2 whole-time directors. Check 2 whole-time directors payment more than 1 lakh. So that way you have to see exemption. And the last exemption, you have to see cumulative applicability. In a particular month, you will not be paying 1%. But from April to, supposing you are standing in the month of October. In October month, you are not paying 1% by cash, therefore it is applicable. But if you see April to October, totally April to October, output tax minus input tax, how much you are paid by cash already crosses 1%. Then it is not applicable. Then it is not applicable. These are all the points which are there for your rule 86B. All the points, we have touched all the points that are there in your rule 86B. Now, the next violation is you are violating the ITC provisions. If you have taken wrong ITC, finished. If you have taken wrong ITC, government can, very dangerous, just by taking wrong ITC, department is having the power to cancel your GST number. If your outward supply in GSTR1 is more than GSTR3B, logical. Your sale in GSTR1 where you are not making any payment is more than sale in GSTR3B where you are making payment. They may have doubt, they will give you a notice, it may be cancelled. Next is non-return filers. You are not filing your returns. You are not filing your returns. If you are under MRMP scheme, continuous 6 months. If you are under QRMP scheme, 2 quarters. MRMP 6 months. QRMP 2 quarters. MRMP 6 months. QRMP 2 quarters. What if you are a composition taxable person? It's not 3 months and all. After the due date of your GSTR 4 is over, even thereafter 3 months are getting over. Even thereafter 3 months are getting over. Like, look at this way. Regular taxable person, casual taxable person. If you are under MRMP, 6 GSTR1 or 6 GSTR3B. If you are under QRMP, 2 GSTR1 or 2 GSTR3B. Non-resident taxable person, 6 GSTR5, 6 GSTR5, 6 months. They will be filing only monthly. Composition scheme dealer, only 1 GSTR4, which is not filed even after the due date, even after 3 months. Which means the due date of GSTR4 is 30th April of next financial year. Wait for May, wait for June, wait for July. Assuming that there is no extension, it is liable for cancellation in the month of August. Only 1 GSTR4. Only 1 GSTR4. And finally, you are talking about a person who went for voluntary registration, but he is not starting his business for the first 6 months. He came for voluntary, he is filing returns. Every month return, nil return, nil return, nil return. Are we talking about a normal person? No. He came for voluntary registration. Second, we are not talking about any 6 months. We are talking about the first 6 months. We are only talking about the first 6 months. He came for voluntary registration, which was not required, and his first 6 returns are all nil returns, liable for cancellation. So you will totally find here 10 cases. We have made it simple by bifurcating the 10 cases. 4 cases where assessee as well as department can go for cancellation. 10 cases where only department can go for cancellation. Where only department can go for cancellation. Now the time limits are not so important. Might be in your MCQs they'll ask when to apply, what department will do. We are not touching the time limits. Easily you can remember the recollect the time limits, and not at all important. Never you will get a direct question on the time limits. If at all you get, you might get in your MCQ. So I'm not touching the time limit. What we are touching is another very important concept called as effective date. When assessee applies for registration, what is the effective date of registration? This 30 days is very important. Whenever assessee is liable for registration, he has to apply for registration within 30 days. If assessee is liable for registration, and he makes application within 30 days, his registration will be effective from the date he is liable, old date. If I am liable for registration on 1st of June, if I apply on 25th of June, I may get my registration in July, August, etc. But it will be effective from 1st of June. It will be effective from 1st of June. But if at all, I did not apply for registration within 30 days. I applied for registration after 30 days of becoming liable, which means I was liable for registration on 1st of June. I have made application say on 15th of July. Is it made within 30 days or after 30 days? I get the registration on 20th of August. I get the registration on 20th of August. When I was liable? 1st of June. When I applied? 15th of July. Did I apply within 30 days? No. I get the registration on 20th of August. What is my effective date? 20th of August. Not even 15th of July. It is 20th of August. The date of grant of registration. If I apply in time, old date. If I don't apply in time, future date. If I apply in time, old date. If I don't apply in time, future date. And in case of voluntary registration, it is always grant of registration. Voluntary registration has no liability. So it is always date of grant of registration. This is when assessee applies for registration. When department gives suo motu registration, you are not going for registration, department is giving you suo motu registration. It is always date of grant of temporary registration, because the registration that department will be giving you is temporary registration. Temporary registration. This is when assessee goes for registration. This is when department gives suo motu registration. What about effective date for amendment? Core field amendment by assessee, non-core field amendment by assessee. Non-core field amendment is very simple because it is automatic approval. There is no question of any approval. Automatic approval. Officer is not involved. It is automatic approval. So when that effective date is important, it is when you are talking about core field amendment. You will apply, officer will check and give it. Now, when you talk about your effective date of core field amendment, prima facie they tell that it is the date when change happened. Supposing you have added an extra branch on 1st of June. Initially they tell that it is effective from 1st of June. But later on they change the answer, they tell that effective date of amendment shall not be earlier than a date of submission of application. And for amendment, the time limit for you to apply is 15 days. For registration it is 30 days. For amendment it is 15 days. 1st of June, you added a branch. You applied on 12th of June within 15 days. You applied on 22nd of June after 15 days. Whether you apply within 15 days or whether you apply after 15 days, here there is no change in answer. Here they tell that your amendment will be effective from the date of submission of application, which is 12th of June or 22nd of June, as the case may be, whether you apply within 15 days or whether you apply after 15 days. So what will be the effective date? Date when you applied for amendment. Date when you, not date when you are liable. This date, not date when it is granted. It is the present date. Date when you apply for amendment. Date when you apply for amendment. So then what is the significance of old point? At times, if commissioner wants, he can make it retrospective. He can make it a date which is 1st of June. He can tell that this amendment is effective from 1st of June. In both the cases, whether you applied within 15 days or whether you applied after 15 days. Normally, what is the effective date of amendment? Date when you apply for amendment. Whether 15 days or whether after 15 days, it is date when you apply for amendment. Can it be made retrospectively from the date when change happened? Yes, commissioner can do it. Commissioner can do it. Whether you applied within 15 days or after 15 days, commissioner can do it in both cases. And finally, what is the effective date of cancellation where assessee goes for cancellation or department goes, or where only department can go? Understand that effective date of cancellation in all cases is the same. Cancellation is a very serious matter and effective date of cancellation will be decided only by the proper officer. It can be current date, it can be a old date, retrospective date. Officer can cancel your registration today, effective from today, or he can cancel your registration today, effective from a very old date. He can cancel your registration effective from 3 years old date. Who will decide it? Officer. Whether assessee applies for cancellation or whether department goes for cancellation, in both the cases, who will decide effective date of cancellation? Proper officer. Can it be present date? Yes. Can he make it cancellation effective from a old date? Yes. Can you make cancellation effective from a future date? Yes. He can tell, I am cancelling your registration as you have asked that you will be doing business during this month, not from next month. Your registration will be cancelled with effect from 1st of next month. Normally that will not happen, but he is having the powers to cancel from future date also. Normally what will happen? Either current date or old date Retrospectively also possible. That will be decided by the proper officer. What we have seen now? We have seen when registration is required, amendment is required, cancellation is required. And what will be the effective date of registration, amendment and cancellation, and your cancellation. Yes, when you talk about persons who are liable for registration, you have to see three provisions altogether. Section 22, turnover based registration, 24, compulsory registration, read along with section 23, no registration. Now, before we see section 23 and 24, the first provision should be section 22. Turnover based registration. Turnover based registration. Based on your turnover, you have to get registered. But which is more powerful? Compared to 22, 24 is more powerful. Compared to 24, 23 is more powerful. 22 is turnover based registration. Then your more powerful provision, section 24 compulsory. And the most powerful is section 23, which tells that no need of taking registration. Now, what is this turnover based registration? Remember the story where we have discussed about politics? Right. So, you are talking about apni politics can be summarized in three things in India. One is money, next is land and Ram. And when you are a very small person, turnover based registration means when you are a very small person, this entire exercise should be time pass for you. Politics should be time pass for you. Now, what is the full form of AP? Arunachal Pradesh. S, U, so S, Sikkim, U, Uttarakhand, M, Meghalaya, Tripura, Manipur, Nagaland, Mizoram, and Telangana, Puducherry. Telangana, Puducherry. Obviously, you'll have your other states and union territory not being covered here. So, when you talk about your apni politics summary and when you talk about Telangana and Puducherry, situation is different. We have to bifurcate now into three. When you talk about Tripura, Manipur, Nagaland and Mizoram, you need to understand that for them, the limit is always 10 lakhs. Be it supply of goods or be it supply of service or be it supply of goods plus supply of service. The limit is always 10 lakhs. Whether you are dealing only with goods or services or goods plus services, limit is always 10 lakhs. Now, when you talk about Arunachal Pradesh, Sikkim, Uttarakhand, Meghalaya, Telangana and Puducherry, whether you are talking about these will come together, whether you are talking about supply of goods or supply of service or supply of goods and service, supply of goods and supply of service, the limit is always 20 lakhs. The limit is always 20 lakhs. Other states, if at all you are talking about supply of goods alone, then it is 40 lakhs. Supply of service, supply of goods plus service. So if it is supply of goods alone, only then you have this 40 lakhs. If it is supply of goods plus supply of service or only supply of service, the limit is 20 lakhs. The limit is 20 lakhs. But this 40 lakhs, which is applicable for other states other than the special states, and that too applicable only when there is supply of goods, has two special points to address. What are the two special points to address? What are the two special points that you need to address them 40 lakhs separately? One is the plus sign and one is a minus sign. Plus sign is normally it is applicable only for supplier of goods. But even if you are talking about supply of goods along with interest on loans or deposits, you will still take the benefit of 40 lakhs. Normally, the moment small service comes in, you forget about 40 lakhs. You go to 20 lakhs and lakhs. But they allow one particular service to be along with supply of goods. Still, you can get the benefit of 40 lakhs. Interest on loan is not excluded. It is included. But still, in aggregate turnover, you have to add interest on loan. Unlike composition scheme, you have to include it. But you can still enjoy the benefit of 40 lakhs. Supposing supply of goods is 30 lakhs. Interest on loan is 5 lakhs. So your aggregate turnover is 35 lakhs. Normally, if it is goods plus services, you will resort to 20 lakhs, which would have said that you have to take registration. But in this case, you are not required to take registration. Why? Your limit is now 40 lakhs. If at all assuming you are there in states other than the special states. Your aggregate turnover is 30 lakhs goods and 5 lakhs services being specifically interest on loans or deposits. This relaxation is not for any other service. It's only for interest on loans and deposits. If it is along with goods, if it is only service along with goods, then still you can enjoy 40 lakhs, need not go down to 20 lakhs. 1 minus, which means you cannot enjoy the benefit of 40 lakhs in certain cases. When? We have already covered this. When your supplier, be it a trader or be it a manufacturer of what? Pan masala, tobacco, ice cream and building materials. Aerated water will not come. Pan masala, tobacco, ice cream and building materials. If you are dealing with any of these items, pan masala, tobacco, ice cream and building materials, you will resort to 20 lakhs. You cannot go for the benefit of 40 lakhs. You cannot go for the benefit of 40 lakhs. So that is all about turnover based registration. Please remember that aggregate turnover includes exempt supply. Exempt supply includes non-taxable supply. When you are getting a question where you are working in multiple states, aggregate turnover is pan-India turnover. Aggregate turnover is, which means if I am working in 2 states, first I will check my aggregate turnover. I will check my, not individually, I will check my aggregate turnover in totality. Both the states turnover, I will add the number and I will see whether I am crossing this 40 lakhs, 20 lakhs, 10 lakhs or I am within this 40 lakhs, 20 lakhs, 10 lakhs. If I am crossing this 40 lakhs, 20 lakhs, 10 lakhs, I have to get registered in both the states. Checking the criteria of aggregate turnover is pan-India. It's not state-wise, it is pan-India. I will sum up the total of all the states and see whether the aggregate turnover is up to 40 lakhs, 20 lakhs, 10 lakhs. If it is below it, no need of registration in any of the states. If it is above it, I have to get registered separately in each of the state. Now that is not pan-India. Separately in step 1, aggregate turnover, not for each state, all the states put together. Step 2, based on step 1, registration, which will be separately for each state. Now few other points. If at all you are working in 2 states where there is a fight between 2 states, you are working in Tamil Nadu and Telangana. What is the limit? Tamil Nadu, Telangana, 40 and 20. You will resort to 20. So you are checking aggregate turnover will be 20 lakhs for both the states put together. So you are working in Telangana, Tripura. 2010. Who will win? 10 lakhs will win. So your aggregate turnover of both Telangana and Tripura should be less than 10 lakhs. If you are working in Tamil Nadu, Tripura, your limit now reduces to 10 lakhs. If there is a fight between 40 lakhs, 10 lakhs will win. The younger one, 10 lakhs will win. So your aggregate turnover means both the states turnover, Tamil Nadu and Tripura together should be less than 10 lakhs. But at times, it will go back to the higher limit. When you are working in 2 states where limit is higher limit versus lower limit, by default, which will limit? The lower limit will be the criteria for all the states put together. But at times, you will go back to the higher limit. When is that? When the lower limit state deals with only exempt supply or only non-taxable supply. Anyways, you are not going to get registered in that lower limit state because of section 23. You can go back to higher limit. So what is the by default condition? Whenever there is a fight between higher limit and lower limit, who is going to win? Lower limit. You are going to 40-20 means 20 lakhs. 20-10 means 10 lakhs. 40-10 means 10 lakhs. But there is an exception. What is that exception? When there is a fight between higher limit and lower limit, you might finally go back to higher limit. When is that criteria? If the lower limit state deals only and only with exempt supply or only and only with non-taxable supply. Only and only with exempt supply and only with non-taxable supply. Because anyways, it is not going to get any revenue. Anyways, there will be no registration in that state. So by default, this is the general thumb rule. This is a general rule. This is an exception. Thumb rule is high limit versus low limit. Low limit will be applied for all the states put together. At times you will go back to high limit when the low limit state deals only and only with exempt supply or only and only with non-taxable supply. So that is everything about your section 22 read along with 10 bar 2019 CT. There's a notification for this 40 lakhs. Now, as I said, what is more powerful than 22? 22, then it is more powerful is 24 and finally it is 23. Now we are going to see section 23 and 24 together. There are three situations where you will never ever get registration irrespective of your turnover. Section 23 will talk about no registration. 24 will talk about compulsory registration. If at all you are caught between 22 and 24, go with 24 compulsory. But if you are caught between 24 and 23, go with 23. Go with 23, no registration. There are three scenarios where you will never ever get any registration, irrespective of your turnover. What are those three scenarios? Where you have supplies which is exclusively non-taxable supply, or you have supplies which is only and only exempt supply, or where you have supplies which is only and only supplies which is taxed under RCM. You are not the recipient. You are talking from the angle of supplier. You are not the recipient. You are talking from the angle of supplier. In these three cases, where it is only and only non-taxable supply, only and only exempt supply, only and only RCM supplies, you are not talking from the angle of recipient, you are talking from the angle of supplier in all these three cases. In these three cases, what will happen? You are not required to take any registration irrespective of your turnover. Your turnover may be 10 lakhs, 1 crore, 10 crore, 100 crore, no worries. No need of registration. But when is it possible? Only and only exempt supply, only and only non-taxable supply, only and only RCM supply from the angle of supplier, not from the angle of recipient. Recipient means compulsory. From the angle of I am making all the supplies, I need not pay any GST. My recipients will pay under RCM. It is as good as no tax for me. No need to get registered. No need to get registered. Then there is a point which tells that agriculturalists, to the extent of supply of agricultural produce out of cultivation of land. Agriculturalist means what? Only and only individual and HUF. No one else, not agriculture company. Only and only individual and HUF. Agriculturalists to the extent of supply of produce out of cultivation of land. Now here they don't use the word exclusively. They use the word to the extent of. To the extent of. First thing, we are not talking about reseller of agricultural produce. We are talking about farmer, agriculturalist, who is actually cultivating the produce out of land and he is selling. Now, if at all, this agriculturalist turnover is 50 lakhs, 30 lakhs produce and 20 lakhs other supplies, he will get registered. Even after getting registration, on 30 lakhs, he will never pay GST. On this 30 lakhs, he will never pay GST. So this is more of no payment than of no registration. This is more of no payment than of no registration. So if you are talking about an agriculturalist who is having agricultural produce 30 lakhs and other supplies 20 lakhs, which means assume that this agriculturalist is in the state of Tamil Nadu. Has he crossed the registration limit? Yes. He has crossed the registration limit of 40 lakhs. Therefore, he is registered. Even after getting registration, assuming all the supplies are only of goods, that being the case, I have taken 40 lakhs. Even after getting registration, assume that agricultural produce is having 5%, other supplies having 18%. On this 30 lakhs, GST will not be paid by the agriculturalist, even though he is registered, even though there is a rate of tax on the agricultural produce. Obviously, he has to pay GST at 18% on other supplies. This is more of relaxation from payment than registration. So here you'll understand the word extent of. To the extent of agriculture. Are we talking about a reseller? If the same person is a reseller, he'll pay tax both on agricultural produce as well as on other supplies. We are talking about an agriculturalist. To the extent of supply of agricultural produce, he will not pay GST. Two important points. Though he is registered, though there is a rate of tax. Though he is registered, though there is a rate of tax, still he will not pay anything on this agricultural produce. So that is for your agriculturalist. Now, all the other points that you have are for other cases. Are you talking about compulsory registration, and at times 23 will help you. As we have seen 4 cases where you will never take registration, 3 where you will never take, and 1 where you will never pay. 3 where you will never take registration, 1 where you will never pay on a particular portion. Fully tax, non-taxable supply, fully exempt supply, fully RCM supply from the eyes of supplier, and agriculture to the extent of supply of agricultural produce which is out of cultivation of land. He might be registered, there may be a rate of tax on produce, but he will still not pay GST on the supply of agricultural produce. On other supplies, he will pay GST. Now, when you talk about RCM, you should also understand that what we have discussed was from the angle of supplier. What if you are talking about from the angle of recipient? From the angle of recipient has to take compulsory registration. From the angle of recipient has to take compulsory registration. Now we are entering 24, read along with 23, 24. We are entering 24 here and there we will be again seeing 23 relaxation. So you are talking about supplier only having supplies tax under RCM. I am the supplier, I am having all the supplies tax under RCM. I am never going to pay tax, I will never get registered. But my recipients have to take compulsory registration even if their turnover is less than 40, 20 or 10 lakhs. So here recipient has to take this compulsory registration. But normally what will happen, there will be suppliers who will have partly taxable under FCM, partly taxable under RCM. They will not get the relaxation of no registration. They have to get registered, but they will not pay tax on the supply which is taxed under RCM. Recipient will pay tax after taking compulsory registration if it is not registered. That is the first point. Now, other points on interstate outward supply. On interstate outward supply of goods or of services, be it interstate supply of goods or of services, you have to take compulsory registration, but you have certain relaxations. Now, how to remember? If at all you are having interstate outward supply, we are not talking about intrastate, interstate outward supply of goods of services. So what will be the normal answer for goods? The normal answer for goods will be you have to take compulsory registration under section 24. The normal answer for services will be, though by prima facie you are covered by compulsory registration under section 24, but section 23 gives you a relaxation and tells that you can go with turnover based registration. But this time this turnover based registration relaxation is not given by section 22, it is given by section 23. Why? The moment you have interstate supply, you don't see 22, you go to 23, you go to 24. Basically, section 24 tells us even if you have interstate supply of services, you have to take compulsory registration, but there is a relaxation given under section 23 for interstate supply of services. So this turnover based registration for services, turnover based registration means what? 20 lakhs or 10 lakhs is not by virtue of 22, it is by virtue of 23. Now there is an exception when you talk about goods. If you talk about notified handicraft goods, even though there is even though there is interstate supply, even though there is interstate supply of goods, even then you can go with turnover based registration. This relaxation is again given by 23. It is not given by 22. And for goods, turnover based registration means what? 40 lakhs, 20 lakhs or 10 lakhs, depending on which state you are. For notified handicraft goods, you will still get the benefit of turnover based registration, that is 40 lakhs, 20 lakhs, 10 lakhs. But because of section 23, not 22. It was thrown outside 22, it went to 24. From 24, section 23 gave a relaxation for notified handicraft goods. Now, what is the normal answer for services? Even though you have interstate supply of services, turnover based registration. But there is an exception when you're talking about job working sector for jewelry industry. Not other industry will come in general category. Job working sector for jewelry industry, you have to take compulsory registration under section 24. For goods by default, it is compulsory registration. For services, by exception, which is job worker for jewelry sector, that is compulsory registration. For goods, when you're talking about exception, notified handicraft goods, that is turnover based registration under 23, not by 22, because of 23, 40, 20, 10 lakhs as an exception. For services, generally there is turnover based registration because of 23 relaxation, 20 lakhs and 10 lakhs. It works in a very reverse manner. So that is for your interstate outward supply. If you have intrastate outward supply, don't worry, you are not even covered in 24. Forget about 23. You take the benefit of section 22, 40 lakhs, 20 lakhs, 10 lakhs. So when you talk about 40 lakhs and 20 lakhs, 10 lakhs, it is applicable only for your intra-state supply within the state. Now next compulsory registration is for your CTP and NRTP. But for CTP, you have a relaxation. But for CTP, you have a relaxation. What relaxation you have for CTP? Same notified handicraft goods. If you are dealing with notified handicraft goods, even though you are CTP, there is no need of compulsory registration. You can go with turnover based registration. So when you talk about your CTP and your NRTP is very clear. There is always compulsory registration under section 24. CTP by default is always compulsory registration under section 24. At times, as an exception, when you are dealing with notified handicraft goods, they tell that okay, you can go with turnover based registration as per section 23, which is nothing but 40 lakhs, 20 lakhs and 10 lakhs. Rather, both are interconnected when you talk about interstate supply of notified handicraft goods, turnover based registration, and casual taxable person for notified handicraft goods, turnover based registration. And for both of them, there is an additional criteria when you talk about notified handicraft goods, that though you are getting relaxation from registration, you should be a valid PAN card holder and there should be compulsory e-way. We are getting relaxation from registration, but we still want to track you. So there should be compulsory e-way. There should be compulsory, even unregistered person can generate e-way. There should be compulsory e-way. Now, other areas that you have, all the other areas that you have. First, let us take simple areas that you have. If you are required to deduct TDS, or if you are required to collect TCS, or if you are required to pay tax under section 9(5), or if you are required to distribute your credit ISD, or if you are an OIDRS from outside India, to India, or if you're talking about a special agent, if you're talking about a special agent as per schedule 1, all of them compulsory registration, no exception, no exception. Who are they? You'll find them all in exception category. TDS deductor, TCS collector, ISD, OIDRS outside India. See, TDS, TCS, ISD, OIDRS from outside India, and ECO under section 9.5. ECO under section, because it is going to pay tax on behalf of both supplier and recipient. So these 5 categories, it is always compulsory registration. Compulsory registration, right? So ECO under section, ECO is required to pay tax under section 9.5, compulsory. ECO who has to collect TCS, compulsory. ISD, TDS, compulsory. Now one more point we have left out. Schedule 1, special agent, compulsory. So these 6 categories, ISD, TDS, TCS, 9.5 OIDRS from outside India, special agent. Always they are required to take compulsory registration. Always they are required to take compulsory registration. Now where is this relaxation? When we are talking about your supplier of goods or services through ECO other than 9.5 category, because 9.5 category you may be registered, you may not be registered based on your turnover. 9.5 is a different category where ECO will take the responsibility. Right, we have discussed passenger transportation, services, accommodation, housekeeping and restaurant, where we have seen that at times if it is passenger transportation services covered under 9.5, supply will never be registered. But if it is accommodation, housekeeping, he might have to get registered because he may not be covered under 9.5 always. 9.5 has a condition that you should not be liable for registration under section 22. And when you're talking about restaurant, you may be registered, still partly it is under FCM, partly it is under 9.5, not RCM. 9.5 is not technically RCM. 9.5 is neither FCM nor RCM. Clear? So you are not talking about 9.5 case. Supplier of goods or services other than 9.5 category where ECO will collect TCS. So you are not talking about Amazon through whom you are supplying the goods. Amazon will take compulsory registration. Amazon will take compulsory registration. It has to collect TCS. It has to take compulsory registration. Amazon, no exception. Amazon has to take compulsory. But what about supplier of goods through Amazon? Or what about supplier of services through different online portals or websites? Now, supplier of goods through Amazon. Now, understand it this way. Understand this way. 9.5 section 9.5 is applicable. Section 9.5 is not applicable. Section 9.5 is applicable. Section 9.5 is not applicable. If section 9.5 is applicable, ECO will take compulsory registration. ECO will take compulsory registration. Supplier of 4 notified services, because 9.5 covers only 4 notified services. I am not writing an answer. I will write it depends. It depends. What you are, who you are, it depends. Case to case you have to decide. When 9.5 is not applicable, when section 9.5 is not applicable, there may be TCS, there may not be TCS, correct? TCS may not be there, TCS may be there. Because for TCS to be there, there are 2 conditions. Supply is through ECO and consideration is received through ECO. TCS may be there, TCS may not be there. If TCS is not there, ECO, supplier of goods who is supplying through ECO, supplier of service who is supplying through ECO, all of them have to take turnover based registration. No one is compelled. Turnover based registration. But when TCS is applicable, ECO, you have to take compulsory registration, section 24. Supplier of goods through ECO, you have to take compulsory registration, section 24. Supplier of services through ECO, that person who is supplying the services through ECO, Now there's a relaxation for service sector, just like the normal relaxation you had in interstate outward supply. Turnover based registration, but because of section 23. Initially it is compulsory, but who's giving relaxation? 23. You'll find a difference. Here also I wrote turnover based registration, but this was because of section 22. This was because of section 22. So when you have this entire understanding, wherever 9.5 is applicable, wherever 9.5 is applicable, don't worry, eco will go for compulsory registration. Supplier of notified services, they may have to take registration, they may not have to take registration. It depends on each of the 4 cases. It depends on each of the 4 cases. Prima facie, first category will never take registration, passenger transportation service. Second, third and fourth, they might have to take registration if their turnover is crossing 20 lakhs and 10 lakhs. Now, when you talk about 9.5 not being there, when 9.5 is not there, you have to ask another question, whether TCS is there or TCS is not there. If TCS is not there, life is very simple, whether it is eco or supplier of goods or supplier of services, turnover based registration as per section 22. If TCS is there, then eco compulsory registration. Supplier of goods through eco, compulsory registration. But when you talk about supplier of services through eco, it is turnover based registration, but because of section 23, not because of section 22. Not because of section 22, it is because of section 23. And whenever I tell turnover based registration for service sector, it is 20 lakhs or 10 lakhs. It is 20 lakhs or 10 lakhs. So that's everything about your liability to get registered. Section 22 read along with section 24, read along with section 23. You cannot crack an answer without linking all these 3 provisions. When you talk about your payment chapter, basically the section is section 49 and the corresponding rules. 49A, 49B read along with 88A, it talks about your utilization of credit and the sequence of utilization of credit, which you have already seen in your ITC chapter. 50 is the most important provision here, which talks about your interest on delayed payment. And 53A is a situation where you end up paying excess tax and thereafter there is a refund, which we'll understand when we take a example while discussing this payment chapter. And by default, when you talk about your payment, the basics, fundamentals of indirect taxes is it is presumed that you have shifted the tax burden to the next person unless you prove it otherwise. So whenever you are talking about payment of taxes, it is always presumed that if at all you are talking about your indirect taxes, you have collected and made the payment. So the shifted burden is shifted to the next person unless you prove it otherwise. And another important point throughout your indirect taxes, which is under section 170, whenever you get a number, you have to round it up to the nearest rupee 1, be it tax or be it interest. Penalty, late fees, generally you will not get in decimals, because the moment you calculate tax in a round off number, penalty automatically is there in a proper number. So whenever you get any number, you have to round it up to nearest rupee 1. So basically when you talk about your payment, there are 3 ledgers. One is your gross output tax, which is going to hit your electronic liability ledger. Then you are going to make your payment of gross output tax by way of input tax credit. First is input tax credit, which will be hitting your electronic credit ledger, and final payment net output tax you are going to make it by way of cash. So this will hit your electronic liability ledger. This is going to hit your electronic credit ledger, and this is going to be through your electronic cash ledger. This is the outer understanding of that. Now let us understand that how you are going to get your liabilities and how you are going to close the liabilities. So whenever you have your liability is created by 2 ways. Either liability is created by assessee himself or by way of assessment by proper officer. So when you are talking about your liability, either assessee himself creates the liability by filing the returns, or it is determined by proper officer. And what kinds of liabilities can be there? The liabilities can be either your tax, interest, penalty, late fees, any other amount. Tax, interest, penalty, late fees, any other amount. So whether it is self-assessed by the assessee by filing his returns, or whether it is determined by the proper officer at the time of assessment, it will be either tax, interest, penalty, late fees, or any other amount. This is your creation of liability. Now, how to close the liability? Basically, when you talk about closure of liability, what would be the first step? What would be the first option that assessee would opt? Closes liability by way of credit ledger or cash ledger? So he is going to close the liability by way of credit ledger. So who is going to try maximum to close the liability by way of credit ledger? And if credit amount is not sufficient, he is trying to close it by way of cash ledger. So that would be the second priority. So first priority will be credit ledger followed by cash ledger. But you need to understand that credit ledger can be used only for tax payment. And that too you have some restrictions. So what are the payments that cannot be paid by way of your credit ledger at all, and that can be paid only by way of your cash ledger? When you talk about your interest, penalty, late fees, any other amount, paid only by way of cash ledger. When you talk about composition scheme tax, paid only by way of cash ledger because they will not have any credit. When you talk about your TDS, TCS, GST, TDS, GST, TCS, paid only by way of cash ledger. When you talk about RCM, RCM has to be paid by cash in one hand and get the credit ledger in other hand. So first payment will be made only and only by way of cash ledger. Then you will get the amount in your credit ledger. So all these payments, that is your interest, penalty, late fees, any other amount, composition tax, RCM tax, GST, TDS, GST, TCS, these amounts will be paid only and only by way of cash ledger. Right, so that is a liability created by the assessee or the proper officer, and now you're closing your liability by way of payment by way of credit ledger or cash ledger. Now, at times your liability which is created by the officer will be reduced. So when you create your liability, you will be paying for sure. But when officer creates liability, there is another option. Rather than payment, what assessee can do? He can go for appeals. So whenever your liabilities has been created by the officer, that liability can be reduced when you go for appeals, either by appellate authority or appellate tribunal or high court or Supreme Court. So that is reducing the liability. That is not payment of liability, that is reducing the liability. That is one more way where your one specific liability will be reduced. In your section 73-74, specifically in section 74, there is a point where the earlier you pay, the penalty will be lesser. The earlier you pay, the penalty will be, by default, penalty under section 74 is 100%. But when you talk about earlier payment, it can be 15%, 25%, 50%. So the second point is only and only talking about reduction of penalty. So your penalty can be reduced partly or fully if at all assessee makes the payment of tax, interest and the reduced penalty within the time specified therein. Right. So these two are not payment of liabilities. These two are reduction of liability. This is all about payment of liability. This is all about payment of liability. This is all about reduction of liability. Either you can challenge your entire liability and go in appeals, and appellate authority or tribunal or court can reduce the liability, or you accept the liability. Still, your entire liability will not be reduced, but your penalty portion can be reduced. So that is all about your liability ledger, and understand that there is a sequence to discharge your liability. There is always a sequence to discharge your liability. If at all you have multiple months liability, how to close the liability? First priority you will be giving to whom? If you have multiple months liability, what is the first priority that you are going to give? Whether it is going to be your self-assessed liability or officer-assessed liability. First, it is always going to be your self-assessed liability. Then it is going to be your officer-assessed liability. So first, try to close your own liability that you have assessed. Then try to close your liability which is ascertained by proper officer. Though the proper officer's liability can pertain to a month which is earlier than your self-assessed liability. The proper officer can ascertain your liability for Jan 2023, and your self-assessed liability can be for say April 24, May 24, June 24. First try to close your self-assessed liability of April 24, May 24, June 24. Then try to close your officer assessed liability, though it pertains to a period which is Jan 2023 or a very old period, say 1718 or 1819. Then try to close that. Now, when you're closing your liability, it is not only tax portion, it should be all the liabilities, tax and your other dues. When you talk about other dues includes everything else. Interest, penalty, late fees and any other amount. So, you have to close your liability, entire liability, then go to the next liability. Not only your tax liability. In self-assessed liability, priority will be given to whom? Priority will be given to earlier period. So, in our example, self-assessed liability pertain to April 24, May 24, June 24. First, you have to create the clear the liability of April 2024. Then you have to clear the liability of May 2024. Then you have to clear the liability of June 2024. Right. So sequence is self-assessed, then proper officer assessed. Within self-assessed, the first priority should be of old months, then the current months. Now, this is all about your liability ledger. When we see liability ledger, a part of credit ledger and cash ledger we automatically see. Why? When you are making the payment of your liability, you are going to use your credit ledger or you are going to use your cash ledger as the case may be. Correct? When you are going to close your liability, what is the amount that you are going to use normally when you are going to make the payment? Either your credit ledger for only tax purposes, cash ledger for anything. For any dues, you can use your cash ledger. But the question is, how do you get the amount in? How do you get the amount in your credit ledger and your cash ledger? By default, first you need to understand how the amount is received in your credit ledger and your cash ledger. Now understand that you get the amount in your credit ledger by way of filing your return. By way of claiming ITC, by way of filing your return. Only when you file your return, you'll get the amount in your credit ledger. This has been discussed even in your ITC chapter, where one of the criteria for claiming the credit is file your return. Only then the amount will go and sit in your electronic credit ledger. Likewise, in your cash ledger, you basically get the amount by way of making deposits in your cash ledger. How you get amount in your credit ledger? By filing your return. Whatever ITC is there, it will be reflected in your electronic credit ledger. How you get the amount in cash ledger? By making deposits. So this is a basic default understanding. How you get amount in credit ledger? Return. Use it for liability. How you get the amount in cash ledger? By depositing. Use it for anything. You don't not restricted only tax liability. It can be used for anything. Unlike credit ledger, which can be used only and only for your output tax. It cannot be used for anything else. Now, special provisions. When you talk about both your credit ledger and cash ledger, you can apply for refund. You can apply for refund. But understand that cash ledger refund can be applied by anyone. It is your deposit. You can break your deposit at any point of time. Whereas credit ledger refund can be applied only in two scenarios. One is zero rated supply, other is your inverted duty structure. Only in two cases you can get the refund of your credit ledger. But understand that you can claim the refund. In credit ledger, it is only in two cases. In cash ledger, it is in all the cases. It is in all the cases. So when you make application for refund, what will happen? Your credit ledger, cash ledger balance will decrease or increase. We are trying to make the application for refund, whether it will decrease or increase. Application for refund. I have credit ledger balance, cash ledger balance 10 lakhs. I am making refund application of 8 lakhs. So your credit ledger balance, cash ledger balance will increase or decrease? It will decrease or increase. It will decrease. This is the decreasing amount. This area is the decreasing amount. You are going to decrease it. See, credit means you are getting it. This means it is going to decrease. So when you are going to make a refund application, what will happen? Your credit ledger amount or your cash ledger amount is going to decrease. So out of 10 lakhs, if you have applied for 8 lakhs refund, balance credit ledger, cash ledger balance will be only 2 lakhs. Assume that you have made a refund application of 8 lakhs, but you get the refund only of 4 lakhs. What happens with balance 4 lakhs? It is being rejected. It is being that rejected 4 lakhs will be added or decreased. Will be added back. So claim which is being rejected will be added back. The refund claim which is rejected will be added back. Right. So that is all about your refund. Now other special points. There are certain other special points. First, let us try to understand the other special points in your cash ledger. Normally, we have seen that cash ledger payments can be used for anything, including payment of TDS TCS. But here, in your credit of cash ledger, you also find again TDS TCS. This is getting the amount in cash ledger, not using it for payment of TDS TCS. Now, what is the difference? One person will be deductor, one person will be deductee. One person will be collector and one person will be collectee. Let us understand from the angle of TDS. The person who has to pay TDS, in GST it is the government. They have to pay that TDS amount by way of cash ledger. There, when they are going to make the payment, it is going to decrease from the cash ledger. The opposite person against whom TDS has been deducted, the supplier to the government. The supplier to the government. They are going to get the amount in their cash ledger. They are going to get the amount in their cash ledger. Let us understand this again. Government deducts TDS for the suppliers to government if the contract value exceeds 2,50,000. That's the provision of section 51. That's the understanding of GST TDS. Government and government undertakings. Not only government there, it is also government undertakings there. Now, the person, it's just like your income tax. The person who has to pay TDS will pay only by way of cash ledger. He cannot use credit ledger. For him, that amount will decrease from cash ledger. So government has to pay that TDS liability only after depositing in cash ledger, and when it is paying TDS liability, the amount will decrease. The opposite person against whom the TDS has been deducted, that is the deductee, the supplier to the government, he'll get that amount in his cash ledger. So that is the point which is given here. Now, certain other important special points which are left out, both in your credit ledger and cash ledger. Now, if at all you have made excess payment of tax in a particular month, supposing your liability was 10 lakhs and you had credit of 9 lakhs, what you did? You made the payment of 1 lakh by cash. So this was your input tax credit and this is the payment which you made by cash, and this was your gross output tax liability. Later on, you found out that your actual liability was not 10 lakhs. By typing mistake, 1 lakh was typed as 10 lakhs, which means how much excess payment you have made? The excess payment that you have made, excess payment of output tax that you have made is 9 lakhs. Clearly you are eligible for refund. By mistake you have made the payment of excess output tax, clearly you are eligible for refund. But understand that this entire 9 lakhs will not get in your bank account. You are not going to get in your bank account. You are going to get in your, partly in your credit ledger and partly in your bank account, not cash ledger. If it comes in cash ledger, again you will apply for refund from that. So partly in your credit ledger and partly in your bank account. So first you need to understand that this refund partly will go in your credit ledger, and don't write cash ledger. Partly will go to your directly to your bank, not to your cash ledger. Partly in your credit ledger, partly to your bank. Now what part will go to your credit ledger? Refund amount is 9 lakhs. What is the ratio of utilization of credit ledger and cash ledger? Though it was wrong, 9:1. So 9 lakh multiplied by 9 divided by 10 will go and sit in your credit ledger. 9 lakh multiplied by 1 divided by 10 will go and sit in your bank. So 90,000 will go and sit in your bank, and 8,10,000 will go and sit back in your credit ledger. Right? This is to ensure that you are not misusing the provisions and converting your credit into bank. Right? If you told you have made excess payment of output tax, yes, you are very much eligible for refund. But that refund will partly go in your credit ledger and partly sit in your bank. So this you will not find in cash ledger. This provision you will not find in cash ledger. What is the proportion by which you made the payment in that month? 9:1. So that in 9:1 ratio, it will go in your credit ledger and it will go in your bank account, not your cash ledger. So this provision has been discussed here. Wrong or excess tax payment from your electronic credit ledger in the ratio of payment by way of credit is to cash. By way of credit will go and sit back in your credit ledger. By way of cash will not go and sit in your cash ledger. Directly it will go to your bank account. Because if it sits in your cash ledger, again you will make a refund application from the cash ledger. It will directly go and sit in your bank account, not in your cash ledger. So correspondingly, you will not find anything in your cash ledger because it will directly go and sit in your bank account. Now, there is another provision, special provision which is given here. If at all you are talking about erroneous refund. So there is a recredit of repayment through electronic cash ledger where there was an erroneous refund initially which was that of electronic credit ledger. Let us try to understand. There was an ITC excess. You claimed the refund of that. It was held that it was erroneous refund. You paid it by way of cash. Now you have to get it back in your credit ledger. You had credit. You are not eligible for refund. You applied for refund. So what happened when you applied for refund? Credit ledger balance decreased. You had your credit. You applied for refund. Credit ledger balance decreased. It was found that it is erroneous refund. You paid it by way of cash. Now, when you get the amount in your bank and you paid back, you got the amount in your bank account and you paid back, that is nullified. But initially what had happened? When I applied for refund, my amount reduced from credit ledger. Don't you think that it should hit back the credit ledger? That is given. There are 4 steps. There was ITC, I applied for refund, credit balance reduced. I got in my bank account. I paid it back through my bank account cash ledger. So I received in my bank, I paid it back through bank through my cash ledger. So that is nullified. But in the entire process, my credit has been decreased. Now it has to come back. It is just like rejection, but later rejection. Just like rejection, but later rejection. It will come back and sit in my credit ledger. And just like this, when you talk about erroneous refund of tax paid from credit ledger, repaid with interest and penalty. If at all there is an erroneous refund of tax which was paid from credit ledger, now it is repaid with interest and penalty. Interest and penalty is always paid by cash ledger. So interest and penalty will come back and sit in my cash ledger. Will again come back and sit my cash ledger. Whenever you talk about interest payment and penalty payment, they have to be paid only by way of cash. And finally, when it is decided that that is not that, it will come and sit in my cash ledger. These are all special aspects. So what you have to understand is, just understand the debits and credits, how you get the liability, how you pay liability, how you get the amount in credit ledger, how you discharge it, how you get the amount in cash ledger, how you use it. So that completes your entire credit ledger, cash ledger and liability ledger. In credit ledger, there are some special points basically pertaining to utilization of credit, which you have already completed. Order of utilization of ITC, we have already seen in your ITC chapter. But yes, in cash ledger, there are certain things that needs to be discussed. How you get the payment in your cash ledger? How you get the payment in your cash ledger? By way of deposit. Deposit should be by way of online challan or offline challan. Deposit is always by way of online challan. Always by way of online challan. There is no concept of offline challan. Deposit is always by way of online challan. There is no question of offline challan. To the extent where even if you are unregistered person, then even then officer will create an online challan for you. So if you are a registered person, your online challan will be CPIN, Common Portal Identification Number. Common Portal Identification Number. If you are unregistered person, your challan will be called as Temporary Identification Number. So deposits are always made by way of online challans. online challans. For registered person, it is CPIN, Common Portal Identification Number, which means that challan has to be generated on the portal and it will have an identification number called as CPIN, which is a 14-digit unique number. If at all you are not a registered person, even then you have to make the payment only after generation of temporary identification number again on, which means they are very clear that challan has to be generated online, only on the portal. Whether you are a registered person or unregistered person. Whether you are a registered person or unregistered person. The second step is payment of that amount in challan, which will result into hitting the cash ledger. First step is challan, second step is actually making the payment of that challan. When you talk about the second step, the moment you make the payment, your CPIN or TIN will convert into CIN, challan identification number. Here we are talking about payment. Here we are talking about payment. What is challan identification number? It is nothing but 70-digit number, 14 digits generally is of CPIN and 3 digits will be of the bank's branch code. So 14 digits is of the common portal identification number and 3 digits will be of bank's branch code, and the validity of that challan will be 15 days. The validity of that challan will be within 15 days of creation of challan, you have to make the payment. If not, don't worry, create another challan. Create another challan. And understand that one challan is sufficient to discharge all your liabilities, be it tax, interest, penalty, and one challan is sufficient to clear your liabilities of multiple months. So there can be a single challan to make the payment for 3 months of multiple liabilities. If at all you have 3 months liability, different liabilities, tax, interest, etc., should you create multiple challans or single challan is sufficient? Single challan is sufficient for discharging multiple liabilities of multiple months. Discharging multiple liabilities of multiple months. Now talking about payment. Your payment can be either online payment or offline payment. Your payment can be either online payment or offline payment. The online payment facility is when you're talking about your UPI, internet banking, credit card, debit card of authorized banks. That is your online payment. Your offline payment can be by of NEFT, RTGS. Now even IMPS is added. It was already there, but they have added this UPI and IMPS now. It was already there. Online payment is by way of UPI, internet banking, debit card, credit card. Offline payment is by way of mainly NEFT, RTGS and your IMPS, irrespective of any amount. No limitation of any amount. But when you talk about the other mode of offline payment, which is your cash or check or demand draft, which is otherwise called as OTC, over the counter payment. So when you talk about OTC, that means cash, check or demand draft. That also can be made. This is another mode of offline payment that also can be made, but there's a limitation. The amount should be up to 10,000 per challan per tax period. The tax period is monthly, per month. If it is quarter, per quarter. 10,000 per challan per tax period. But this restriction of 10,000 per challan per tax period is not applicable in cases where the payment is to be made by government department, because government is also liable to pay GST. It is also not applicable for persons notified by commissioners. These two are the persons, government department and notified persons by commissioner. Plus, it is not applicable in cases where assessee is not going and making the payment on his own. The payment is forced by the department. So when you're talking about recovering outstanding dues by the officer, proper officer during investigation or enforcement is demanding the payment to be made, or there is an ad hoc deposit demanded by the proper officer. So when officer is asking you to make the payment, even though you're making the payment by way of cash, demand draft or check, there's no limitation of 10,000 per challan per tax period. If you yourself are making the payment, there is a restriction of 10,000 per challan per tax period. So for whom all this OTC restriction is not applicable? Person, situation. Person is government department notified person. Situation. When officer is demanding the amount. When assessee is not himself paying the amount, when officer is demanding the amount, this restriction of 10,000 per challan per tax period is not applicable. This SWIFT payment, which was there for OIDR, now it is removed. There is no such facility now available for OIDRs. Initially it was available, but now it is not available for these special categories. Now when you look at all the categories, all the different points of your liability ledger, cash ledger and liability ledger, credit ledger and cash ledger, we are done with it except for one point of your cash ledger. Credit ledger is a kind of flexible ledger because it has got a sequence. First use IGST credit for IGST output, then for CGST output, SGST output, any ratio, any proportion. Then CGST credit, CGST output, IGST output. Then SGST credit, first for SGST output, then for IGST. But when you talk about your cash ledger, there are totally 20 pockets, 4 major heads. What are the 4 major heads? IGST, CGST, SGST or UTGST as the case may be, and compensation cess. 4 main pockets. In each of these main pockets, you'll have tax, interest, penalty, late fees, any other amount. In each of these major heads. So totally there will be 20 pockets. Totally there will be 4 multiplied by 5. Totally there will be 20 pockets. So in IGST there will be 5 minor heads. CGST there will be 5 minor heads. SGST there will be 5 minor heads. Compensation says there will be 5 minor heads. But the difficulty here is you cannot cross utilize it. If at all you have to pay CGST penalty, the amount should be there in CGST penalty cash ledger. If you have to pay IGST tax, the amount should be there in IGST tax cash ledger. If after you pay SGST interest, there should be an amount there in SGST interest cash ledger. See, one is your liability and one is your cash ledger. It is one-to-one utilization. It is one-to-one utilization. Your cross utilization is not possible. So your cross utilization is not at all possible. But government realized later on that though cross utilization is not possible, you have to give them a facility so that they can transfer from one pocket to another pocket and discharge their liability. So if at all you have amount in CGST, tax, cash ledger, and you have to pay SGST, interest, liability. Assume that this amount is say 1 lakh and you have to pay SGST interest liability of 80,000 or let us say 80,000. How you have to do it? Direct utilization is not possible. What is your step number 1? Transfer the amount from CGST, tax, cash ledger to SGST, interest. You cannot transfer it to SGST tax because even SGST tax cash ledger cannot be used for paying SGST interest liability. To that extent, even SGST tax cash ledger cannot be used for paying SGST interest liability. Even that is not possible. Even within the major head, utilization of minor heads is not possible. So you have to transfer to SGST interest cash ledger. How much you are going to transfer? You require only 80,000. The requirement is only 80,000. So you are going to transfer 80,000. So what will happen? The amount from CGST tax cash ledger will reduce from 1 lakh to 20,000, and suddenly there will be an amount which is there in SGST interest cash ledger, which is 80,000. Now, can I use SGST interest cash ledger for paying SGST interest liability? Yes. So step number 2. What is the step number 2 that I am going to do? I am going to use my SGST interest cash ledger amount, which is 80,000, to set off my SGST interest liability. SGST interest liability. I will set it off. Now, first step is not payment. First step is mere transfer. transfer from one cash ledger to another cash ledger. Second step is payment, or otherwise called as set off. Second step is discharge of liability. So what will happen finally? What will happen finally? My SGST interest cash ledger will become 0. My SGST liability, interest liability will also become 0. I am going to make the payment of my SGST interest liability. And finally, I will have a balance of CGST tax cash ledger of 20,000. Two steps. One, transfer from one pocket to another pocket. Second, payment of your liability. But when you are transferring it, now comes the scenario of section 53A. That is transfer from one government to another government. Initially, you have paid this amount of 80,000 to central government. Let us not focus on 20,000 because 20,000 still remains. Initially, you have paid this 80,000 to the central government. But finally, this amount was set up for paying your state government liability. Now, state government is telling that my liability has become 0, but I did not receive anything. State government's liability has become 0. State government's SGST interest has become 0. But in fact, state government did not receive anything. So, there will be a back end transfer by the central government to the state government of the amount of 80,000 rupees. That is nothing but section 53A. Why? Again, I will tell this logic, very simple logic. State government's liability of 80,000 has become 0. But the fact is, this 80,000 was never received by state government. This was received by central will pay to state. So, this will happen when it is between CGST, SGST or SGST, CGST or IGST, SGST or SGST, IGST. It will not happen when you are talking about C and I. Because for the time being, C and I payments are always with central government. It will happen only when it is between C and S or INS. C and S or INS. Not always in the first step there will be transfer. Only if it involves C and S or I and S, there will be back end transfer. There will be back end transfer. So that's all about this payment. Now they have brought out a new provision, an advanced version of this, telling that if at all you are having multiple registration, you can transfer cash ledger amount from one GST number to another GST number. From one GST number to another GST number. But that's a catch. The transfer can be possible only from C and I. S is not possible. C and I. S is not possible. See, if it is within, this was example, this was within the same GST number. Within the same GST number, you can transfer it from C to S, S to A, S to C, C to I to C, or you are talking about I to S, S to I. Anything is possible. Within the same GST number, transfer from any head to any head is possible. Yes, but back end transfer will happen only if it involves CNS or INS. But anything to anything is possible. Transfer from any head to any head is within the same GST number. But if it involves two GST number, what is the restriction? Transfer is possible only between C and I. S cannot be involved. Are we talking about two GST number of multiple persons or two GST number of the same person? Two GST number of the same person. So you are talking about two GST number of the same person, say VP Limited. You are talking about distinct person. You are talking about distinct person. Even then, though there is a restriction that it can be transferred only between C and I, finally you can plan it. I am not going to elaborate the answer in detail, but if I am telling that you have SGST, this supposing GST number 1 is that of Tamil Nadu and this is that of Maharashtra. Supposing you have SGST tax cash ledger of 1 lakh in Tamil Nadu and you have to pay SGST interest liability in the state of Maharashtra, same 1 lakh. Directly S to S transfer is not possible. Between two GST number, it is evidently clear that transfer will be allowed only if it is C and I. C and I. So what are you going to do? First, in the same GST number, you will transfer it from SGST tax to CGST tax. Assume, or IGST tax, whatever it is. Assume that we have transferred it to CGST tax. So, Tamil Nadu SGST tax to Tamil Nadu CGST tax. When SGST to CGST is happening, back end transfer will be there. Tamil Nadu state government will give to central government. Second, CGST tax of Tamil Nadu to CGST tax of Maharashtra. Nothing, no back end transfer. Third, CGST tax of Maharashtra to SGST interest of Maharashtra. SGST interest of, now when it is CNS back end transfer, central government will give to Maharashtra state. Initially Tamil Nadu state gave to central government, now central government will give to Maharashtra state. Fourth set off. Close the liability. Because finally you have received the amount in SGST interest cash ledger that of Maharashtra. So use that cash ledger to discharge your liability. So there will be multiple steps. What was the first step? Within Tamil Nadu, transfer it from SGST tax cash ledger to CGST tax cash ledger. Within first GST number, within GST number 1. So back end transfer will happen because it involves SNC. So Tamil Nadu state will make the payment to central government 1 lakh. Then CGST tax cash ledger of Tamil Nadu to CGST tax cash ledger of Maharashtra. No back end transfer. So now amount has gone to GST number 2. Then CGST tax cash ledger to SGST interest cash ledger of Maharashtra. Back end transfer. Central government will give to Maharashtra state. Finally, fourth step is set off. First 3 steps are transfer. First step is transfer within the state of Tamil Nadu. Second is Tamil Nadu to Maharashtra. Third is transfer within the state of Maharashtra. Fourth step is set off. That is very much possible. So that is everything about your all the ledgers, be it your liability ledger or your credit ledger or cash ledger. For every item hitting your credit ledger, cash ledger or liability ledger, there will be a unique identification number created on the portal so that you can track it. If at all in case of any technical glitches, you can track the same. And if at all there are any charges by the bank for making the payments, that charges has to be borne by the taxpayer, not by the government. And finally, the most important provision of payment chapter, which is interest on late payment. If you see the provisions now, we are done with 49, 49A, 49B, 53A. All the other provisions are done with. The only provision which is left out is your section 50 interest liability. Now break your interest liability into 2 parts. One, interest is on late payment of taxes, delayed payment of taxes. Second is your wrong availment and utilization of ITC. The first provision is discussed in section 50 subsection 1 and section 50 subsection 2. The second is discussed in section 50 subsection 3. So when you talk about the first scenario, let us only focus on the first scenario. In the first scenario, if at all it is a case where officer has found out that liability in terms of section 73 or 74 notice, or it is a case where the liability is of 1 month but reported in another month. Liabilities of 1 month but reported in another month. Not next month, we'll write it as another month. Third, balance. What is balance? Balance means it is neither 73 case nor 74 case plus in this scenario liabilities of 1 month reported in the same month. In the first two cases, your interest always involves 3 amounts, correct? Principal, rate and the period. So what is the principal amount? In the first 2 cases, your liability will be on gross output tax, which means without reducing your ITC. If your gross output tax is 10 lakhs and input tax credit is 8 lakhs, your interest will not be on 2 lakhs. Interest will be on 10 lakhs. Interest will be on 10 lakhs. Including a case where 1 month liability you missed out in that month and you're reporting in other month, interest will not be on, supposing April month's liability you reported in December month. April month you have output of 10 lakhs and input of 8 lakhs, but you report that in December month. Interest will not be on 10 minus 8 lakhs. That is 2 lakhs. Interest will be on entire 10 lakhs. So it is on gross output tax liability multiplied by 18% per annum multiplied by number of days of delay. What is the starting date of delay? From the next date of due date of payment. From the next date of due date of payment to the actual date of payment. To the actual date of payment. Due date of payment is generally your due date of return filing. Normal scenario. Your due date of payment is generally your due date of return filing. Whatever is your due date of return filing will be the due date of payment. There are only two exceptions. Composition scheme and QRMP scheme opted by RTP and CTP. In that scenario, for composition scheme dealer, your due date of payment is quarterly payment after within 18 days, which means for April to June, July 18th. Interest will start from 19th July. For July to September, 18th October. Interest will start from 19th October. So there payment is quarterly, but return filing is yearly. Second, QRMP scheme. There payment is monthly, but return filing is quarterly. QR, quarterly return. MP, monthly payment. There payment for the first month of the quarter and second month of the quarter will be on 25th of the next month, which means April means 25th of May. May means 25th of June. And June month it will be 22nd or 24th of the next month, which means June month it will be either 22nd of July for the southern part of India and 24th of July for the northern part of India. Right. So only in these two cases your due date of return filing is different from due date of payment. All the other cases, whatever is your due date of return filing is your due date of payment. Right. So what is your interest liability on? Gross output tax multiplied by 18% multiplied by period. So it will start from the next date of due date of payment till the actual date of payment. Now, what is the only change in the last scenario? When it is a normal case, it is not a case started by officer, and 1 month liability you report in the same month but after due date. Very normal case. April month liability you are reporting in April month, but you have filed your return and made your payment late. You have made your payment of taxes and filed your return late. It is not filed within the due date. It is the due taxes is not paid within the due date. Then interest is on net output tax liability, which means if your gross output tax is 10 lakhs and input tax credit is 8 lakhs, interest will be only on 2 lakhs. Interest will be only on multiplied by tax rate of interest 18% per annum multiplied by the period. Again same, next date of due date of payment till the actual date of payment. You will have to find the number of days divided by 365. That is your interest. That is your interest when you talk about your delayed payment of taxes. Delayed payment of taxes. When you have made the payment of taxes belatedly. Right. Normally, it will be your net output tax liability, because normally what will happen? It is not a case started by officer section 73-74 case. It will not be a case of 73-74. Plus, it will be a case where 1 month liability you report in the same month. 1 month liability you report in the same month. You file that transaction in the same month return. April month transaction are reported in April month return, but they are reported after the due date. You have missed the deadline. Lot of associates will miss the deadline, right? So they will come in which category? They will normally come in the net output tax category. That is net output tax multiplied by 18% per annum multiplied by the period. Next date after the due date of payment till the actual date of payment. Now what if there is wrong availment and utilization of ITC? What in that scenario? What in that scenario? understand that in that case, your interest will be there not because of wrong availment, it will be because of wrong utilization. It will be because of wrong utilization. So the principal amount will be ITC, which is wrongly utilized. Supposing I avail wrong ITC and utilize in the same month, interest will start in the same month. Interest will start in the same month. Supposing I have taken wrong credit of 10 lakh of my car, which is not eligible. But I have excess credit anyways. I don't utilize in the same month. I utilize after 4 months or 5 months or 9 months or a year or 2 years. Interest will not start from the date of wrong availment. It will start from the date of wrong utilization. Wrong utilization. The maximum interest rate is 24%, but the applicable interest rate here also is 18% per annum. 18% per annum. Now the from date. What would be the from date? From date depends. To date is simple. To date is simple. Till date is actual date of payment or actual date of reversal by whatever name you call. So till date is always simple. Actual date of that payment or reversal. Actual date of that payment or what is the from date? What is the from date? From date will be depending on how you have taken that particular credit. It will be depending on different situations. Right? When that wrong utilization happened. If that wrong utilization happened by filing a particular return, then that is a different answer. If that wrong utilization happened by discharging your liability through a challan, then that will be a different scenario. See, understand that from date is something based on utilization when you have wrongly used. Correct? Correct. Assume that April month you have wrongly availed the credit, but that was utilized while filing December month return. That was utilized while filing your, what is the meaning of that? From April to December, you had credit balance more than what you have wrongly availed. You had credit balance more than what you availed. Only in December month, your credit balance was lesser than what you wrongly availed. So, if at all it is because of filing your December month return. April month, you have wrongly availed your credit, but utilization happened while filing your December month return. So, if it is because of, if utilization happens while filing your return, then it is actual date of that return or due date of that month's return, whichever is earlier. Whichever is earlier. Which means, in our example, if I have taken wrong credit in the month of April, but that was wrongly utilized only in the month of December, it means December month's actual date of return filing or due date of return filing, whichever is earlier. Whichever is earlier. If that could be other scenario. I did not file my December month return. There was a notice served on me by the officer. I wrongly availed the credit in the month of April. Let us keep the same. But I utilized it. When I got the notice, I accepted my liability and I am making the payment. I am discharging the payment now by filing a challan, voluntary challan, DRC 03 challan. Say for example, I am making the payment by way of DRC 03 challan, voluntary payment. Voluntary payment. Now, somewhere in the month of December or Jan, I am paying the old dues. I am paying the old dues because of the notice being served and I am accepting my liability. While making the payment of old dues, I utilize that wrongly availed credit. Because my old dues also I can pay it by credit ledger. If you remember when we have discussed your liability ledger, all your liability, whether assessed by assessee or assessed by officer. If it is tax liability, I can use my credit ledger. So while discharging my old liability, by when filing my DRC 03 challan, I have utilized that wrongly availed credit. So if a utilization happens because of voluntary payment, then it is date of voluntary payment. Date of voluntary payment. One thing you clearly need to understand is wrong availment is not an issue. What is an issue? Wrong utilization. Government will lose the revenue if you have wrongly utilized the credit. If you have taken credit of 1 crore rupees wrongly have taken credit of 1 crore rupees, but you don't use it, government is not having any problem. We will stick to our example where wrong availment happened when? Wrong availment happened in the month of April 2023. Wrong utilization happened in the month of December 23. So, problem is only December month. Interest will start somewhere in December month. If that wrong utilization happened in December while filing a December return, then interest will start from actual date of December month return filing or due date of December month filing, whichever is earlier. If in December month I wrongly utilize the credit while making the payment of old dues by a voluntary challan, which is DSC03 challan, voluntary payment challan, DSC03 challan, then interest will start from the date when I made the voluntary payment of old dues. Voluntary payment of, so what is the two time? Till date is very simple. Till date is actual date of payment. Till you actually close that reversal. Till you reverse that wrong ITC. Interest will continue till you correct your mistake. So till I do the reversal, I may do the reversal somewhere in November 2024 or somewhere in Jan 2025 or somewhere in the month of November 2025. So interest will continue till that. And one more thing, please understand. Once I have wrongly utilized it, otherwise you will think once I wrongly utilize it and again my credit balance comes up, nothing will happen with interest. Interest will continue. That coming down and going up has got no impact. Once it has come down, interest will start. Thereafter, immediately in the next month, the credit balance again shoots up. That will not change my interest. My from date is freezed. At times, interest will be calculated in two parts. I wrongly availed the credit of 1 lakh. 25,000 utilization happened somewhere in December. And balance 75,000 utilization happened somewhere in April. So 25,000 interest calculation will be separate. 75,000 interest calculation will be separate. So that also you need to understand. So this is about your interest on late payment. 3 parts you need to remember. Principal, then your rate of interest, which is always 18%, and then the period. The issue or the challenging portion in this entire discussion was all about section 50 subsection 3. You need to understand that when you're taking wrong credit, that is not a problem. Issue is only when you wrongly utilize your credit. So principal amount is ITC wrongly utilized. Rate is 18% per annum. And period, your from date will be depending on when you have utilized it. If the utilization happened while filing your return, it is actual date of that month's return. In our example, December month return or due date of December month return, whichever is earlier. If the wrong utilization happened because of voluntary payment of old dues, then it is the date of voluntary payment because you have closed it. There is no if and but. You have closed your voluntary payment. So from date is that. And always remember that your to date in any of the cases is always actual date of payment. Your to date in any of the case is always actual date of payment. Always. Any case, till date is actual date of payment. Your till date will always remain the same. Be it your section 50 subsection 1 and section 50 subsection 2, where it depends whether it is on gross output or net output. Till date is always actual date of payment. Or be it section 50 subsection 3, wrong availment and wrong utilization of ITC, it is always actual date of payment. In ITC case, it may not be actually payment, it may be reversal. If you have credit, you will reverse it. If you don't have credit, you will make the payment. So till date is not a problem. Problem is the from date, and problem is the from date only specifically when you talk about your wrong availment and wrong utilization of credit. So that's it about your interest. A very important concept, interest, in this entire chapter. This happens to be a very important concept, and repeatedly ICAI keeps asking questions about your interest. So when you're talking about return filing, what we'll do is we'll see a master summary chart. We'll be splitting that into two discussions. There will be two master summary charts. And we'll try to see most of the concepts of all the different types of your return filing. Now when you talk about your regular taxable person and your casual taxable person, for return filing purposes, they'll be having the same types of returns. Basically, they'll be filing their GSTR1 or IFF if they are under QRMP scheme, and followed by the main return called as GSTR 3B. 2A, 2B as already discussed in your ITC chapter. I will not be spending again the same time in 2A, 2B. They will be getting their details of input tax credit in GSTR 2A, which is dynamic, keeps changing, and ITC will be availed not on the basis of 2A, it will be availed on the basis of 2B, which is a static report. Right, they will not file it, it will be coming automatically on their portal and they have to verify and take the credit based on GSTR 2B. 2A will be used when they are filing their annual return. So what are the returns that will be filed by your regular taxable person and your casual taxable person? GSTR1 at times, IFF if you are under QRMP scheme for the first 2 months of the quarter, and GSTR 3B. GSTR 3B. So when you talk about GSTR1 and GSTR 3B, in regular taxable person and your casual taxable person, you have two options. Either you can go for the normal scheme, which is MRMP scheme, monthly return, monthly payment, or you can go for QRMP scheme, which to my understanding will be scrap soon because it is of no use, no benefit, though they think that they are giving a benefit. But in fact, if you see, the work is more in QRMP compared to your MRMP, because again and again you have to reconcile what you have done already in the first 2 months. Nevertheless, for your exams, you have two schemes, QRMP and MRMP. Now, when you talk about your different returns and payments in MRMP scheme, you won't have IFF, but still I will be writing what is the due date of IFF. Then you will have GSTR1. Payment will be always there, followed by GSTR 3B. Here also let us write IFF, GSTR1, payment which is followed by GSTR 3B. In your MRMP scheme, there is no concept of IFF. Let us take the months as say April, May and June to understand the concept as well as the due dates. April, May and June. So when you are talking about April, May and June, in your MRMP scheme, you will not have any IFF. So for April month, GSTR1 will be 11th of May. Payment and GSTR 3B both together same due date, 20th of May. So you have to first make the payment followed by GSTR 3B. May month, GSTR1 your sales report. 1 is only a sales report, a outward supply report. 3B contains your sales details with output tax, purchase details, that is corresponding ITC, and the net payment. So final details are contained in your GSTR 3B. So May month, GSTR1 11th June, and payment and GSTR 3B is 20th June. June month, again there is no IFF, 11th July, and payment and GSTR 3B 20th July. For your QRMP scheme, which not everyone can opt, only certain assessees can opt. When you are talking about your QRMP scheme, what is the criteria? What is the limit? Now understand that limit is 5 crores. If you are lesser than 5 crores, you can go. What will be the due dates first? Understand that you will have now IFF also. So April, May and June. April month you will have IFF, the due date of which will be 13th of May, not 11th. There is no GSTR1. Payment will be there, but it will be on 25th of May. There is no GSTR 3B. May month, there is no GSTR1, there will be again only IFF. IFF, invoice furnishing facility, is nothing but mini GSTR1. Mini GSTR1. So it will be 13th June. There will be no GSTR1. Payment is 25th 25th June, there's no GSTR 3B. Then in June month, there will not be any invoice furnishing facility. For the entire quarter, you will file GSTR 1, which is 13th July. Whatever was not reported in IFF or missed in IFF, or you might not even file IFF, everything will be again finally reported in GSTR 1 if not reported. If already reported, it will not be repeated again here. And when June is over, this is for entire quarter. When June is over, you will be making the payment and 3B. Again, this will be happening for the entire quarter, both payment and GSTR 3B. This will be there on 22nd or 24th of July, both payment as well as 3B. Whatever payment you have made, if there is a balance payment, that will be made, and 3B will be filed for the entire quarter, 22nd or 24th July, 22nd for the southern part of India, 24th for the northern part of India, both payment and GSTR 3B. Here it is both payment and GSTR 3B, 22nd or 24th of July. Again, it is for the entire quarter. Right, these are the due dates for your GSTR 1, IFF GSTR 1, payment and GSTR 3B. Payment and GSTR 3B. Now, let us complete the small aspects of QRMP scheme here itself. Now, can everyone enter QRMP scheme? Who can enter QRMP scheme? Who can enter QRMP scheme? First, let us talk about QRMP scheme, entry point and exit point. QRMP scheme, entry point and exit point. Is this scheme open for everyone? No. It is applicable only if your previous year aggregate turnover is up to 5 crores. Pan India turnover, aggregate means Pan India turnover is up to 5 crores. Right. So that is the first criteria for the entry scheme. There is another criteria. You have to opt in a particular time. What is that particular time? What is the particular time? First day of the second month of previous quarter. Last day of the first month of current quarter. Supposing you want to opt for QRMP scheme for October to December 2024. So what is the opt-in time? First day of second month of previous quarter. So previous quarter is July to September. What is the second month? August. So 1st August 2024 to what is the last date? What is the last date? Last day of the first month of the current quarter. What is the last date of the first month of the current quarter? It is 31st of October 2024. That is the opt-in time. In this period you have to opt in. In this particular period you have to opt in. And it is that does not stop here. When you are opting in, you should not have any pending returns. In this time gap, whenever you are opting in, supposing you are opting on 25th of October, your September return should have been filed. Supposing you are opting on 5th of August. 5th of August, whether July return has become due? No. So your June return has to be filed. If you are opting on 5th of August, what return has become due? On 5th of August, whether your July return is due? No. But whether your June return is due? Yes. Your June return should have been filed. Supposing you are opting on 25th of October, whether your September return has become due? Yes. You should have filed your September return. This is your opt-in time. In that opt-in time, whenever you are entering it, make sure that you don't have any pending returns which are due. The due date of which is crossed. So when I am opting on 5th of August, my July return need not have been filed because due date is yet to come. But my June return should have been filed. Right. So these are the three criteria for entry. These are the three criteria for entry. What are the three criteria? Previous year aggregate turnover should be up to 5 crores. There is an opt-in window. That opt-in window tells that first day second month, previous quarter, last day, first month, current quarter. In that opting period, you have to select. And when you select, make sure that you don't have any pending returns. Make sure that you don't have any pending returns. Now, also other special points that you need to remember, that if at all you're opting for QRMP scheme, one GST number, you can go for QRMP. Another GST number, you can go for MRMP. Please do not confuse this with composition scheme. You are under regular scheme. You are under regular scheme, because QRMP scheme is only available for regular scheme dealer being RTP and CDP, regular taxable person and casual taxable person. So for one GST number you can go for QRMP scheme, another GST number you can go for MRMP scheme. MRMP scheme. Second special point, this opt-in is there only for the first time. Thereafter, by default, you're inside. Every time you need not tell. Even if the year changes, by default, you're inside. Only for the first time entry, this is applicable. These two conditions are applicable only for the first time entry. Thereafter, by default, you're under QRMP scheme. You need not do it every quarter. Even if the year changes, by default, you're inside QRMP scheme. By default, you're well within the QRMP scheme. That is the entry point. All the special points of entry. 3 conditions of entry, 2 special points of entry. What are the 2 special points of entry? When you are entering, it is not necessary that you have to enter for all GST number. One GST number, in one state you can go for QRMP, another state you can go for MRMP. Second special point is opting in criteria. That second and third condition, that you have to opt in a window and make sure that there are no pending returns. That is only applicable for the first time. Thereafter, by default, you are under. If you have gone for QRMP once, by default, you are inside QRMP scheme. By default, you are inside QRMP scheme. Now, your exit. Either it will be voluntary exit. You don't like the scheme, you are going outside, or your current year aggregate turnover has crossed 5 crores. Current year aggregate turnover has crossed 5 crores. Whenever you are going outside, again, whether it is a voluntary exit or whether it is your current year aggregate turnover has crossed 5 crores, make sure that you opt out. You opt out in a particular window. Supposing this is happening from, exit is to be done from, say, July 2025 to July 2025 onwards. It is not September now. July 2025 onwards. What is the window? Opt-out window. What is the opt-out window? Same window. First day of second month of previous quarter. What is the previous quarter? April to June. So 1st of May 2025 to last day, first month, current quarter. 31st of July 2025. 31st of July 2025. But there is a special point. Whenever you are opting out, whether it is voluntary opt-out or forceful opt-out, because your current year aggregate turnover has crossed 5 crores. There is a window you have to opt out. But remember that if your turnover has crossed 5 crores in a particular quarter, you are thrown out from the next quarter. Not immediately. Not immediately. When your current year turnover, supposing your current year turnover crosses 5 crores somewhere in May, initially itself it crossed. You are not thrown out immediately. You will be thrown out from the next quarter. You will be thrown out from the next quarter. Not immediately you are thrown out. Next quarter. Again, it is not like composition scheme that immediately you have to go outside. You are thrown out from the voluntary opt-out, means from you have decided that from next quarter you are not interested. Compulsory opt-out means your turnover has crossed 5 crores. But when your turnover crosses 5 crores, not immediately you are going outside. Supposing your turnover crosses 5 crores in, say, November. So October to December you can still be under QRMP scheme. You are going outside only from Jan. Only from next quarter. Only and only from your next quarter. These are all the points for entry and exit. Entry and exit. The conditions as well as the special points. Not only the conditions but also the special points of the entry and your exit from your QRMP scheme. Now, when you are inside QRMP scheme, what are the returns that you are going to file? for your outward supply, only for your outward supply, IFF versus GSTR1. Those are the returns that you file for your outward supply. Now, what is the difference? In IFF, first of all, is optional. GSTR1 is mandatory. IFF cannot be filed after due date. GSTR1 can be filed even after due date. As IFF cannot be filed after due date, there cannot be any late fees. Obviously, GSTR1 can be filed after due date, there will be late fees. There will be late fees. Even after due date, you can file, and therefore there will be late fees if you are filing after the due date. IFF is there only for what all months? It is there only for the first 2 months of the quarter. GSTR1 is for the entire quarter. GSTR1 is for the entire quarter. In IFF, you can report only B2B supplies, and that too with a limit of 50 lakhs. That too with a limit of 50 lakhs. Here you can report B2B as well as B2C. Obviously, there is no limit. Unlimited. No limit. See, IFF is basically given so that your customer can take the credit. Your customer will get that in GSTR 2B and he can take the credit. So it is only for B2B. That too there is a restriction 50 lakhs. I don't understand why they have put this restriction. It makes sense to report only B2B. But it really does not make sense to have a limit of IFF. Only up to 50 lakhs. Only up to, supposing B2B in first month, April month is 60 lakhs. You have to select among the customers who will disturb me, who will not disturb me. Then you have to select 50 lakhs and put. And exactly 50 lakhs will not be used. Because your invoices will never count exactly to 50 lakhs. It might be say 49 lakh 95,999 or 45 lakhs 95,695. It will never touch exactly 50 lakhs. Correct? Up to 50 lakhs. You will never get a number exactly 50 lakhs. Maybe at times it will be 47 lakhs, 95,000 because the next invoices are all more than 3 lakhs. You cannot select them. You cannot select them. Right. So this is only up to 50 lakhs. So whatever, now your question will come. So what if it is not reported in IFF? Don't worry. Whatever is left out, report in GSTR1. Will you be repeating those what is reported in IFF? No. Whatever is reported in IFF will not be again reported in GSTR1. But whatever was left out in IFF, B2C was totally left out in IFF. It will be fully reported in. So B2C for all the 3 months will come in GSTR1. But B2B, whatever was reported in IFF will not come in GSTR1. Whatever was not reported in IFF will come to. You may have decided for a particular month you are not going to file IFF, or you have crossed the due date, because after due date you cannot file IFF. After the due date has gone, you cannot file IFF. In that case, you cannot do anything, and you have to wait for GSTR1 and then file at the time of GSTR1. So whatever was left out will be then reported in your GSTR1. So these are all the differences when you talk about your IFF versus GS. Both of them can be amended. Amendment is possible in both of them. Some mistake is there, you can amend it. So amendment is possible in both of them. The differences between your IFF and your GSTR1. And obviously, needless to say, IFF is only available for a person who is going for QRMP scheme. Obviously, GSTR1 is there for QRMP scheme, quarter or MRMP scheme. So it is not for entire quarter always. It can be for that month. If you are under MRMP scheme, it will be only for a month. This I have compared IFF versus GSTR1, thinking that you are only under QRMP scheme. Right. Now, we have discussed first about your entry and exit. Then we have discussed about your outward supply, difference between IFF and GSTR1. Now comes the final part. What is the final part? Payment and GSTR 3B. Payment, GSTR 3B is simple. Finally, you will report everything in your final GSTR 3B. But what about payment? Payment. What are the due dates for payment? What are the due dates for payment? Supposing you are talking about the month of April, May and June. And supposing you have output tax in April, output tax in your April is say 10 lakhs, ITC is 8 lakhs. In May month, output tax is 6 lakhs. ITC is 3 lakhs. In June month, output tax is say 7 lakhs. And ITC is say 6 lakhs. For the first 2 months of the quarter, what is the due date, by the way? What is the due date? We have already discussed the due date. For the first month, 25th of May. For the second month, 25th of June. For the third month, 22nd for the southern part of India, 24th for the northern part of India, July. 22nd or 24th of July. So due dates we have discussed. Now we are talking about options of payment. Options of payment. Now understand that when you talk about your first and second month, you have two options, either fixed sum method or self-assessment method. Either fixed sum method or self-assessment method. You can opt either or. Either or. Now for this I need to have an information that what I was doing in the previous quarter. What I was doing in the previous quarter. Assume, what was my previous quarter, by the way? My previous quarter is Jan to March. Assume that in my previous quarter I was working under QRMP scheme and my total cash payment, my total cash ledger payment is say 6 lakhs. Is say 6 lakhs. Total payment by way of cash is say 6 lakhs. Now, that is required because I need to understand how I am going to work out an fixed sum method scheme. In fixed sum method scheme, it tells that if under your previous quarter, and it should be a complete quarter, special points we will discuss finally. If it is in your previous quarter, you are under QRMB scheme, the calculation will be 35% of what amount you paid by cash in the previous quarter. 35% of what amount you paid by cash in the previous quarter. For the last month, you don't have fixed sum method. This option is available only for the first 2 months. Now, what is the amount that you will get? 35% of cash paid in previous quarter. What is the amount that you have paid in previous quarter? 6 lakhs. What is 35% of that amount? 6 lakhs multiplied by 35%? 2 lakh? 2 lakh? 2 lakh 10,000, or what is the self-assessment method answer? 10 lakhs minus 8 lakhs. What is the answer? Which one you are going to select? Self-assessment method. So obviously you have an option to select any one of them, but logically speaking you will go for 2 lakhs. What about the second month? What about the second month? What is 35% of 6 lakhs? 2 lakh 10,000. And what is the other self-assessment method? It gives you 6 lakhs minus 3 lakhs, which is now which one is beneficial for you? Correct. Because now this payment is lesser. This payment is lesser. For the first 2 months, you have an option to go under fixed sum method or self-assessment. Self-assessment method is nothing but output tax minus input tax credit. What is fixed sum method? That's a percentage. If in your previous quarter you are under QRMP scheme, then it is 35% of cash payment in the previous quarter. If in your previous quarter you are under, this is applicable in your previous quarter, you are under QRMP scheme. If I tell in your previous quarter you are under MRMP scheme, then this answer would have been 100% of cash paid in last month of the previous quarter. So what was the last month of your previous quarter? March month. Because in your previous quarter, if you are under MRMP scheme, you would have made the payment on monthly basis. What is the last month of the previous quarter? March month. What is March month cash payment? Take the March month cash payment. What was the amount? Take 100%. Why? your foundation is month and your payment is also month. But in this example, I have taken your foundation, your base is quarter, but you are making the payment for a, when your base is month and you are making the payment of month, 100% of cash payment made in last month of the previous quarter. But when your base is quarter, but you are making the payment for a particular month, be it April month or be it May month, it is 35% of cash payment what was done in your previous quarter, because you have paid for the entire previous quarter. Right. Now, understand that this fixed sum method depends, the percentage depends on what you did in the previous quarter. Previous quarter it was under QRMP scheme. Then for first 2 months of the current quarter, that is in our example April month and May month, you have to work out both the times independently. It is 35% of cash payment which what was done in your previous quarter. If in your previous quarter you are under MRMP scheme, then for April month and May month you have still option to go for fixed sum method. It is 100% of cash ledger payment made in March month, that is last month of the last quarter, last month of the last quarter, because the base is month and the working out is also for a month, right? But you don't have an option to go for FSM for the last month of the last month of the current quarter. This option is available only for the first 2 months of the quarter, not available for the last month. In the last month, you will be doing self-assessment method for the entire quarter. For the entire quarter. What is your entire quarter output tax? What is your entire quarter output tax? 10 lakhs plus 6 lakhs plus 7 lakhs minus what is your entire quarter input tax credit? 8 lakhs plus 3 lakhs plus 6 lakhs. So output taxes, output tax, total output tax 23 lakhs, total input tax credit 17. What is the balance payment? What is the balance payment? 6 lakhs. How much you have already paid if at all you have gone for beneficial point? How much? In assuming in April month you went under SAM method and you paid 2 lakhs, and in May month you paid 2,10,000. How much is already paid? How much is already paid? 4,10,000 is already paid. What will be the balance payment to be done in cash? What will be the balance payment to be done in cash? This 4,10,000 is paid in the month of April and May. What is the balance payment to be made? 1,90,000 is the balance payment that is to be paid by way of cash. If at all you have ended up making more payment, don't worry, apply for refund. Cash ledger refund you can apply anytime. Anyone can apply anytime. Clear? Clear? This is how you are going to do the working. And if at all April month payment, what is the due date? 25th May. If you have made the payment on 28th May, 3 days delay. Interest will be on 2 lakh multiplied by, because you have opted for 2 lakhs. So 2 lakhs multiplied by 18% multiplied by 3 divided by 365. What is the due date for your May month? 25th of June. If at all you have made the payment on 30th of June, so interest will be for on what? 2,10,000 multiplied by 18% multiplied by 5 days divided by 365. What is the last date for the entire quarter GSTR 3BN payment? Assuming southern part of India, 22nd. What is the payment that is to be made? So what was the due date? 22nd July. Assume that you have made the payment on 28th of July. 28th of July. Interest will be on what? 1,90,000 multiplied by 18% multiplied by 6 divided by. With all they ask this complicated questions, it's very simple. Okay, this is how you have to calculate the interest, because due dates have been freeze for them. Accordingly, you have to calculate the interest. Are you guys clear with this understanding? Now, certain special points. Fixed sum method is applicable only if you have a clear cut full month or a clear cut full quarter. When I tell clear cut, it should be full, complete month. If in the previous quarter you are under MRMP scheme, or complete quarter if in the previous quarter you are working under QRMP scheme. which means assuming that you have taken registration in Feb, but you're going for, so assuming that you took registration somewhere in July, somewhere in your July, January 25th, in mid of a quarter. You took registration on Jan 25th. So do you have a complete quarter? No, you don't have a complete quarter. Assuming you took registration on Jan 25th and you directly opted for QRMP scheme. Do you have a complete quarter? No, you don't have a complete quarter. You don't have a complete quarter. Therefore, you cannot go for fixed sum method. Because fixed sum method has an assumption that the reference base, either the entire quarter or the entire month of the last month of the last quarter, is a complete tax period. Assume that previous quarter you are working under composition scheme. Assume that in the previous quarter you are working under, you cannot go for fixed sum method because the base that you have is not a proper base. You are now under regular scheme, but previous quarter you are working under composition scheme. You don't have a proper base. So when you talk about fixed sum method, you should have a proper complete tax period and it should be under regular scheme. Full tax period, whether it is full quarter or month. If the previous quarter was under QRMP scheme, entire quarter. The previous quarter was under MRMP scheme, entire last month of the last quarter. It should be full. Second criteria, it should not, the base should not be that of composition scheme. It should be full plus regular. It should be full, the base should be full plus regular. The base, whether the quarter or the month, should be full and it should be under regular scheme, not under composition scheme. Otherwise, this assumption of percentage will defeat. That's everything about your QRMP scheme. How we made this simple? We first spoke about your entry exit, then your IFF and GSTR 1, and finally about your payment and your GSTR 3B. Now your entire QRMP is over. So what we have seen was written filing by a regular taxable person and a casual taxable person. All the concepts, be it MRMP and be it QRMP, we have done with your concepts of your MRMP scheme and your QRMP scheme, which is by your RTP and CTP. Then you are talking about a composition taxable person who basically will file two returns. One is CMP 08, which is quarterly payment, it's not a written filing, it's quarterly payment, and quarterly payment will happen when? After the end of the quarter. So it has got nothing to do with your written filing, it has got everything to do with your payment. So it will be this quarterly payment will be done after the end of the quarter within 18 days. So CMP 08 is all about payment. There's no question of any late fees. If this is done late, interest will come. Late fees will not come. So April to June, 18 July, July to September, 18th October, and so on. And they have to file a yearly return. That is a quarterly payment. And there's something called as your yearly return. Yearly return, which is GSTR 4. This will be, don't call it as annual return, call it as yearly return. After the year end is over, they have to file a yearly return GSTR 4, which is within 30 days, which means for a financial year, say for example 23-24, it is 30th April 2024, 30th April of the succeeding financial year, 30th April of the next financial year. So quarterly payment and yearly return. Quarterly payment and yearly return. They'll have their purchases like RTP and CTP get their purchases automated, auto-populated in GSTR 2A and 2B. We have discussed the difference between 2A and 2B. These people will get in GSTR 4A, but for them it is of no much use because anyways they cannot take any credit. Right. That is all about your composition taxable person. One important point that you need to remember is even if they are working for part of the quarter or part of the year, the due dates will remain the same. It might happen that you switch over from composition scheme to regular scheme in between of a year. Say for example, on 12th of November, between a year, you decide to switch over from composition scheme to regular scheme. You can go outside composition scheme in between a year. Don't worry. So when you are going outside composition scheme, 12th November. Now, you have 1st October to 12th November, 1st October to 11th November composition scheme, 12th November onwards. So 1st October to 11th November, still the due date for CMP 08 will be 18th of Jan. 18th of, even though it is part of the quarter, 1st October to 11th of November, still it will be 18th of Jan. Though for the balance part of the November, you will be under regular scheme. You might make the payment for the balance part of the month of November, which is 12th November to 30th November, on or before 20th of December, assuming that you are under MRMB scheme, but that will not change the situation. Even though you are working for the part of the quarter under composition scheme, CMP 08 date, due date will remain the same. The same way, in this scenario, when you are going out from composition scheme on 12th November to regular scheme, you still have to file GSTR 4 for 1st April to 11th November. For the transaction between 1st April to 11th November, your GSTR 4 yearly return due date will remain the same, 30th April of next financial year. So that is a special point that you need to remember. Even though it is part of the quarter, CMP 08 due date will remain the same. Even though it is part of the year, GSTR 4 due date will remain the same. Now, we are done with the return filing by RTP, CTP and return filing by your composition taxable person. The next person in chain is your NRTP, non-resident taxable person. They have a separate return filing. They have something called as GSTR 5. GSTR 5. Please understand that now onwards, whatever is the due date of return filing is the due date of payment. There are only two cases where due date of return filing and payment differs. What are they? One is for composition scheme, that is quarterly payment, yearly return. Other is for RTP, CTP when they are under QRMP scheme. When they are under other cases, whatever is the due date of return filing is the due date of payment. So I am not going to touch both. Same thing. Now what is the due date for NRTP? The due date for NRTP both for payment and return filing is 13th after the end of the month. Earlier it used to be 20th, now it is 13th after the end of the month or 7 days from the last date of registration, whichever is earlier. 13th after the end of the month or 7 days from the last date of registration, because they'll have temporary registration just like CTP, whichever is earlier. But there's a difference. Both CTP and NRTP will have temporary registration, but CTP will always go as per GSTR 1 and GSTR 3B due dates, but NRTP will have a separate due date. What is that due date? 13th after the end of the month or 7 days after the last date of registration certificate, whichever is. It is highly possible for the last 2 months you have the same due date. For the last 2 months you have the same due date, which means if at all your registration is from say 1st of April, valid from 1st of April to say, for example, say 5th of June. 1st of April to 4th of June. 1st of April to 4th of June. So if your registration is there from 1st of April to 4th of June, what is the April month's due date? April, May, June. For CTP, it is all about 1 and 3B. For NRTP, it is different. But first, let us understand for NRTP. For April month, what is the due date? 13th May. For May month, it is 13th June or 7 days from the last date of registration certificate, which will be 11th June, whichever is earlier. For June month, 13th July or 7 days from the last date of registration, which is 11th June, whichever is earlier. Whichever is. So you see for May month and June month transaction, that's the same due date. This will not happen with your CTP and NRTP because CTP, this will not happen with your CTP because it is going to file your GSTR 1 and GSTR 3B regular due date. For April month 1, it is 11th of May. GSTR 3B and payment 20th May. For May month, GSTR 1, 11th of June. GSTR 3B and payment 20th June. For June month, GSTR 1, 11th of July, though it is only for 4 days. And payment and GSTR 3B 20th of July. No change. No change. This is changing only for NRTP, and these due dates are not only for return filing but also for the payment purposes. There is no change in the understanding of your CTP. The due dates are just like what you are discussing in your 1 and 3B, assuming that CTP is going for MRMP scheme. The due dates we have discussed. Exactly same. No change. One more difference you need to appreciate and understand is CTP will have to file something called as final return, GSTR 10, whereas NRTP is not required to file final return. NRTP will not file GSTR 10, final return. Only CTP has to file final return. Both of them will not file annual return. Both of them will not file annual return. For both of them, annual return concept is not applicable. Though CTP and NRTP have a common concept called as temporary registration, but the written filings are separate. For CTP, it is GSTR 1 and GSTR 3B, the normal due dates, even though it is part of the month. For NRTP, it is different, GSTR 5. And the due date is 13th of the next month or 7 days from the last date of registration certificate, whichever is earlier. There is very high possibility for the last 2 months, the due date is it's not always the same. Possibility is that. There is a possibility where it might be the same. Now, when you talk about the other returns, we are talking about GSTR 5A, which is applicable for OIDARS, who is working from outside India, who is supplying online information and database access and retrieval services from outside India to non-taxable online recipient, which means unregistered non-business persons. Unregistered non-business persons. Right. GSTR 5A will be the return filing, and the due date of payment and return filing will be the same as already discussed. It was now the same. It is always the same. 20th of the next month. For April month, 20th of May. May month, 20th of June. July month, 20th of July. So on, so forth. So it will be 20th of the next month. Both for return filing as well as for the payment purposes. But if at all you are supplying online information and database access and retrieval services from within India, you are supplier in India. For you, it is GSTR 1 and GSTR 3B. So that is all about your GSTR 5A. GSTR 6 happens to be for your input service distributor, where head office, which is ISD, will distribute the credit to the branches. It will take the credit of common input services, then distribute to the branches on basis of pro rata basis. The concept of which is there in your ITC chapter. Take the credit, distribute the credit. Take the credit, distribute the credit. This concept is common when you have multiple GSC number and you have common input services pertaining to multiple GSC number. So you have to take another registration called as ISD. Take the credit of common input services and distribute the credit to the branches. Distribute the credit to the branches. So it has to file a return. Please understand that ISD will never ever make any payment. It will never ever make any payment. It will take the credit, pass on the credit, take the credit, pass on the credit, take the credit, pass on the credit. So there's no question of any due date of payment. It is only due date of return filing. Due date of return filing, which happens to be GSTR 6 after the month is over 13 days. So for April month, 13th of May, May month, 13th of June, June month, 13th of July. The only purpose of ISD is to book the credit of common input services of that company and distribute to its branches different GSC number. Take the credit, distribute the credit. Take the credit, distribute the credit. There's no question of any payment, and they'll distribute the credit on or before 13th of the next month. So for April 13th May, May 13th June, so on, so forth. And their purchases, they will distribute the credit. How they'll get the credit? They'll get it from the supplier. Those suppliers, when they are filing their GSTR 1 IFF, that will come and sit in ISD's GSTR 6A. ISD's GSTR. If you are a regular taxable person, casual taxable person, your purchase information automatically will come and sit in 2A, 2B. 2A, if you are a composition taxable person, it will automatically come and sit in 4A. If you are ISD, it will come and sit in automatically in 6A. Right. So that is the information. You are not going to do anything. You are going to get that information automatically. Then you have a concept called as TDS and TCS. TDS is to be filed by government or government undertakings. TCS is to be filed by electronic commerce operator through whom the supplies are being made by the supplier. TDS by government, TCS by electronic commerce operator, and their return filings are GSTR 7 and GSTR 8 respectively. And for them, due date of return filing as well as due date of payment. They are not like ISD. They'll make the payment. For them, you'll have both payment and return filing. For ISD, there is only return filing because they take the credit, pass on the credit, take the credit. But for TDS and TCS, you have payment and return filing. And the due date for them is 10th of the next month. 10th of the next month. So for April month, 10th of May. May, 10th of June. June, 10th of July. So on. The person who's making the payment of TDS and TCS has to pay it by cash. The opposite person will get that in his cash ledger. The opposite person will get that in his cash ledger. Then you have something called as your annual return, which is GSTR 9, 9A, which is a ghost no one has ever seen. So don't expect any questions on 9A. GSTR 9, 9A, 9B. 9 is for a regular taxable person, 9A is for composition taxable person, but it is not effective. No one has ever filed GSTR 9A till date, because composition taxable person anyways file yearly return. But still, there's something called as GSTR 9A. 9A is for regular taxable person. CTP is not coming here. Annual return is not applicable for CTP as well as NRTP. So 9 is only for regular taxable person. 9A is for composition taxable person theoretically, but practically no. Then finally 9B is for electronic commerce operator who's collecting TCS, who's already filing GSTR 8. GSTR 8. So you're talking about concept of 9, 9A and 9B. 9, 9A, and please understand that for them there's no concept of due date of payment. Though you may make the payment while filing your GSTR 9, but it's not mandatory. It's only a reporting mechanism. Payment you may make, you may not make. If you want to stop interest calculation, if you're very clear that you missed out some dues, and if you want to stop your interest calculation, make the payment. But payment is not mandatory while filing your annual return. So there's no question of due date of payment. It is only question of due date of filing your annual return. 9, 9A are technically called as annual return. 9B technically is called as annual statement. Annual statement. Name difference is there, and the due date of that is 31st of December of succeeding financial year. 31st of December of succeeding financial year. Be it 9 or 9A or 9B, 31st of December of succeeding financial year. Now please understand that along with 9, there can be a reconciliation statement. This is only specific to 9. Along with 9, there can be a reconciliation statement, which is GSTR 9C. 9 along with 9C. That reconciliation statement is required to be filed when? This reconciliation will reconcile the figures of your annual return GSTR 9 and annual audited financial statement, which means your GST records and your books of accounts. That will reconcile. Reconciliation will be there. So GSTR 9C is not a separate return, it's an attachment to GSTR 9. It is only an attachment to GSTR 9 which will reconcile the figures of your annual return GSTR 9 and annual audited financial statements. Annual audited financial statements. Please understand this is required only and only in scenario. Your GSTR 9C is required only if your aggregate turnover is more than 5 crores. If your aggregate turnover is less than 5 crores, only 9. More than 5 crores, 9 along with 9C. Also understand that when you're talking about GSTR 9C, there is no requirement of any signature by CA, CMA, which was initially there. So self-certification. Self-certification. A regular taxable person will always file GSTR 9. And if at all his aggregate turnover is more than 5 crores, it will be 9 along with 9C. 9 along with 9C. What is 9C? Reconciliation statement. What reconciliation will be done? Your GST annual return figures, GSTR 9, compared with annual audited financial statements. And you have to write the reasons for the differences. So reconciliation statement will be there. Now understand that there is some relaxation, both when you're talking about 9C, relaxation. We'll complete all these points here itself. This is all about your annual return. Now, certain special points. 9 as well as 9C is not required to be filed by government, that is central government, state government or local authority, if their books are already been subject to audit by CAG or any other statutory auditor. If the books are already been subject to audit by CAG or any statutory auditor, then for government there is no need for GSTR 9, no need for 9C. No 9, no 9C. So if you are talking about OIDARS from outside India, government, that is central government, state government and local authority, where the books are already subject to audit by CAG or any other statutory auditor. Finally, you are talking about foreign airline company. Foreign airline company. Now, OIDRs from outside India, initially if you see the provision, you will find that they have to file their annual return. But finally, you have a relaxation. No need of 9, no need of 9C. Central government, state government, local authority, if their books are already been subject to audit by CAG or any statutory auditor, no need of 9, no need of 9C. Foreign airline companies, there are conditions. If they satisfy the condition, they have to file 9 but not 9C. What are the conditions for the foreign airline company? It should be properly complying with the Companies Act provisions and making sure that it is preparing statement of receipts and payments for their Indian operations, not for entire operations, global operations, only for their Indian operations, only for their Indian operations, certified by a chartered accountant, no CMA, certified by a chartered accountant and submitted that on or before 30th of September of next financial year. For each of the GST number. For each of the GST number separately. Foreign airline company which is satisfying the criteria of Companies Act, Return of Companies rules and submitting the statements of receipts and payments not for the global operations but for the Indian operations GST number wise. GST number not one, it is GST number wise and it should be certified by a CA and submitted on or before 30th September. If all these things are satisfied, no need of 9C. If the conditions are not satisfied, 9 and 9C. 9 and 9C. Right. These are the special relaxation that you have in your annual return. Annual return. OIDRS, no condition, no 9C. Government, local authority, if their books are subject to audit by CAG or a statutory auditor, no 9, no 9C. But there's a condition. You have a condition. Foreign airline companies, file 9 but no 9C, but you have conditions. If you are not required to file 9C, please satisfy the conditions. Please satisfy the conditions. Right. That is all about your annual return and annual statement 9, 9A and 9B. Then you have something called as your final return, which is to be filed by regular taxable person, casual taxable person, even OIDRs from outside India. RTP, CTP and OIDRs from outside India. Final return. Final, this will come at the time of cancellation. There's something called as first return, but it is not a separate form. First return is a normal return that you file, be it 13B, be it CMP 08, normal return that you file, or be it even GSFI, for a group of months together. For a group of months, this will come, first return will come at the time of new registration and revocation of suspension. That's something called as first return, which will come when? New registration and revocation of suspension. New registration and revocation of suspension. Birth and rebirth. New registration and revocation of suspension. But it is not a separate return. You will not find any mentioning of that because it is a return that you file for a group of months. Supposing you are liable for registration on 1st of June, but you are getting registration on say 15th of July. When you are filing your first return, it will be for June and July month together, the due date of which will be 20th of August. for GSTR 3B and for GSTR 1, 11th of August. It is a normal return that you file for a group of months together. Group of months, when first return is applicable? New registration, revocation of suspension, birth, rebirth. When final return will be there? Death, cancellation. Only one scenario, cancellation. But final return is a separate return. Final return is a separate return. Who are required to file that final return? RTP, CTP, OIDRS from outside India. Basically, RTP, CTP, OIDRS will not have any stock. RTP and CTP. Now, in the final return, what are they going to give? The details of stock and the ITC taken. Because when you are cancelling your registration, this has been discussed a lot of time. VJ registered is different from VJ unregistered, which means there will be deemed supply. There will be on the stock that you have. The stock details that needs to be mentioned in GSTR 10. You are required to make the payment. You are required to make the. So, along with final return, you will find payment also being there. Correct? On the stock, you have to make the payment. Deemed supply. Deemed supply. Now, what is the due date for that? The due date for that is within 3 months. It is only a one-time return within 3 months. Both for GSTR 10 and payment is within 3 months. Either from the date of cancellation or effective date of cancellation or order of cancellation, whichever is later. Whichever is, I get the registration cancellation order on 10th December, but it is effective from 1st April. So it is 10th December or 1st April, whichever is later. Whichever is, from that you have 3 months time. So from 10th December, I have 3 months time. 10th Jan, 10th Feb and 10th of March. So I have to file my final return on or before 10th of March in our example. I get the cancellation order on 10th December, but it is effective from 1st April. So first decide what from where you are going to start 3 months. Whichever is later. 1st April or 10th December, whichever is later. 10th December. From there you have 3 months time to file your annual return. Sorry, to file your final return. To file your along with final return, will there be payment? Yes. Stock information will be there because it is deemed supply, and on that you have to make the payment. Then you have something called as GSTR 11, which is filed by international bodies having UIN, unique identification number. Unique identification number. Remember, international bodies having UIN, unique identification number. They will file their GSTR 11. Please understand that they will never make any payment. So there's no question of any due date of payment. And understand that their return filing is very special. Only when they want refund, they will file GSTR 11. If at all they are not interested in any refund, there is no requirement of filing GSTR 11. There is no requirement of filing the GSTR. So when GSTR 11, there is no due date for GSTR 11. GSTR 11 needs to be filed when they are making their refund application or at times when it is demanded by the proper officer, which is very rare. So they will file GSTR 11. There is no due date. When they are making refund application of tax paid on their inward supplies, they don't have any outward tax. They don't have any output tax. Input tax they have, but they cannot take the credit. ITC cannot be taken, but they can apply for refund of that input tax. They cannot take the credit. So it is not refund of ITC. It is refund of input tax, not input tax credit. Refund of input tax, which is there on their inward supplies. So they'll make the refund application. So if you are supplying to international bodies, you will pay output tax and UIN will have input tax. Can UIN take the credit? No. Because when you don't have any output tax, you cannot take the credit. Now UIN is having the burden of input tax. What UIN will do? Will go and make the refund application of the input tax. When it is making refund application, file GSTR 11 to show what all inward supplies you have and what all input tax you have. What all inward supplies you have and what all input tax you have. So that is GSTR 11. And finally, there's a return which is there in your ITC chapter called as job worker return, which is to be filed by the principal. Which is to be filed by the principal. And that return is called as ITC 04 to give the details of the goods which have gone to job worker and which have come back from job worker. That will contain the details of delivery challan given to job worker and received back from job worker. Received back from job worker. Now that due date is either half yearly or it is yearly. We are talking about half yearly return or Yearly return. If I'm not wrong, the limit for that is 5 crores. You can cross verify that limit for that is, take your ITC chapter and see the limit for that. It is 5 crores. If at all, your turnover, aggregate turnover is up to 5 crores. Is it 5 crores? If your aggregate turnover is up to 5 crores, then what will happen? You are a small person. You file yearly ITC 1, ITC 04. You file yearly if your aggregate turnover is more than 5 crores in the preceding financial year, then you are a big person. When you are a big person, you file half yearly ITC 04. If you are a big person, 2 ITC 04 half yearly. If you are a small person, 1 ITC 04 yearly. It is yearly. So aggregate turnover of preceding financial year. What will be deciding criteria? Aggregate turnover of preceding financial year. Preceding financial year. Right. What is the due date after the half year is over or after the year is over? 25 days. You'll have time limit of 25 days. Which means if you are a small person, if your aggregate turnover in preceding financial year is up to 5 crores, you will file only yearly ITC 04, which is after the year is over 25th of April. If you are a big person, if your preceding financial year, previous year aggregate turnover is more than 5 crores, you will file 2 ITC 04 half yearly for the first half of the year, April to September, 25th October, October to December, second half, 25th April. 25th? Obviously, there is no question of any payment because it is only an information return. It is only an information return that the goods that I have sent, whether they have come back within the time. It's only an information return. Information return. These are all the different types of returns. Now, for all these different types of return, there are 5 questions that you need to ask. 5 simple questions that you need to ask and assess whether what will be the different answers for all these different types of returns. All the different types of returns and their due dates, be it payment and return filing, and also the special points, we are done with it. Now we are trying to understand what? We are trying to understand different concepts in all these return filings. Can you rectify your mistake? If at all you have committed a mistake, all these returns, right from IFF, you will find all the returns being given here. Can you rectify your mistake? Yes, rectification of error is possible. Can you rectify your error? This is the first question that you need to ask. Yes, revision of return is not possible, rectification is possible. If there is some error or omission in April month return that you find in December month, you cannot revise your April return, but you can rectify that while filing your December return. While filing your December return, rectification is possible, revision is not possible. Rectification is possible, revision is not possible. And when you talk about your rectification, we already discussed there's a deadline which is there, same deadline for 3 things. 1 for ITC, second for credit note, third for rectification of return. What is the deadline? 30th November of succeeding financial year or actual date of filing of annual return, whichever is earlier. 30th November does not mean November return. The last return in which you can rectify is October of next financial year. That too should be filed on or before 30th November of next financial year. Now there's one more special point in rectification which was not that. Rectification is possible if you find out your own mistake. Rectification is not possible if at all this error was found out by officer, whether by your scrutiny, audit, enforcement, investigation, inquiry, etc. etc. Simple concept. If you find out your own mistake, rectification is possible. If officer has found out that mistake, even though you have time, you cannot rectify. You cannot. Fairly logical. If you have found out your mistake, rectification is possible. If officer has found out your mistake, rectification not possible. Deadline, time limit is there. But the time limit is when? When you find out your own mistake. If officer has found out that mistake, forget about time limit. You cannot rectify. You cannot rectify. Now, rectification of all the types of returns is possible. But rectification is not possible when you talk about your GSTR 9, 9A, 9B, that is your annual return and annual statement. It is not possible when you talk about your, even your 10, 11 and ID0. 10 actually question, why I have put not applicable, because 10 you will be filing only once. There's no question of filing it again. So rectification is not there in 9, 9A, 9B, 10, it is not even possible. 11, not there, you cannot rectify, and even in your ITC 04, you cannot rectify. See, there are certain things that law does not allows you, but practically you have to rectify. Law does not permits you. So, what we are discussing is about law. 9, 9A, 9B, 10, forget about it, it is not all a possibility. 10, 11 and ITC 04. In all other cases, rectification is possible. Now, second concept. Can you file your return of June month without filing May month return? If you have to file your June month return, you should have filed your previous month return. Return filing goes in this way. If you have filed your return for a particular month, only then you can file your return for the next month. 2. You cannot file your return for the next month without filing return of the previous month. That's a very simple concept. True for all the cases, but not true for IFF. IFF is optional. I can ignore for April, file for May. It is not true for TDS and TCS. Why? Because TDS and TCS, if it is nil return, I am not going to file it. We are going to see the next concept. If there are no transactions, I am not required to file any nil return for TDS and TCS. So, I may not file TDS return, TCS return for April month. I may still file for May month. So, this concept that I should file my previous month return for me to file my current month return is not true for IFF, not true for TDS and TCS, that is GSA 7 and 8, not true for 9, 9A, 9B. I can file my annual return of current year without filing annual return or annual statement of the previous year. Again for 10, this question will not come because it is filed only once. It is not possible. It is actually possible when you talk about your 11 and ITC 4. In all these cases, I can file my GSTR 7, 8, 9, 9A, 9B, 11, ITC 4 without even filing the previous period's corresponding returns. Without even filing the previous period's corresponding returns. Which means without filing April month 7 and 8, GSTR 7 and 8, I can file May month GSTR 7, May month GSTR 8. Without filing annual return or annual statement for financial year 22-23, I can file annual return, annual statement for 23-24. Which means without filing GSTR 11 for April month, I can still file for May month. Which means without filing half yearly or yearly ITC 04 for the previous half year or the previous year, I can still file ITC 04 for the current half year or the current year. In all these cases, I can do that. In all these cases, I can do that. They are all exceptions. Next question. Should I file my nil returns? Even if I don't have transaction, I am required to file my nil returns. I don't have an option. Even if I don't have transaction, I am required to file my nil returns. But there are exceptions. Exception being your IFF, because it is optional. If you don't have transaction, there's no question of going for any nil IFF. That really doesn't make any sense. So IFF, no need to file nil return. And then you're talking about your 7 and 8. TDS return and TCS return. If you don't have transaction, just like your income tax, you are not required to file GSTR 7 and GSTR 8. But wait, this time, when you talk about your 9, 9A, 9B, annual return, even if you don't have transaction, you have to file your annual return. You have to file your annual return. Don't look at the current provisions and tell that, sir, up to 2 crores has no requirement of filing. See, that is all yearly relaxation. It is not a provision which is permanent. It is a provision which is temporary for each year. It is a provision which is temporary for tomorrow. If they don't give this relaxation for the next financial year, you have to file your GSTR 9, 9A, 9B even if your turnover is 0. So please don't go. I have never touched that 2 crores because that 2 crores is a yearly relaxation, not a permanent relaxation. Are you guys clear with this understanding? So filing nil return is not required when you talk about your IFF, GSTR 7, GSTR 8, but for GSTR 10 it is mandatory. Even if you don't have any stock, you have to file GSTR 10. For GSTR 11, not required. ITC 04, not required. So in which all cases nil return is not mandatory? IFF, GSTR 7, GSTR 8, GSTR 11 and ITC 04. And is it mandatory for annual return, annual statement? Yes. Is it mandatory for GSTR 10? Yes. Even if you don't have stock, you have to file your final return GSTR 10. It is not like other concepts. Next, every concept will have a different answer. So you have to remember all the concepts for different points. Next, wait, by the way, before moving on to the next point, when you are going to file your nil returns in all the other cases apart from the exceptions that you discussed, in 3 cases, you have an option to file your nil return through SMS. What are those 3 cases where you can file your nil return through SMS? GSTR 1, GSTR 3B and CMP 08, not for GSTR 4. 1, 3B, CMP 08. 1, 3B, all the other nil returns, I have to go on portal and file it. But these 3 nil returns, 1, 3B and CMP 08, I have an option. Either go on portal and file nil return or through SMS I can file nil return. This facility of filing through SMS is only for nil returns and that too only for 1, 3B and CMP 08, not even for GSTR 4. 1, 3B and CMP 08. Next, late fees concept. If you are filing your return late, you should pay late fees. If you're filing your return late, you should pay late fees. That's true for all the returns, but it's not true for IFF. Very simple logic. After due date, you cannot even file IFFs. You cannot even file. So question of late fees is not there. So for IFF, it is not there. For CMP 0, it is not there. Logically, this you already discussed. CMP 0 is about payment, not about return filing. If you have filed CMP 08 late, you are going to pay interest. You are going to pay CMP 08 is for quarterly payment. It is for quarterly. So if you are filing CMP 08 late, there won't be late fees. There will be interest. There will be interest. And it is not there when you talk about your GSTR 11 and ITC 04. All the other returns, whenever you are required to file, and if you don't file on time, whenever you are required to file, and if you don't file on time, there will be late fees, including your 7 and 8. Nil 7 and 8, you are not required to file. If at all nil transaction, GSTR 7, GSTR 8, you are not required to file. If there are transactions, you should file GSTR 7, GSTR 8. And if you file that late, you have to pay late fees. You have to pay late fees. So when you don't have the concept of late fees, IFF, because you cannot file after due date. CMP 08, because for late CMP 08 there will be interest, not late fees. GSTR 11, because you will file that only when you want refund. Government is not bothered. And ITC 04, logically speaking, there should be late fees, but as of now, there is no late fees. As of now, there is no late fees. 4 cases where there will not be any late fees. And the 5th concept. If you don't file your return, you might get a notice which will ask you to file the return within next 15 days. If you don't file even after that, your case will be taken up for scrutiny. Your case will be taken up for scrutiny. Best judgment assessment may be there. So that is the possibility that you get a notice if you don't file your return. If you don't file your return, you might get a notice. But this notice will not come for your IFF and GSTR 1. Government is telling that we are not bothered about your GSTR 1. If you file your GSTR 1, we don't get anything. If you don't file your GSTR 1, your customer will call you and tell you good words. So we are not bothered about your IFF and GSTR 1. So even if you don't file your IFF and GSTR 1, we are not bothered. For CMP 08, why government is not bothered? Because CMP 08 is not for return filing, it is actually for payment purposes. And there is no notice for your GSTR 11 and ITC 04. See, all the concepts are not applicable for GSTR 11 and ITC 04 and ITC 04. So when you will not get a notice under section 46, even if you don't file your returns. What are the cases? IFF, GSTR 1, CMP 08 and GSTR 11, ITC 04. In all these cases, even if you don't file your return, you are not going to get any notice under section 46. Section 46. So that is all about 5 different concepts. Now if you see your note 2 and note 3, there's a special principle interlinking your GSTR1 and GSTR3B. This principle or this concept is connected to your second concept. If you don't file your previous month return, you cannot file your current month return. Now they are interlinking 1 and 3B. They are interlinking 1 and 3B. If you don't file GSTR1 of April, you cannot file GSTR3B of April. If you don't file GSTR3B of April, you cannot file GSTR1 of May. If you don't file GSTR1 of May, you cannot file GSTR3B of May. So this goes in this sequence. So this is the sequence. First for the previous month file 1, then 3B will open. Then for that particular month, say April month, file 3B, only then May month's GSTR1 will open. Then file GSTR1 of May month, only then GSTR3B of May will open, and so on. And rather than reading complicated 4 provisions, different provisions, interlinking all of them, simple provision is this. April month, first close it, then target May month. In April month, first target 1, then 3B will open. Only when you target 3B of April month, GSTR1 will open of the. You cannot tell, I already filed GSTR1 of April, I can file GSTR1 of May. No. After you file 1 plus 3B of April, only then GSTR1 of May will get open. And after you file GSTR1 of May, only then GSTR3B of May will get open. So this is the sequence. This is the sequence. This sequence you have to follow. Interlinking the previous month and the next month between 2 types of returns. Between 2 types of returns. Now, there's a new provision that is added. That provision tells that in case a registered person, this is the last provision, in case a registered person gets an intimation under Rule 88C, which tells that there is a difference of liability, output liability in your GSTR1 compared to GSTR3B, which means your GSTR1 output is more than GSTR3B. Your GSTR1 or IFF, mini GSTR1, output liability is more than GSTR3B, you might get an intimation. The moment you get that intimation, what will happen is you will not be allowed to file GSTR1 or IFF from the subsequent tax period. If you get that intimation, what is being barred? Filing of GSTR1 of the subsequent tax period is being barred. Now understand, if I cannot file GSTR1 of the subsequent tax period, I cannot even file GSTR3B of the subsequent tax period because of provisions that we have discussed just now. So what is happening? They are telling that if at all you get an intimation under Rule 88C, which tells that your output tax liability in GSTR1 or IFF is more than GSTR3B, then automatically the moment you get that intimation, what will happen? What will happen? From the subsequent month, your not from the same month, from the subsequent month, you will not be in a position to file GSTR1. But when I tell you cannot file GSTR1 of the subsequent month, it is implied that you cannot even file GSTR3B, because without filing GSTR1 of that month, you cannot file GSTR3B. But they give an exception. What are the exceptions? Either you reply to that intimation, or you accept the difference and tell that I have made a mistake, pay that amount. If you agree that there is a mistake, pay that amount. If you don't agree, reply to that intimation. If you have paid or if you have replied, this will not apply. This will not be applicable. If you have paid or if you have replied, this restriction will not be applicable. Right? The moment you get this intimation, they are expecting you to take action. What is action? Either reply, explain the difference, or deposit. There can be genuine reason for the differences. Actually, there can be genuine reasons. You would have made a mistake in GSTR1 of earlier months where it was lesser. Now you are adding that. In 3B, it was right in the earlier months. Now you are not doing anything in 3B. So there can be genuine reasons. Either reply or make the payment. Then this restriction will not be applicable. If you don't take any action, then from next month onwards, your GSTR1 and 3B, they tell that your GSTR1 IFF will be blocked. The moment it is said that your GSTR1 IFF will be blocked, it is implied that you cannot even file GSTR3B from the next month. So that is all about your different types of returns and the different concepts therein. Now, certain special other points which we did not discuss. Late fees concept. Late fees concept. So when you talk about your late fees, understand that late fees is different for different types of returns. So first you are talking about your GSTR 1, GSTR 3B, GSTR 4. 1, 3B and 4. In case of 1, 3B and 4, you need to understand that if at all you have a nil return, that's a different late fees. If you have a normal return, that's a different late fees. If there is a nil return, what are the late fees? If there is a nil return, what are the late fees? Irrespective of your aggregate turnover, it is rupees 100 per day or 250, whichever is, everywhere it is whichever is not higher, everywhere it is whichever is lower. The maximum late fees will be 250. And all these late fees that we are discussing is CGST late fees. Copy paste amount will be SGST late fees. So we are discussing only CGST late fees. Our discussion is restricted to your CGST late fees. Copy paste amount will be there for SGST. So when you are talking about normal GSTR 1, 3B and 4, then you have to ask a question. What is your previous year aggregate turnover? What is your previous year aggregate turnover? If your previous year aggregate turnover so and so, late fees will be so and so. If at all your previous year aggregate turnover is up to 1.5 crores, then the late fees is rupees 100 per day, subject to a maximum of 1000. Subject to maximum of whichever is lower. If it is 1.5 crores to 5 crores, then it is rupees 100 per day of delay. Per day means per day of delay. If there is 2 days delay, 100 multiplied by 2 days. If there is 3 days delay, 100 multiplied by 3 days. Or rupees 2500, whichever is lower. How to find out the delay? Check the due date of return and check the actual date of return. Find out the delay. If at all your previous year aggregate turnover is more than 5 crores, then it is rupees 100 per day or rupees 5000, whichever is lower. So in your text you need to make it very clear that everywhere it is rupees 100 per day or 250, whichever is lower. Rupees 100 per day or 1000, whichever is lower. Rupees 100 per day or 2500, which is lower. Rupees 100 per day or 5000, whichever is lower. Here also rupees 100 per day for composition scheme GSTR 4 or 250, whichever is lower. Rupees 100 per day or 1000, whichever is lower. I have mixed composition scheme along with this scheme because when you're talking about composition scheme, obviously your previous year aggregate turnover will be only up to 1.5 crores. So you need not remember it separately. In this chart itself, we can easily find out the answer. Obviously, it will always be up to 1000 only. It cannot go beyond it. Your composition scheme dealer, your previous year aggregate turnover cannot be more than. So obviously, you'll stop in the first slab itself. Will not go to second and third slab. You'll not obviously go to second and third slab. And by the way, late fees is separate for GSTR 1, late fees is separate for GSTR 3B because their due dates are separate. I may file GSTR 1 on time, no late fees. I may file GSTR 3B after time, there will be late fees. This is for GSTR 1, 3B and 4. There is another late fees for GSTR 7, which is for government themselves. Government will be filing TDS return. Government will be filing. Look at the irony. Government tells that how can we pay extra late fees for us? Late fees is not rupees 100 per day, it is rupees 25 per day or rupees 1000, whichever is any case. Obviously, nil GSTR 7 is not required. Normal GSTR 7 is required. So it is rupees Not 100 per day. It is rupees 25 per day or 1000, whichever is lower. Whichever is lower. Right. Then you have your annual return. Then you have your annual return. Annual return. GSTR 9, 9A. Rather, 9B is not covered here. 9B will go in other place. 9B is not covered here. It's only annual return, not annual statement. It's only and only annual return, not annual statement. In that case, forget about nil and normal. See, only for 1, 3B and 4, that's a differentiation between nil and normal. For all of the cases, whether it is nil or normal, the answer remains the same. Now, when you're talking about GSTR 9 and 9A, 9 and 9A, what is the late fees? Again, it depends on your aggregate turnover. Aggregate, this time your aggregate turnover is of current year. You are going to file your annual return only after the year gets over. Only after the year gets over. You are not required to see that year's aggregate turnover. If you are going to file annual return for 22-23, you see aggregate turnover of 20-23. There is no requirement of seeing 21-22 aggregate turnover. You are getting that point. Why your annual return is filed after the year gets over? So that year's aggregate turnover. That year's aggregate turnover. And the late fees. So that year's aggregate turnover, if it is not, if I am not wrong, 5 crores, 25 crores and more than 25 crores. Yes, 5, 25 and more than 20, up to 5 crores, 5 crores to 25 crores and more than 25 crores. Up to 5 crores, the late fees is very special here. It is rupees 25 per day or 0.02% of state turnover. Please understand when to use aggregate turnover, when to use state turnover. Whenever it is a concept, aggregate turnover, pan India. Whenever it is a calculation, finding a number, be it late fees. Now, concept was whether you are big or small. So, you have used aggregate turnover. 5 crores, 5 to 25 crores, 25 crores. And computation was calculating the number. Whenever you want to calculate the number, including when you are calculating the number under rule 42-43, any place where you calculate the number, even under composition scheme where you calculate the number, the moment you start calculating the number, you go with state turnover. When you talk about payment for composition scheme, you go with state turnover. The moment you start calculating the number, you go with state turnover. Inner limit for state, you go with state turnover. The moment you want to find out a number, go with, no need to buy art. Calculation, state turnover. Conceptual thing, whether you are big or small and all, aggregate turnover. Pan India aggregate turnover. If at all you are in the second slab, rupees 50 per day of delay or 0.02% of that state turnover. If it is 25 crores, more than 25 crores aggregate turnover in that year, it is rupees 100 per day or 0.25%. Now it is not 0.02, 0.25% of state turnover. 0.25% of state turnover. It depends on the slab. And all the other returns. What are the other returns that you are required to file? Are you required to file IFF? No. There is no late fees for IFF. What are the other returns that are? 1 is gone. IFF not relevant. 1 is gone. 3B is gone. 4 is gone. CMP 08. Late fees will not come. Interest will come. Then what are the other returns that you have? GSTR 5, GSTR 5A, GSTR 6. 7 is not there because 7 you have a special late fees. GSTR 8, GSTR 9, 9A special late fees. 9B is there. GSTR 10, yes, you have late fees. 11 and ITC 04, you don't have any late fees. These are all the other returns. For them, it is rupees 100 per day or 5,000, whichever is lower. This is a basic provision actually. The main provision is rupees 100 per day or 5,000, whichever is All the other things that we discussed for 13B4, for GSTR 7, for 99A, they are all special relaxation. The normal provision is rupees 100 per day or 5,000, which is lower. Obviously, for annual return, it was rupees 100 per day or 0.25% of state turnover, which was lower. Then there came a relaxation of slabs. Right. So this is the summary of late fees for different types of returns. 13B, 4, two categories, nil and normal. Nil and normal. 7, only one category because nil is not required. Only normal will be there. Very lesser, 25 per day. Suddenly they come with the concept of 25 per day or 1,000, which is lower. 9A. 9A. No 9B. 9B will go in last category. 9A. They come with again the slab. Whether it is nil or normal, it is the slab. 5 to 25 and more than 25. They come with a slab. And if you see the slab, it is very special. It's very, very special. It is rupees 25 per day or 0.02% of state turnover, first slab. Second, 50 per day or 0.02% of state turnover, second slab. Third, rupees 100 per day or 0.25% of state turnover, third slab, whichever is lower. And finally, all the other returns. So that is all about your late fees for different types of returns. Late fees for your different types of return concept. So when you see your return filing concept, we have seen the concepts of different types of return filing as well as the late fees principle. Other small aspects, understand that whenever you are filing anything, there is no mandatory DSC. You have to authenticate it. Whether it is written or any other document that you file on portal, you have to authenticate it. You have an option to authenticate by way of digital signature certificate or electronic verification code. Even if it is companies and LLB, they have an option. DSC or EVC. There's no mandatory. So you have to cancel that. There's no mandatory point. E-signature is only theoretically, not practically there. So they have only two options. DSC or EVC. DSC or EVC. There's no mandation for anyone. Even if it is companies or LLP, they can still go for EVC. One time password that will get in registered mobile number and mail ID. Now, there's something, how many portals are there, by the way? Other small concepts will complete. How many portals are there? 3. Main portal, www.gsc.gov.in. You will do all the functions there, right? Starting from taking registration, making payment, filing returns, filing appeals, etc., etc. Everything being done there. Everything else which is not covered in other two portals will be done here. Then there is e-way bill portal, www.ewaybillgsc.gov.in. Only work is generating e-way bill. Then you have e-invoice portal, 10 portals, www.einvoice1.gsc.gov.in. Starting from 1, it will goes to 10. You can access only 1. 2 to 10 will be accessed by GSP, GST Suvidha providers. Alright. The only work of e-invoice portal is generating e-invoice. Now, when you talk about your main portal and e-invoice portal, they are managed by GST network. They are managed by GST network. So, GST network manages your two portals, main portal and e-invoice portal. What about e-way bill portal? It is managed by National Informatics Center. National Informatics Center. Your e-way bill portal was brought out in emergency because government failed to understand that they will manage e-way bill. They can manage e-way bill on the same portal. So it was now managed. It was then managed by National Informatics Center, NIC, National Informatics Center, Ministry of Information and Ministry of Information Technology and Communication. That is under that ministry. So NIC will manage your e-way bill portal. Now, what is GST network? It is a non-profit company, Section 8 company, having major control of government. Even banks are part of it. Now, normally you can contact directly to the portal. Second option, you can contact to the portal by GST Suvidha providers. Classic example, Tally. You need not go to the portal. You can contact by way of GSP, GST Suvidha providers. They are all IT companies, fintech companies, IT companies. You can contact via them, right? So, first option is directly talk to GST portal. Second option is via GSP, Third option is have even ASP, but ASP cannot talk to portal. few information shared to application service provider. Say for example, sales information in restaurants is there in POS machine application service provider. That application service provider will give the sales information to GST Suvidha provider, and other information you directly enter into GST Suvidha provider, and finally GST Suvidha provider will talk to the portal. So you give part information to ASP, which will directly give it that to GSP, and balance information directly to GSP, which will in turn talk to portal. Why you go for application service providers? Because you can have a lot of customized programs or codings with your application service provider. The role of ASP is now reduced because GSP tries to give as much as customization as it can. But even at times, the level of customization that GST Suvidha provider, big IT companies, big fintech companies, whatever they try to give, they cannot give it at a group level, because they are all big companies. They will solve the common issues, not specific issues. Now, specific issues will always be addressed by ASP, application service provider. So you will see a lot of websites, lot of apps, not websites, lot of apps that you see might not be technically GSP. They will be technically ASP. They will be talking to GST Suvidha provider. So that is all about your different portals and GSP and ASP. This completes your entire written filing chapter.